morning, sir.
Morning. The tomatoes look good. What should I grow next year though? How can my farm adapt to climate change?
You only progress when you ask better questions. Mint. Think ahead. Think growth.
How can I achieve my targets? How can I target the remotest markets?
You only progress when you ask better questions. Mint. Think ahead. Think growth.
Namaste and good morning, everyone. And a warm welcome to all of you to the 18th edition of the Mint Annual BFSI Conclave 2025. Well, my name is Kavya R. Chavali, and I extend a warm welcome to all our dignitaries and all our guests here as we come together to be part of conversations that showcase groundbreaking innovations shaping the future of finance. Now, that being said, we all know that India's BFSI industry is driving the country's growth story, expanding credit, accelerating digital finance, and also bringing millions into the formal economy. So let's get together and be part of some riveting insights flowing in from this side of the hall, and let's do so. But before we do that, I'd also like to take the opportunity to thank our associate sponsors, Equirus Capital, Pine Labs, HDFC Life, J&K Bank, and Gift City. Now, that being said, we'd also like to urge all of you to please join the conversations using the hashtag MintBFSI Conclave. You can also please tag us at @LiveMint. So while we get to witness all the insights flowing in from this side of the hall, please join in with your thoughts as well using the hashtag MintBFSI Conclave. Now, that being said, another quick and important announcement coming your way. As you can all notice on your tables, we have placed these interesting tent cards. And as the nation readies for the budget 2026, Mint invites you to share your views on the next year's priorities. So I'm going to urge you all to scan that QR code so that you can go ahead, share your thoughts, your priorities as well, and they've all been placed on the respective tables. At the same time, we also want to quickly introduce all of you to the Mint Annual BFSI Conclave, your AI-powered networking companion right at your fingertips. We've got another tent card placed right there. All you have to do is, again, scan the QR code, and then you can go ahead, get to be part of a world of opportunities, collaborations, and partnerships. So as you do so, it'll straight take away you to a bot, that is what we're calling it, the WhatsApp chat. That bot will help you connect with the people around you, will also help you with all the things that's happening right here at the conclave. Any queries, any doubts, the team is right around to help you. But that being said, let's get the conclave started. And to set the tone and to set the context for the day, I'd now like to invite on stage a commanding voice in Indian journalism who drives Mint's editorial vision with intellect, clarity, and relentless integrity. I'd like to please invite Ravi Krishnan, Editor-in-Chief, Mint. And before he presents the welcome address, I'd like you all to please welcome him with a round of applause. Ladies and gentlemen, Mr. Ravi Krishnan, to set the context for the day. Over to you.
SEBI Chairman, Shri Tuhin Kanta Pandiji, distinguished guests, ladies and gentlemen, I am thrilled to welcome you all to Mint's annual BFSI Summit. This is the 18th edition and the longest running event for our newsroom. The theme this year is Finance's Next Frontier, and the financial services industry is well on its way to crossing it. During my interactions with various executives from the industry and regulators, the energy, the vibe I got from all of them is one of confident acceleration. The cautious optimism which we saw in the years past is over now. And why not? Just last week, the Reserve Bank of India called this a rare Goldilocks moment for the Indian economy. Inflation has cooled down to near 2%. GDP growth forecast for FY26 has been revised upwards to 7.3%. So we are in a sweet spot that few major economies currently enjoy. And this has happened, at a time of global geopolitical turmoil and supply chain disruptions and whatnot. Now, this stability is not an accident. I mean, it is a dividend of a decade of structural repair. Bank NPAs are at a multi-decadal low. The twin balance sheet problem is history. Corporate balance sheets and bank balance sheets are strong, clean, and ready for the next round of capex acceleration. India's primary markets are booming despite some headwinds. They have already raised a record $20 billion. Equity, I'm talking only about equity here. And there is a promise of more to come. Through this all, there have been some common themes running through the whole BFSI sector. The biggest one, I think, which defined 2025 is deregulation. For years, the industry has asked for deregulation. Even the central government wants it. I mean, we saw from the economic survey earlier this year, there was this signal for a massive push for deregulation to reduce the cost of doing business, to increase the ease of doing business. In 2025, the regulators actually listened. In fact, just a couple of months ago, we ran a full pager in Mint where we talked about how, Mr. Pandey here and Governor Malhotra, how the market just loves them because they listened, to people. Secondly, there is a push for more technology, not only for the regulated entities, but even for the regulators. Now, they are watching things more closely. They are pushing for more market intelligence, and they are also acting. I mean, we saw SEBI take to task, a big foreign entity in trading, Jane Street, earlier this year. Recently, it published a consultation paper on responsible AI. So in the days ahead, a key task for the financial services sector, I feel, will be managing this tension between innovation and governance. Gen AI, in an area like banking, for example, has moved from hype to hyper-personalization. Fintechs are maturing into regulated entities. They have a self-regulatory organization now. And underneath all, the basic question still remains, how do we innovate without compromising trust? That is the bedrock of financial services. We have a packed agenda today. I invite you all to enthusiastically participate in it. Thank you for being part of Mint's journey. Let us start. I welcome Shri Tuhin Kanta Pandey, Chairman of SEBI, to deliver the keynote address. Thank you.
Thank you very much, Mr. Ravi Krishnan, and also Mint. Distinguished leaders of the banking, insurance, and financial services sectors, esteemed colleagues and friends, a very good morning. It's a pleasure to join you at the Mint BFSI Summit on the theme, Finance's Next Frontier. We often view banking, markets, and insurance as distinct domains, credit, equity, and risk. But those walls no longer exist. India's financial system now functions as one integrated ecosystem. Consider a typical Indian corporation today. Mutual funds and retail investors hold its equity. Insurers and pension funds subscribe to its bonds, and banks finances its working capital. These linkages have fused these segments into a single economic ecosystem, enhancing efficiency and widening capital access. These linkages also heighten systemic interdependence, where an event in one segment can rapidly transmit to another. Steering India Inc. today requires a holistic, system-wide perspective. To build a Viksit Bharat by 2047, we need to fundamentally rethink how we finance our growth. For decades, India Inc. has leaned on bank credit, but future growth requires diversifying risk beyond a single balance sheet. Our markets are now ready to shoulder this burden. India is transforming decisively from a bank-led to a market-led financing model. Our equity and debt markets raised over 9 trillion rupees in the first 8 months of this financial year. Corporate bond outstanding has reached 55 trillion rupees, now standing at close to 60% of bank credit to industry and services. On its part, SEBI has progressively strengthened India's capital raising ecosystem. We have simplified listing frameworks, reduced listing timelines, and recommended easing of minimum public offer thresholds for large issuers. To encourage new age companies to list, we have allowed founders to retain ESOPs post-listing while maintaining transparency. We've introduced measures to make the corporate bond market more accessible to retail. Framework for REITs and InvITs has been tweaked to boost retail participation, liquidity, and governance. For AIFs, which channel risk capital into our markets, we have provided operational flexibilities to their accredited investor-only schemes, as well as also providing co-investment opportunities, and reduce the minimum investment threshold for large value funds. Going ahead, India's priorities in science and technology will bring innovations in strategic sectors like AI, semiconductors, clean energy, biotech, advanced materials, defense tech, and space tech. The government has also recently announced to launch a fund of 1 trillion rupees to support high-risk, high-reward R&D in these sectors. While such enterprises may receive government and venture capital funding, what role can our markets play to provide long-term capital for such enterprises? Can SEBI's Innovators Growth Platform, called IGP, be modified to enable such companies to better access our markets? SEBI's goal has been very clear: optimum regulation. Regulation is not the destination, it is the instrument. Over-regulation may kill the very innovation that drives our economy, while under-regulation may breed systemic risk. We have undertaken a comprehensive review of SEBI stockbrokers and mutual fund regulations to make them more objective, contemporary, easier to comply with, while strengthening investor protection. Going ahead, we will be reviewing the LODR regulations on similar lines. We recently standardized the framework for penalties levied by stock exchanges on stockbrokers. A major ease was to do away with imposition of penalties by multiple exchanges for common violations. Now, penalties will be levied by a single exchange across exchanges. Extending this approach, we will now seek to establish similar common framework for companies listed on multiple stock exchanges. Because the companies also have to do the similar thing for both the exchanges if they are. So can we have a common penalty framework for them as well? We are streamlining the provisions governing the administration of our MIIs. The exercise for stock exchanges is underway, and we will take up clearing corporations and depositories in a phased manner. While we stress on optimum regulation, we will not compromise on investor protection and market integrity. Our objective is not forced compliance, but voluntary adherence because well-designed rules align with good business practice. We now have over 13.5 crore unique investors in our markets. This is a massive demographic dividend, but it comes with a responsibility. Our investor survey has highlighted the challenges and opportunities that lie before us. While 63% households are aware of securities product, only 9.5% actually invest, with 80% households being risk averse. Moreover, only 36% investors possess adequate knowledge about the securities market, making them vulnerable to performance claims. We are tackling this head-on. Our investor-focused campaigns like SEBI versus Scam will be in multiple formats, digital, multimedia, physical, and in multiple languages. The valid UPI handles and the SEBI check utility of SEBI have created a secure digital pathway for investors, ensuring that payments go only to registered intermediaries. Direct payout of securities into client accounts and upstreaming of client funds has enhanced protection of investors' assets and funds. SEBI is actively monitoring social media platforms for misleading content related to the securities market. Over the last 1.5 years, we have escalated more than 1 lakh such instances to the concerned platform for taking down. We'll intensify our efforts to take down such content, especially now that the SEBI has been notified as an authorized agency under the Information Technology Act. The Past Risk and Return Verification Agency, PARVA, has been recently launched. This will give investors access to verified performance data of intermediaries, enabling informed investment decisions. We are looking at further simplifying the onboarding of retail clients. Apart from doing away with redundant documentation, investors will not be required to provide supplementary information repeatedly to each intermediaries during account opening. Re-KYC norms will also be streamlined to ensure that only updated records reside on our KRAs. Public consultation on these measures will be carried out shortly. Just this week, we have made it easier for NRI clients to invest in India by doing away with the requirements of the physical presence in India during re-KYC. Now we will look at further easing the onboarding itself of NRIs in consultation with all stakeholders. For our global investors, we've introduced the Swagat FI framework to facilitate easier investment, access, and unified registration. We have also eased regulatory compliances for FPIs investing only in government securities. Our aim is to complete digitalization of the FPI registration process to reduce the registration timeline from months to just a few days. Technology, the new regulatory frontier. The markets of today and of future will run on code as much as on contracts. While this brings efficiency, it also introduces risks. A single cyber incident at a key market institution can destabilize the entire ecosystem. We are no longer regulating entities. We are regulating resilience. As leaders, you must treat technology and resilience as a boardroom priority. We have strengthened the governance framework of our MIIs, ensuring that public interest always comes first. A comprehensive cyber security and cyber resilience framework has also been mandated for all regulated entities. SEBI has rapidly scaled its SupTech, that is supervisory technology capabilities, deploying AI-driven analytics and upgraded data systems to enhance speed and quality of our oversight. Our revamped surveillance architecture now generates predictive, rule-based alerts on manipulative trading patterns. SEBI's upgraded data warehouse and offsite tools allow continuous supervision of the MIIs and intermediaries. We will constitute a working group of experts to prepare a 5-year and a 10-year technology roadmap for the MIIs. The goal is to prepare a comprehensive vision for the MIIs, considering their systemic importance and rapid changes in emerging technologies. We will aim to strengthen organizational competencies, enhance technological capabilities, and prioritize workforce development. The path forward is clear. It's one of partnership and shared purpose. We are not merely building markets, we are building a financial architecture in line with our vision for Viksit Bharat. This journey demands that we recognize our collective role in the larger narrative of India's growth. Whether you are a banker financing a highway, an insurer anchoring a bond issuance, or a fund manager deploying retail savings, your decisions today shape the resilience of our economy tomorrow. The road ahead will undoubtedly bring new challenges, technological shifts, global uncertainties, and evolving investor expectations. But it also offers unprecedented opportunities to innovate, to deepen our reach, and to empower millions of Indians to participate in their nation's prosperity. SEBI remains committed to bringing a responsive, consultative, and forward-looking regulator walking this path with you. I invite each of you to join us in building a capital market ecosystem that is efficient, trusted, inclusive, and future-ready. Thank you. Jai Hind.
Thank you very much, sir, for sharing your valuable thoughts. On that note, ladies and gentlemen, we will now march ahead with the Fireside Chat that will be spearheaded by Ravi Krishnan. So with that, Ravi, over to you.
Thank you. Thank you, Chairman Pandey. One thread from your speech today was, that phrase which stuck with me was optimum regulation. So in the 9 months so far, in your tenure as SEBI chair, you have emphasized optimum regulation over hyper-regulation, so to speak. But how did this come about? I mean, can you give us an example where you felt that there was hyper-regulation and you needed to dial back?
I think I think I've been in the government for a while, and we have been seeing, how much of latent potential that we have if we are able to regulate better. Basically, regulation is for a purpose, not an end in itself. And the purpose also changes as the context changes. There is something called, in rules and regulations, there is a concept called stickiness. We tend to, something comes up in response to a certain situation, and then it sticks on. We don't review, and many a time there are no sunset clauses. So something comes up for a purpose, contextual, maybe for optics sometimes. When something happens, we seem to be doing something. We become reactive, we bring something more. Now that burdens the entire ecosystem, even though it was meant for a few egregious incidents, or it was for certain bad actors. So this particular thing is quite endemic. And I would say not only in India, but also in several jurisdictions, because if you really see, many countries are today talking about deregulation. After having done, there was a time when they were talking re-regulation, and they went far. Europe is also went so far, and then they started treading down because there is a cost to regulation. So this is what I think we have to understand intrinsically, that I would say intuitively, my intuition is that anything we will see, there will still be some scope for improvements in terms of bringing that regulation down and make it more effective. I'll give you an example. Suppose we have this penalties thing. It's been going on for years. Now you are penalizing people. It more looks like a double jeopardy. Like you do something and you penalize, and then you have another exchange and said, here also you will have to pay double penalty, and then you have to double report. You have to give, forms at double places. So even if you will say, independently looking at the same regulation, but if you do not actually stress on this commonality, common frame, common data standards, so who will define it? Regulations again. So then the second example I will give you. There will be, different segments in, for example, industry. You may have an AIF industry. You may have a mutual fund industry. You may have industry which is relating to REITs and InvITs and so on and so forth. Now there will be fund managers, or there could be PMS. There could be fund managers for different things. Now, it might be because these regulations developed in different points of time by different, departments of the SEBI, for example. There could be, something which may jar you sometimes, that, okay, here you are requiring this qualification, here you are requiring something else, here you are requiring something else. Now, someone who wants all the three licenses, he has to independently satisfy that. So then the question arises what we can do. These regulations have been written, and they are now stuck to it. So therefore, we are now internally raising an issue that can we have a common regulation for fund managers, which is across. So we can dissociate the industry regulation from the manager regulation.
Okay, is that in the works?
Today I think that, since you have raised it, we can actually think more deeply about it. So these are the kind of thoughts, when you do, you will find that you are actually reducing the cost of doing business, one. You are reducing the time taken to do that. Now, you are not necessarily increasing the risk. So without increasing the risk, so therefore what I say is that, with all risk mitigation in place, can we actually write better regulations, simpler regulations, more contextual? So that's what effort now we have taken, and a more comprehensive, not that SEBI hasn't been doing in the past, but we have said that, okay, let's focus more and try to, these are, early pickings. We can do that. But it is a deep work. This work requires a lot of extra efforts. But if we do it, it has got a lot of systemic benefit in terms of reducing the cost of regulation.
So stockbroker regulations, mutual fund regulations, they are all close to 30-year-old regulations, and you have initiated a comprehensive review. What is the single biggest redundancy that you want to eliminate?
It's very difficult to say what is the single biggest redundancy, because redundancies are of different kind. And I think different regulations, when you look at it, you will find different kinds of redundancies. And that's how we should address it and look at. Because I would say that single biggest thing I can say is there are redundancies. So you can take it from me that no regulations can ever be perfect. And it is not also to claim that our new regulations will be completely faultless, in the sense but we have to move somewhere. We just can't really hone up and doing it. So we said substantially we can bring about relief in terms of our own time also. Because when you prescribe an onerous regulation, you end up, you not only make others a victim, you also become a victim yourself. Because we are also accountable to Parliament and whatever we write and media. And so you might raise questions like, you have these regulations, what are you going to do about it? So it's a joint effort from industry and SEBI to reduce a collective burden where collective burdens can be reduced.
Right, but one criticism which I am sure you will face with deregulation is that are we doing enough for investor protection? Let me come to this specific example of FPIs. You said recently that FPI registration time you will cut to a few days. I mean, speed is good, but does this compromise the ultimate beneficial norms which were announced last year?
No, that is exactly what I said. Even, for example, we keep the norm as such, whatever it is. Still, if you register it faster through digitization, you are not really, adding to investor protection just because you are taking too much of a time on registration. So it's a myth. We have to see investor protection. When you are saying that this will reduce investor protection, then let us look at that. What measure will mean that investor protection is reduced? In my opinion, we have taken in last few months so many measures for investor protection, and on a very wide system basis. For example, where as a regulator we have come out with a 30-second check facility for someone who has not even become an investor. That means someone intending to come to the capital market, being duped by fraudsters, for which, they will actually go to the police to see that, because it's like a fraud. You suck their money. But because his intent was to come to the securities market, and someone down the line has defrauded him by cloning the app, using the technology, making him, untrusted, his trust was belied, and he has sucked away through his mule account. Now, this particular thing, if he applies 30-second check on our SEBI check, he will be sure that the accounts he is putting the money in, or the UPI handle which he's using, right? Or the QR code he's scanning, is it the right code, which is of a regulated entity? And just 30 seconds. So suppose we are able to propagate through media, through other campaigns, to each one of them, that, okay, if you are wanting to get a securities market, someone says, okay, now you are there, I'm just put this money into this account, or this handle, or this QR code, and you apply this 30-second check, and at least save that money, because that money was very hard-earned money is just being sucked away by a fraudster. It is not an investor risk. It is a complete fraud risk. It is a crime under the BNS. It's not even a security market crime, because he has not even come to the securities market. Before that, someone has sucked away his money. So these kind of investor protection, which goes even beyond, he's even coming after the securities market we have initiated. finfluencers, how they will be picked up, and awareness, generation, getting into multilingual. Then now Parva system, where performance monitoring will be coming, and nobody can opportunistically claim that, I give so much of return without having independent verification. The right to vote through an app. Nowhere in the world a regulator will ensure that you have a simple app where you will be able to vote as a retail investor to any resolution, bringing proxy advisors' advice right onto the app so that you can choose one of them. So these are the forward-looking measures of the highest kind available in the world today. Nobody has done it. So these are the investor protection measures also. But we are not doing regulations here. These are being done through enablement of a technology kind and asking regulated entities to put their money into these technologies to do the investor protection. So I'm giving you a clear example that simply having more regulation does not mean more investor protection. Sometimes even 2 rules can make the investor protection so robust. And even 100 rules cannot make that investor protection robust. So therefore, we have to really see the merit of the case. And we go into the merit of everything and they said, okay, to what extent investor protection is there? And secondly, I would not like to use the word deregulation as such, because I made it very clear. I'm saying that there is an optimum regulation, because under-regulation may also actually create systemic issues. So the right type of regulation and the right thing, which is also slightly difficult to understand, but the moment we put our heads together, both industry, investor people, those who are dealing with investors, and the media, because we put everything on public consultation before we do. So media has I would say that media is not only a criticizing entity, but also a developing entity. Like your role in participation is so highly appreciated by us that when the public regulation goes and you bring in comments and your editorials, like we take notice of those, that how this will also impact. So this is what I called a co-creation with a purpose. And the purpose is we have an effective regulation, an optimal regulation, keeping the cost of regulation in mind, but we must also take our risk mitigation, investor protection goal as intact.
So at the Global Fintech Fest around a month and a half back, you warned people about irrational exuberance in the derivatives market. Beyond warnings, are you planning to introduce hard caps on retail participation, like, for example, income-based trading limits, or investors sitting for a test or something for an NISM kind of certification before they participate in derivatives?
At this moment, I can say that we had taken certain measures to improve the market, the way we looked at it. Certain segments of derivative markets, which is on the expiry day, on options, you have exuberant activity. And it is also slightly, not understandable from the point of view of hedging and, price discovery point of view. And then also many of the retail participants making huge losses, what our data and study shows. So these were 2 concerns. Based on that, we started looking at the market more systemically. And on October 24 and May 25, we had sets of measures. First in October 24, then a consultation paper, then wider consultation led us to a measured approach on that. And then the May 25 regulations, in which Delta-based was brought in. And then it was a rollout in July and others, and then 6th December was the last rollout. So this is the way we have, and coupled with that is an improved surveillance, both by the exchanges and SEBI. This is one set of measures that we have taken to see that some of those, I would say systemic issues to some extent have been dealt with. If we have to move any further, we will require a further data analysis, and we will require to also say, again, effectiveness of what kind of regulations can be brought into effective so that our intended purpose is achieved. I think that will require a little more time, and when we do that, we'll finish with our analysis, then we'll put it out for consultation. This is something which we don't want to rush into something and then just go back and forth on that.
But the things I mentioned, are they part of the consideration set?
I mean, I don't want to really, at this point, try and explain what kind of things are there, because I think that itself creates a lot of uncertainties. Unless we have really thrashed it out, if to, give, I would say of course, there is a very important interest in the subject from the media, but reacting on, every week or 10 days basis on that is, in my view, is not on, unless we have done a complete analysis, because this is a tricky subject, and we have to see the pros and cons, because it may be very easy to suggest that we can kill the market, but the markets are also built after a lot of consideration. And there are multiple players who are participants in that. So we can't really say that if we have a problem from one side, we can just do it by, it's like, using not really like, we have to look at more nuanced way. And unless we are ready for that, we will not really be commenting on that.
Okay. The mutual fund and wealth management industry, I mean, they have expressed concerns about frequent revisions to TER, which they say, affects their business model. I mean, how do you view these concerns? Are you planning to address them?
They have not complained of frequent revisions, because the last revisions were done 2017 or 18. So there has been no frequent revisions, one. Secondly, in response to the consultation papers, they have given their comments. There have been wide consultations after that. They have also met different, this thing, and SEBI officers. They have also met, their whole association has come and met us also. There are others, sides also who have met it, because, every regulation is on both sides. Our intended purpose of that simplification, apart from bringing the size down, make it simpler, clearer, on the TER, we had an important consideration that there has to be a clarity and transparency about the TER in a manner where the elements of certain taxes which are embedded today in the DER should be extracted out and should be juxtaposed separately. Because the taxes is something which, number one, the people must know what taxes are being paid. And secondly, they are dependent on an external. They are on the government side. So they are not something which they will, today if the taxes rise, they will rise. If the taxes fall, they will fall. So that should not be affecting the TER, because TER should have more flexibility. So therefore, taxes, etc., should be come out and transparently shown. That was one part. The second part was also, we had to say that we have to reduce the cost to investors, given that we have now certain scale. The mutual fund size and scale is of a much larger kind. So therefore, whenever you have a lot of bulk, then there are certain economies of scale which happens. Of course, we have telescopic charges there. Like we have larger schemes, then, the things are less. The TER gets lessened. Taking into consideration all these factors, we will take again an optimum and balanced view which balances the industry's needs, which includes, of course, as you said, the distribution cost and other things, as well as the, our really big objective is also to reduce the cost to investors, because any of you in the room may be actually doing it in mutual funds investments, and you would really like, that your schemes, you get maximum, and you will not be charged more than what is necessary. So it is a balancing thing that will take place.
On LODR norms, an overhaul is underway. So what can companies expect from the revised norms? Is it going to be more of a disclosure-based regime than the approval-based regime for major transactions?
It's broadly, in the LODR, it's more on disclosures and responsibilities, listing and post-listing. So there are, like, this was written in 2015. Some changes have come in on selectively basis depending upon the context and the need. We are looking at more comprehensively now, because 2015 to 2025. So there could be some structural things which you could look at, like the way the companies are there. For example, the kind of companies which are coming today are also varied kind. It was not so 10 years ago. The kind of startups and some of it which today I referred to, like, for example, biotech. So we do have, for example, an IGP, but IGP is not taken off. So there must be certain barriers and certain things which we have to discuss and all that. Then there are certain ambiguities which we can fix, because, any ambiguities can then ultimately has to go towards the courts to fix in case they are, because if there are interpretative problems.
Any example there?
No, I mean, I don't want to really get into the specifics of all that, but there are examples in the LODR where, there could be two views, whether it should mean like this or whether it should mean like that. Now, so making it more unambiguous in others. Third set of problem, there could be a certain terms and expressions which may be more generic and general. So, like, for example, if you have companies' responsibilities or independent directors' responsibilities, whether we are saying that those responsibilities are they very onerous? Because, or are they really, is there any materiality and non-materiality there? Suppose someone asks you to do 10 things. And are those 10 things equally important in terms of materiality of the thing or penalties, or they could be different? Because some of those things will be far more important from the point of view of minority shareholders than minor technical violations. So how do you view it when independent directors perform their jobs, and suppose we look at it, they should have done this and they should have done that. So can we improve the guidance in the LODR on that count? You may have something that, they should have looked at these. These are very, very important. So there could be many such things which will come. Once we open it to consultation, people will actually give their views, including, I think, for media, there could be several views on how should we look at the LODR. But it will take time because, it's a more comprehensive exercise and of a very material regulations. It's a very important regulation. It's quite at the heart of our capital markets.
You said regulators, it's not just about regulation, but it is about development. So when it comes to small and mid-sized companies raising money from public markets, we need a lot more that if India has to become a high-income country, over the next 20, 25 years. But at the same time, there are, questions about some of the companies which are listing on these platforms. SME IPOs has been a very debatable kind of a topic. How do you draw a balance there? Are you going to take a relook at SME IPO rules?
We have taken the review not very long ago when we had some of these issues which were brought to SEBI's thing, and we had intervened then, and we created certain different norms for that. And we are continuing to monitor certain things. So we have to identify whether the problem is, whether there is a systemic problem continues or not, and how do we really do that. So there have been measures which have been taken. Now, do we require further measures, etc.? Again, it has to be a data-based. It has to be based on certain things rather than our own feeling, because certain measures have been taken.
But have you received representations from investors on this particular topic?
No, we do not have very specific, I mean, the people do keep writing, and particularly on social media, when we analyze, so there are different kinds of suggestions which keep on both sides. And some people, they say that we should be tighter, and in some ways that we should not further burden with the rules. So again, we have to really base it on based on what comes out of data.
You have clamped down on several finfluencers and educational institutions, which are posing as investment advisors. Can we expect any specific regulation there? I mean, what more are you planning to do there? Because that is a menace, isn't it?
No, I think that regulation is pretty clear. I don't think there is an ambiguity about it. Because between education and this, what constitutes investment advice is clear. So, I mean, what really we saying that we are able to find out, and I think we had have several cases where we found, for example, pump and dump cases where many of the influencers were involved on a very clearly deliberative way, maybe financed also by certain players in order to pump the stock, and then so that people can make money and then dump it onto the retail investors. So one part of that is a surveillance in general on the stocks, and also on the market surveillance on the social media, and for which I think certain tools we have now to see that, what's going on in the social media. And then we also bring in the disclosure part, the materiality. We said that, okay, this is what is, then we brought in also the rumor verification. We have also brought in, instructions that if someone claims that they have received such and such an order from so-and-so, generally large companies, so the people really want to pump the stock, they may claim false claims. So how do we really see that those, even if the false claims are reported to the exchanges, are they verified by the exchanges? So we have asked the exchanges to verify with those companies wherever they have the feeling that it could be wrong. So, which means that they are checking with those companies of whose names have been taken in that regulation.
Are you confident that this can be fully be curbed, this influencer issue and this kind of advice, fake advice and all that?
The point is that there has to be in constant efforts. This is one area, social media is one area where you cannot say that we take up certain thing for a period and then it's over. No. It's just like a continuous thing. So this will be like a bread and butter kind of thing where everything, it's like we have to keep on doing it and keep on surveillances and keep on removing it. Because here there is a line there where there could be a simple education, and where we can't also take away people's rights in their freedom of expression and whatever they want to say and whatever they want to do. So those fundamental rights have to be respected. So we have to really clearly scrutinize, but increasingly we have the tools available in order to distinguish where the lines are getting crossed. And so therefore we are in a confidence to say that here is a line which is crossed, so therefore we can take down.
One final question as we are running out of time. One of the first things you did after taking charge as SEBI chair was to set up a conflict of interest committee, a committee to study conflicts of interest. Now that committee submitted its report to you last month, and there have been media reports that even some SEBI employees are not very happy with some of the things which might be required of them. What are your views on those? I mean, will you be soon making the report public and implementing it?
The report is made public already, so that is there on the website. Media has commented on it.
In terms of implementation?
And the implementation part, it will be taken to our board, next board, and there will be a deliberations on that. There are elements where maybe which are the felt needs both inside and outside, which can easily be implemented, like on conflict of thing. How do we maintain the conflict framework and databases and creating a framework and having someone to look at it. So internally, those are the kind of things which can, I think, be easily implementable and should be. So it depends upon how the board will take a view on the way we will roll out that implementation.
Where do you see you're likely to face the greatest resistance?
I think there are some issues relating to privacy issues, relating to, say, financial assets because I think committee has recommended that, CGMs and above, we will be they will be also giving the assets and liability, the financial assets and liabilities onto the public domain. I think there are concerns around it on the grounds of privacy. They have no concerns on giving it internally to an independent office and whatever we establish inside SEBI for this. But putting it out as a matter of thing to the public domain, they have issues. And the question that whether it would be necessary, particularly then when it's not largely required still in the system elsewhere in the country.
What is the single biggest task you have set for yourself for 2026?
These questions are very difficult to answer for the simple reason that we always feel that we have multiple tasks to do. And multiple tasks to do also efficiently, because one, our capability to do multiple tasking is also should be well understood. SEBI is a robust institution. We have different departments, we have different things, and we are very ably supported by one, the committee processes that we have. So independently, the committees can do work. So it's not, centralized in a sense that I have to be there and things like that. So as we speak today, several consultations must be going on in different committees and different issues. Then we have got this very healthy practice of public consultations, where what we initially propose gets honed up. And believe you me, that we give importance to every single comment. Every single comment that we receive, we see that, it's doable and not doable, or is nuanced, or whether, we can do it for later stage, maybe as a suggestion, many times there is a suggestion that why don't we do this also? And in some cases, we should say that we cannot agree because of so and so and so. The rationale is given. So that is another one. Then we have, next is media, because of the public consultation, the media now get to react it not on the basis of what sources say, but on actually what is our thought process, which is actually, and with data, which comes out on the thing, where you can actually very, very specifically say that, these kind of things. And so therefore we get a lot of commentary while the consultation paper is out on some of the measures, what it might to lead. So it sometimes saves us from some unintended consequences. Because anything is, whatever you do is rational, it's not unlimited. It's a limited wisdom. Many a time you might say that this may lead to so-and-so, then what we do. So at least it brings about those. I think as a combination, it allows us to do multiple things, but it's very important to see, where we start from. Our starting from, we should have some high-level vision of where we want to really focus our energies on. And once we do that, we can do it at multiple areas to do that. So that's where we are every quarter, you must have seen, is we are able to bring a certain different level of, thinking that, whether we can simplify, do it better and all that. And of course, in some areas, we have brought in tighter regulations wherever for example, in derivative market, we have not been liberal, rather we have tightened it. And that was a very, again, deliberative thought process which has gone into it.
Right, time's up. Thank you, Mr. Pandey, for patiently answering our questions. Ladies and gentlemen, Shri Tuhin Kanta Pandey, SEBI Chair, please give a big hand.
Thank you very much, sir. What an enlightening conversation that turned out to be. But that being said, while I request Shri Tuhin Kanta Pandey ji to please remain on the stage. First up, we'll have a photo up. I now request Ravi to also present a token of our gratitude for the valuable presence and those valuable thoughts that we managed to gather from Shri Tuhin Kanta Pandey. We thank you once again, sir. And on that note, ladies and gentlemen, once again, I request all of you to continue being seated as we march ahead to our very first panel discussion. In fact, this conversation also allowed us to understand a lot around the regulatory reforms that are truly shaping a stronger and a more transparent market. But that being said, we'll now shift your attention to our next topic for discussion, which is all about insurance industry after GST 2.0. Well, as you can notice, we're giving a quick makeover to the stage as we set the stage for this particular panel discussion. We are all aware about how the GST 2.0, how it managed to not just be a tax update, but actually turn out to be like a test even for the insurers, not just to innovate faster, but also price smarter and deliver real customer value. That being said, the GST 2.0 has been redrawing the insurance landscape, simplifying some lines while squeezing others, and also forcing the industry to think value from the ground up. So let's get to understand a little more about this from our very, very interesting and very esteemed set of panelists who are about to join us in a minute. But that being said, meanwhile, once again, I'd like to urge you all, there are these tent cards that we have placed on your respective tables. On one hand, there's a survey that we'd like for all of you to participate, as we all know that the nation is gathering for Budget 2026. So we'd love to hear your priorities as well. So don't forget to scan the QR code, share your thoughts across the survey. And at the same time, we also have the Mint Annual BFSI Conclave, the AI-powered networking. So the other tent card, in fact, has that QR code. Go ahead and scan it so that when you do that, you can actually get connected to a whole lot of collaborations happening right here. So we'd love for all of you to experience that as well. Well, that looks like we're all set. We've set the stage for our discussion, and it's only befitting that first up, I invite the very person who will be extracting all the relevant insights from her panelists. We have with us Deepthi Bhaskaran, editor, Mint Money, Mint, who will be here joining us to welcome her panelists on the stage. Thank you, Deepthi, for joining us. And with that, without any delay, ladies and gentlemen, let me go ahead and invite our speakers. First up, I'd like to please invite Mr. Rakesh Jain, Executive Director and CEO, IndusInd General Insurance Company, to please come on stage, sir. I further invite on stage Satishwar B, Managing Director and CEO, Bandhan Life. Well, let's put some life into that applause as well, and let's welcome all our speakers. I now invite Animesh Kumar Das, Managing Director and CEO, ACCO General Insurance, and G. Srinivasan, Managing Director and CEO, Galaxy Health Insurance. Thank you once again to all the speakers for joining us here. And with that, let's get the discussion started. I'll hand over the proceedings to Deepthi. Over to you then.
Hello. Hello, everyone. Today, we have a very interesting mix of speakers from various sectors of the insurance industry. And we are here to discuss the GST reforms. The government had removed GST from retail health and life insurance policies. And we're here to really sort of discuss how does that unlock demand for the sector, increase operational efficiencies, or bring in even the next wave of reforms, if at all. My first question is to everyone at the panel, but I will start with you, Sateshwar. What are the early signals that you're picking up of GST reforms, especially given that along with the removal of GST, the industry can't claim the input tax credit, so costs have also come under pressure.
Thank you for having me here first, Dipti. And I think it's a big, big change, right? And one is, of course, the mathematics part of it in terms of the price, the discount, and the input cost credit. But the bigger piece which is actually solved or getting solved over here is one, of course, the product becomes affordable. But the next big piece is it getting into an exempt category is helping us in terms of improving the awareness around life insurance, right? The moment it became exempt, the very fact that it got discussed a lot, but it also kind of gives a message that how important or how necessary and how urgent it is to have a life insurance, of that matter, insurance in itself, right? So that also gave it a kind of a huge flip in terms of creating that awareness of not just knowing life insurance or insurance per se, but also how important, how necessary it is. So that's a big, big one. I can't quantify it. Coming back to the pricing part of it, naturally the demand has gone up. We are seeing a lot of traffic into our website. And if I just look at the numbers for the last, say, 2 months since the time it came in, our numbers have gone up by close to 25% on the term space. Naturally, the ticket sizes are small.
Yes.
And especially in the life insurance business, taking both savings and life together. So you will say that the term propositions, ticket sizes are small, and that's the reason you might not see that impact directly onto the end output numbers. But if I just look at our volume on the protection space, it has gone up by good 25 to 30%. And if I also look at the web aggregators, right, the various web aggregators, even for them, I am clearly seeing at least a 25 to 30% increase in that volume.
Okay.
Yeah, so that's big. Coming back to this piece of input tax credit, right? Of course, it's not
costs.
It's a cost, right? Basically, it's all my expenses are going up by close to 18%. But we need to understand that life insurance business is not a one-year product. So it doesn't immediately, similarly, the way we also consider commission as the first year spend, right? It's actually amortized over a good 25, 30 odd years. So when I say it's gone up by 18%, it also gets amortized over that period. There is an impact. It's not that there is not an impact. But we are very optimistic that the demand should take care of it. And there are various other levers that we will have to use. It's not that we had it and we didn't use it. But naturally, when these kind of aspects comes in, when the demand goes up, it's only for the industry to also figure out how do I make it more affordable or use that entire 18% benefit to get the demand side higher. So that's how we are looking at it, and that's how we see the demand going up, and thereby a larger part of the population actually trying and getting some insurance cover for themselves.
Great. Srinivasan, I would like you to come in now. You represent the standalone health insurance companies. And with the GST gone, distribution, of course, came under a lot of pressure with the ITC loss. How are you looking at the numbers? And do you think the price of health insurance would go up at some point?
Thank you, Deepthi, for the question. Thanks, Mint, for this opportunity. I think removal of GST is really a great move. I mean, the industry has been asking for it for a very long time, because 18% is too big an amount. It's not a small amount. But if you really ask me whether it has increased the volumes of health insurance, I would say it's still early days. We may see some spikes, but I think insurance is not like automobile. So you will have to really wait and see how this evolves. But we are very optimistic that this will definitely increase the volume of health insurance business to the industry. Because if we look at the Indian scenario, health insurance today is absolutely necessary for everyone. India has great doctors, great hospitals, but the cost of healthcare is very high. So it's very difficult for somebody to be without health insurance. But if you look at the scenario about 40 crore people, what we call as missing middle, are today not insured. Those who are insured are also not adequately insured. The kind of sum insurance they have, if they really go into a hospital, they realize that it's not good enough. So I really see maybe in the medium to long term, this will definitely make most of the people to come into the health insurance net. Talking about the impact on the industry, clearly the health insurers, which I think maybe general insurers also to some extent, the impact is 5 to 6% on our bottom line. Some insurers have passed on part of it to the intermediaries. It's not everyone who has done that. But still on the operating expenses, the impact of that has to be borne by the insurance industry. But I don't think the insurance industry will increase prices because of this. For the health insurance industry, the bigger problem is cost of healthcare.
Yeah.
If the cost of healthcare goes up, clearly the insurance health premiums go up. But unfortunately in India, we don't talk much about cost of healthcare. We are talking of medical inflation of 12 to 14%. If that can be controlled, I think there will be, if that can be brought down, we can even bring down the cost of health insurance premium. I don't think GST will be responsible for increase in health premium.
Yeah, I think that's an important topic. Whenever we discuss health insurance, we need to sort of also talk about healthcare, and I do have some questions in the lineup, and I will be asking you about that as well. Animesh, I'd like you to come in and give me a sense of how the numbers looking for you, given that you're a digital player.
First of all, pleasure to be part of this panel. I think given our model, we are able to closely track the numbers on the website. Like what Satishwar mentioned, we also saw a clear jump in terms of number of visits on the website or number of consumers who are going through the transaction, right? So that's the shift. But there are multiple levers when the consumer are taking calls to kind of buy health insurance or any insurance product for that matter. Price is one of those points, and price is at least the factor which got unlocked with this GST relief. So that we have seen. But the other, and we also always apply consumer lens when we study any opportunity or problem statement. If I have to share a consumer lens in this, one is there is a higher engagement because the industry has got more talking point now, right? There's a talking point, you can go out and communicate something to the user, and usually in insurance there are very less opportunity to get talking points, right?
Absolutely.
So that one thing which happened, consumers are also checking now because there's a affordability to some extent. There we see higher engagement, we see people opting for or checking higher coverages, and we see consumers or rather a higher renewal rate also. So all these factors, there's a shift,
right? Has the conversion improved as well?
Yes, yes. So that's what I'm saying, right? So there'll always be, so you can always see a spectrum of users, right? People who are very price sensitive and they usually take a call basis the price point only. And there are consumers who are purely looking for peace of mind, right? The price doesn't matter, but they're looking for something which gives them peace of mind or trust, right? So there's a spectrum of user. So there'll always be an edge user who will fall into the affordability bucket just because now there's from their lens, it's an 18% discount, right, effectively. So that uplift is there, clearly. On top of it, like I said, one more part of a talking point is that the policymakers are also seeing this category as a need instead of like a luxury, if you can say, right? That if you have disposable income, then you can check for health insurance. So that's not the case. So that positioning also is something which industry also owns the ownership of going out and communicating to the user, right? So that's another angle which is critical to see. I think rest of the points were added by the others.
Okay. Rakesh, I would like you to come in now. Reliance General and now IndusInd General, you've been around since the sector got privatized and you've seen many reforms take shape over the years. Maybe put the piece together for us to basically tell us what are the important reforms for the sector and where do you sort of then put the GST reforms and how does that unlock demand for the sector?
Yeah, thanks Dipti. This is an excellent question in the sense, This is almost 25 years since the sector opened up. Of course, me and Mr. Srinivasan were there to look this through, and Animesh has joined in between. But trust me, there are various ways to really look at it. The first and foremost is obviously, the sector opened up after a consolidation which took place in 72, where 100 odd companies came in together. Again, then in 99, people thought it's good to get private capital, private, partnership in actually growing insurance. So it was a good start, but then, it was like a start in a defined environment because there were tariffs, there were wordings, there were hardly any intermediary regulations. The broking regulations came a few years later. So clearly it was just an open up. You just open the door, but you haven't still defined the world at large. Over the last 25 years, if you really see, the things have started to move step by step towards reaching the end consumer. And if you ask me, that is evolution. It is not something which, one would like to define how it should have happened only, but it was like a goal which, I guess the regulators as well as the, country at large would set for itself. And it also beautifully coincided with the way the economy was also flourishing. Ultimately, we have to understand what is insurance. Insurance is a protection to control volatility in the lives of a consumer. When customer has something to lose, that is the time he needs insurance.
That's right.
And that is the stage which India has experienced and have started to experience more now, as well as likely to experience even higher as we move on. So the need for insurance is compounding because of the need of a consumer to control volatility.
Sure.
And this is why I feel, if we really categorize a few things, of course, I will lay down the few things of opening as very critical, like in 2008-9, de-tariffing took place. The pricing freedom which came to the insurance companies gave them the liberty to really price differently for consumers. Over a period of time, various regulations towards product constructs and all came in. Even, year and a half back, IRDA opened up the product architectures, which means you can customize product looking at different individuals, not just looking at segments or sectors. So in my view, most of these open up environments, were essential to reach a consumer and tell him, look, this is important for you. A big good piece which has happened is the GST now. With the government clearly establishing the fact that insurance is critical for everybody, we recognize this as a social need. And two, we want this to be bought by people. We want everybody to be insured. See, insurance for all is a Government of India's slogan. And to my mind, this is music to our ears in the sense, because insurance is ultimately law of large numbers. If we cover everybody in this country, trust me, the premiums will be half of what we are talking.
And also the coverages will be more comprehensive, right? You'll be able to underwrite more risk.
So GST, in my view, is a great indication for people to come forward and control their risks in a defined way, as against living with the risk as a young demographic country and thinking that we will be able to take care of it as we move on. So this, in my view, is going to be hugely, hugely beneficial. It also will give people the ability to do so much more in their day-to-day activities. Today, many people who must be worried about things can really now be more fearless, and this perhaps accelerates the way we want our GDP and our various other parameters to really grow. And as Mr. Srinivasan rightly alluded to, I think the other problem in which we generally don't measure is not about insurance only, it's also about underinsurance. I can tell you today, almost 30% of the people in health claims today find their sum insureds are inadequate after they really take a treatment. So many of us in some ways have grown in a very small or a controlled architecture. Now people have started to define what they need. People are linking their lifestyles to it. It's not just about survival or existence. It is about the quality of life you want to experience. Insurance gives you that freedom to enjoy a quality of life.
Yes.
It's like if I booked my tickets on Indigo to travel, and if it doesn't happen, I shouldn't be losing my hotel fares, right? That's my lifestyle. That doesn't mean that I'll be scared and worried to travel on air. If you know you have a cancellation policy in place, then you will go ahead and even book after 2 months, even with the same airline.
Yes.
This is not permanent, it's temporary. But then these are costs. So these are how, the lifestyle changes will drive a lot of the insurance thing. And I think GST is a fantastic move to establish this as a country and not like a sector or a segment and sometimes an urban and a rural
Sure. Sure, got it. Mr. Srinivasan, I would like you to come in here. You know, you've been in the industry for many years. You've headed one of the biggest PSUs in India. And now, of course, you know, you are heading a health insurance company, a standalone health insurance company. I think the question I really want to ask is health insurance that price sensitive? You know, we've spoken about demand picking up for health insurance. We've spoken about the government push for people to buy health insurance as a, you know, as an important product to have. But we've not really seen the penetration increase the way we would imagine. So, you know, take us through the 25 years of reforms in the health insurance space, and what exactly do you think will actually push the demand for health insurance in India?
Yeah, I will take your question in two ways. One is health insurance price sensitive? I think every insurance is price sensitive, not only in India, all over the world. But since GST is reduced by 18%, I mean, so the premiums have come down by 18%, does it mean that everyone is going to take insurance? No, that's not going to happen immediately. So it's going to take time. As Animesh just said, that price is one of the levers. There are people who have the affordability, but still they're not taking at this point of time because they feel that it's not required. So I think this is a very positive move, but I think we need to give it time for people to, you know, for everyone to get insured in the health space. Now, the other point which you mentioned, what will make everyone come into the health insurance net? I think as an industry, we also need to come out with products which are meaningful to the customers. We need to now focus on wellness and also OPD, which is almost half the healthcare cost. So I think we need to move to the next, you know, plane of health insurance products. We really need products which can capture the imagination of people. Because today, as I said, you know, this 18% can really be used by people to even upscale their insurances. Is that happening the way we want? I think we still have to wait. I mean, it's not happening the way I would have expected. But I think we need to go out into the market, talk to the people about health insurance, need for health insurance. And the products also should really be something which they can understand. I think if we can do all this, then probably, you know, we will see health insurance for all. I personally feel, you know, health insurance will be probably the first of the insurance products which will become a pull product. Because everything else today we are pushing. But I think the understanding of people about the need for health insurance is very, very high. But I think it has not materialized into everyone taking adequate health insurance. So I think we need to do a lot of things to make that happen.
Sure. You know, you've spoken about preventive and wellness, especially with OPD insurance. Will this GST removal unlock OPD insurance for the sector? Do you see that happening?
No, this 18% is available. So there is a bit of money available with the customer who can spend it on health insurance. How does the industry use this? See, today I personally feel OPD insurance is something the customers want. The industry has not been able to do it because they have not been able to set up a mechanism whereby they can handle OPD in a big way. I think today a lot of things have happened. Today it is possible for us to, you know, come out with products, handle claims reasonably well. I think this is a time where probably the whole industry will need to focus on OPD. If OPD is given a lot of focus, it can even reduce the inpatient hospitalizations for the industry. Absolutely. It's good for the industry also. So it's good for the customer, it's good for the industry. The other one is wellness. See, I always feel that health insurance for a long time has been a disease insurance. I think we need to now move to the level of making health insurance as wellness insurance. If that is the case, I feel, you know, a lot of people will show interest. Today, there are a lot of people who feel that nothing will happen to me. So the better part of the risk is outside the health insurance net. So I think we need to bring them through wellness. And if these people come into the health insurance net, even the viability of health insurance space will improve.
Sure. So, you know, when I look at health insurance, I think of the problem as twofold. One is the young demography that our country has, where, you know, you feel, I'm not getting hospitalized anytime soon, so why do I need to buy health insurance? Because, you know, health insurance still is very hospitalization or IPD focused, right? And then the other problem is that when people actually get hospitalized, there's a lot of problem they face when it comes to claiming. So if you look at the complaints, that's one of the highest in the industry coming from the claims bucket, right? So Animesh, I would like you to step in here and tell me what is it that will sort of increase the demand for health insurance in India?
No, so we discussed like GST reform is one of the levers. Yes. But personally, I believe that the health insurance positioning, or in general health insurance as a sector, I think it needs radical transformation, right? The form factor in our head, at least I'm not saying it on behalf of the industry, from our point of view, it's very outdated still. If I zoom out and few of the points we've been discussing, let's say, how can you integrate OPD or wellness, all of these preventive cares in some sense to kind of manage the health insurance cost, I'll cover two aspects. One is, if you see across all the products, including health insurance, you also touched upon on that point. Health insurance is effectively a financial protection, a tool to kind of manage the financials for your family, right? The decision maker at home, I've said this before, the decision makers at home who are taking financial decisions are getting younger day by day. And their form factor to kind of decide these things are also getting very modern, new age, right? They're not falling back to the traditional way of deciding how should I take care of my finances. So that form factor has to be observed by the industry, and they have to figure out how to reach out to these consumers, right? And Rakesh touched upon on the point that let's say there's a theme of insurance for all by 2047, yes. And if you think about next 22 years, right? Just imagine 10 years from here, which is 2035 or so, almost every financial decision maker at home will be population which is born after internet. And their way of getting introduced to any kind of product is very different than what the generation a decade back was doing, right? So if we zoom out and touch upon on all these pieces, you'll get solutions like OPD has to be taken care of, wellness has to be taken care of, the way the customers, your cost of creating that product has to be way more optimized so that there's an affordability angle. And then the positioning, you have to solve for very basic things like the simplification of the products. You have to solve for out-of-pocket anxiety. Like today, if I buy a product, health insurance product, I don't know what am I supposed to pay when there is a claim, right? And that's an anxiety. So by default, the perception is that I don't know if the insurance company will pay or not, right? Or how much they'll pay. So I'm anyway shelling out something upfront, and am I getting it back in a fair form, right? So all these out-of-pocket anxiety, all these levers have to be solved, right? So somewhere the positioning has to be transformed a lot with all these angles in mind. And it is, as in the industry is getting pushed to the state where you have to realize who are the new decision makers in India, and you have to solve for them.
But this also goes beyond just how health insurance is sort of gearing up for the new India. It's also about how are you interacting with healthcare, which still does not have a regulator, doesn't seem to be regulated in the way that we would like to see the industry. How does that sort of impact your experience? You know, Rakesh, maybe if you would like to come in here. That's one piece of reform that I think the industry is asking for, if I'm not mistaken.
See, that's the biggest and the trickiest, for 2-3 reasons. The first, obviously, when you talk about healthcare, it's like an emergency, and often you see, the architecture of the insurance is built upon that you pay for something which is getting provided or done by others. Like in motor insurance, is the garage who will be responsible for doing something, but you pay for that claim. In the same way, the hospital is responsible for doing what it does, you pay for the claim. Often I have seen people missing the big point is that the insurance company is not generating or adjudicating the claim. It's also following the same trends, the way the claims are coming to them. The second thing is, if you really see, the onus on insurance company is also to protect all the policyholders. It's not just about a policyholder. We ultimately run a policyholder fund. If you see by regulations also, the primary right on the insurance company's resource is for all policyholders. Now, all policyholders means you also have two dimensions for them. One, an optimal premium, and two, a claim settlement, a reasonable claim settlement in a reasonable period of time. The problem with premiums has never been there, and as everybody keeps on talking, You know, it's a very competitive industry. You get the best of the premiums and give it to the customer. When it comes to the claim, the insurance company is not responsible. It's the hospitals. If you see the hospitals, and I can draw an analogy today, you know, the variance. You know, when we say of grievances, we are predominantly talking about the grievances which we see in the retail individual policies. And that is about 3 to 4% of the population who buys that. About 40 to 50% of the population is getting covered in the Ayushman policy. In Ayushman policy, there is hardly any grievance. Well, now why? These are all below poverty line. These are all because the structure of the policy is you have 500 to 1,000 illnesses. Everything has got codified. Protocols have been laid down. Packaged. The hospitals agree on a rate and a price. Insurance company agrees to make it biometric and, you know, almost intervention free. And everything follows like a process. Now, this is the beauty of a digital environment. This is where India needs to really reach or take all its products. Now, when it comes to retail products, the same Ayushman architecture today doesn't exist. The same hospital which gives that architecture to a set of customers in a set of policy doesn't want to give in the next set of policy. And how do you standardize experience? Now, this is where I guess the big debate now needs to precipitate. How can we be more protocol oriented? I'm not saying everybody should be given every same thing, nor can we live with this kind of a variance. When we talk 40,000 hospitals and maybe hundreds and thousands of clinics, talk about OPD, I don't know what, we'll go into millions. How do you handle a health crisis for an individual if your architecture is so varied?
Yeah, absolutely.
This is where I guess the classic dilemma lies.
Got it. Would you like to come in and give your 2 bits?
I'll just continue what Rakesh said. See, I mean, there is a problem between the insurers and hospitals. All of us know about it. I think it has to reach a point where it gets resolved. I think we need to reach that. I think we are in that situation at this point of time. See, what we need is forget insurance. If insurance is not necessary, I mean, people can live without insurance if they have money. If the cost of healthcare goes up like this, will the system survive after a few years? I think that's the biggest problem. There is no standardization of rates. There's no standardization of protocols. I can charge any rate I want. So that is not a workable model. So what we are saying is, that's the concept of the common empanelment the industry has started. Surprisingly, we see a lot of interest from many hospitals, but there's still some providers who are not very happy about it, and it's leading to a lot of other issues. I think the logic of common empanelment is we want standardization of rates so that there is clarity as to what will be the line of treatment and how many days I'll have to stay in a hospital, how much I will incur. This is not only for the insurer, it's for the customers also. So I think this has to happen. Till then, these kind of pinpricks in the whole claim process will continue. I think we all need to resolve this.
Sure. Okay. Satish, I'm going to come to you now. And my question is that, how does, what all needs to happen beyond the GST for demand to pick up? Because if you look at the life insurance industry, the protection gap is still very huge. And when you look at, a basic metric, a basic hygiene metric called the persistency ratio, that still sort of remains to be very low after 5 years. So customers are sort of, ditching their plans after 5 years. And you just mentioned it's a long-term product, right? So what are the things beyond GST that the industry needs to sort of take forward?
No, before that, just a clarification. The persistency that you mentioned, I think it's industry as a whole. But if you look at the protection space, there the persistency is much better.
Okay.
So it's a kind of a little bit of a conscious buy. In fact, if you remember in our earlier avatar as Gone Live, the whole introduction of term plan and those things, on those products, especially the policies that we sold between the initial 5 to 6 years, we currently, and this is more a reducing balance method, more than 97% of the people renew their policies on a continuous basis. Right? That's a different kind of a challenge for us in terms of, because you factor it in your pricing and those kind of things. But it continuously stays. And that's one area where our effort in terms of chasing for renewals is near zero. So protection business, which specifically term plans, which people have bought, there the persistency is pretty good. So if I look at my own book and a straight line method, so people who bought policies, say 5 years back, close to 78, 90% or 78 to 80% of the people are sticking around, even at the 61st month. That's true for other than term products, where, for example, if you look at the unit link plan, the lock-in period gets over at the end of the 5th year, and then there is naturally an exodus, especially if the market has done pretty well. So it's also a factor on those lines. So when you look at term plans separately, it works. And coming back, what do we need to do more? I think it's creating that awareness around it. So 2 pieces. One is I agree with the health space, saying more than the time that I spend, not just on designing the product and the benefits for the customer on the pricing side of it, a lot of time is actually going on ensuring that the onboarding process can weed out the frauds. Right? The moment I try to make my process easier, I don't know, without any marketing, how do people get to know about it? They come first. Right? Okay. So dead man getting insured, or deathbed case getting insured, or basically you are in a terminal illness case and then you want a life insurance policy, and that comes to, right? So life insurance policy is not for a deathbed case. Right? It's basically when you buy it when a healthy state. It's a risk mitigation product. It's not about a certain instance. That's one piece in terms of how do I ensure that frauds can be weeded out in a much better way. I normally give this analogy saying when you're going to an airport, right, we actually have to screen everybody. You will hardly, the instance of somebody with a wrong intention will be in a fraction, right? But still you have to screen everybody. In a life insurance case also, especially on a term plan where the multiple on protection is pretty high, you also do that. And that process is also one of the hindrance for the customer to actually take 4 or 5 days to buy a policy, right? So that's one area. If we can have a much embedded ecosystem, which one of the records would be the health records. If that comes in, I think that will be a big savior. And 2, I think it's basically awareness in terms of necessity and urgency to have a life insurance policy.
Do you think awareness alone can bridge the protection gap? Because it's actually the problem is of underinsurance, right?
Yeah.
I'm buying a term plan, but I'm buying, like a paltry sum. I'm not sort of looking at my income and then buying a term plan accordingly.
No, that's where, see again, people need to understand that life insurance is an expense. It's a risk mitigation, especially the term protection. It's not an investment product. So, and you need to have it till the time, as Shini has also said, right? If you have the money, you don't need life insurance. Right? So ideally the approach should be, I start creating a corpus for myself. Until the time that corpus is pretty big, I have a life insurance product to cover that. So the ideal solution is when I'm young, I buy a policy, which should take care of my, say, 15 to 20 times of my current income. But it's not that I need to continuously keep on upgrading it all the way till age 60, 70.
Sure.
So my process would be that in parallel, I will start creating a corpus which should take care of that increased cover that is required rather than doing this. But till the age of 40, 45, 50, because beyond that, the pricing is pretty high. So you should kind of top up that space. That also comes through. So for quite a few policy of ours to whom we had sold policy, they have come back and topped up their premium. So that happens. Say any life event happens. Like for example, I'm a parent now, right? I have upgraded. Or basically my income has now increased multifolds. So I have upgraded. So that also happens. So the very first introduction is more important. I think if that happens, protection gap can be solved easily.
Okay, great. Okay, I think we're running out of time. We're almost at the end of the discussion and we're also at the end of the year. And it's customary to ask, what are the big changes? And we also have the insurance bill that will be, tabled anytime now. And there are interesting conversations around that about, increasing the FDI to 100%, having an open architecture and distribution, having a composite license. So taking from all of that, there's one question to each one of you, and we'll start with Rakesh this time. The question is that, what are the big headline events of 2025 that will shape the next year?
So first, I think the follow-on of the GST, I think what we saw at the end of the year, I trust that will lead to a consumption boom. Of course, in the month of November, which we just went by, we clearly see the industry growing much higher, much better. Health has grown almost 35% 35-40%. Motor is also growing behind, the cars getting more affordable. And I expect this trend to continue. I guess the FDI thing, if it opens up, brings in more capital. For sure, this is a capital-intensive business. The forward-looking regulations, likely around IFRS as well as risk-based capital will necessitate the need for having a good capital and solvency. Even listing the company is an access to capital in my way. So I think all these norms, along with the fact that consumer centricity and claims handling, and I think in particular the health claims, I guess the common empanelment which the insurance industry is propagating for the larger good of the consumer and giving a good service, reducing, the back and forth, that will fall in place along with Bima Sugam.
Okay, great. Satish, just keep the answer very brief because we're almost
I think the headline event has been GST, and hopefully it helps us. Basically, it did help create that awareness, a big boost to that space. It's on us to kind of carry it forward and maximize the demand on those lines. The second, of course, whatever can come in by 2026 is going to be the composite license. Naturally, competition will increase. But I strongly believe life and health, they actually complement each other, right? So they will also get into life for sure. But that's something which basically can bring in a lot of innovation, where you can actually club those products and create some new equations. So it's still nascent, but I think that opens up a lot of space.
Okay, but good luck handling so many claims.
And hopefully this all for us before we enter that.
Animation.
So we are sharing the headline which 25 will carry. So you're outsourcing your job to us. Like we need to give the headline. So I think I'll give two. Like I think it's covered by Rakesh and Satish, but at a larger level, I'll give two. One is healthcare inflation is a national issue. I think that's one thing. It's not just an insurance issue. I think that's one thing which we have to deliberate more on. Second, a very quirky one, and which is slightly, obviously not relevant to 25, but I think, see, health insurance is not a voucher, it's a hack and needs a narrative. I don't want it to be misleading. See, from a regular user point of view, it's very tough to budget for any healthcare disruption in my financials, right? So health insurance, like what Rakesh mentioned, right? There can be a volatile situation or a very disproportionate situation financially that can happen. And how will you budget for that? It's very tough to kind of save money to budget for a very disruptive situation, right? So health insurance comes as a hack, which is way more predictable. You know the finite amount, you can save for it. And then you can cover for something which is very disproportionate in terms of financial risk, right? So in a modern language, it's a hack, it's not a voucher. People should not buy it as like something which they need to redeem, right? So that's a very different take. And I think it's pending to kind of, to make people aware about in this form factor versus like a voucher. So that's one. But other than that, I think the major one is healthcare inflation is a national issue, has to be solved at a larger level.
Sure. So,
GST, the insurance bill, which is still not tabled. I don't know where it's tabled by now. Third is the common empanelment exercise the council has embarked, if it is successful. Finally, if you don't mistake me, the emergence of Galaxy Health Insurance.
Okay, with that, we'll let the audience ask questions. Please identify yourself and keep the question brief. Do we have any questions? Okay, great.
Either the topics were very boring or we explained everything.
I think we explained everything. I would go with that. Okay, thank you so much.
Thank you, Deepti. Even I'd go with the latter because that was very lucid, the way all the answers you managed to extract from our speakers. First up, I'm going to request you all to come together for a group photograph. We'll do that. And that being said, I'll also be requesting Deepti to please present a token of gratitude to all of our speakers as well for joining us this morning. Well, with the insurance industry standing at a reset moment, going leaner, cleaner, we also decided to go greener. So with that, thank you so much again, Deepti. With that, let's march ahead. We're about to set the stage now. And this time, we're priming up our summit for a very interesting fireside chat, again on a very befitting theme as we look at markets at a turning point. Now, one thing that we do know is that it's a tale of two realities. Global turbulence meeting local optimism. So what's the market's next move? Let's get to find that out from a very befitting leader of our industry who's about to join us in just a couple of minutes. That being said, ladies and gentlemen, I'd also like to urge you all to continue being seated as we move forward to our next round of discussion. Now, this is aptly called a fireside chat because it's a feisty topic coming your way, which is all about global headwinds and domestic euphoria, what really gives. So let's get to understand a little more by getting both of our speakers here. Of course, we're going to do that in a minute. Meanwhile, for those who still haven't filled up this survey, the tent cards are staring at you. So go ahead, give it a quick scan, and please do fill in your priorities when it comes to the budget for 2026. What is it that you're looking forward to? So go ahead and scan the QR code, be part of the survey. At the same time, get to build those connections right over here and across by utilizing our AI-powered initiative right here at the summit. We do have a tent card for that as well. Very easy and very quick steps available for all of you to make the most. All right, thank you for obliging with us. We were also sort of working on the aesthetics for our camera right here, because that's also very important to spearhead the conversation. But that being said, ladies and gentlemen, without any further delay, let's actually get this fireside chat started. All right, so on that note, first up, ladies and gentlemen, while to spearhead the fireside chat, we have with us Surinder Tirumurthy, who's the consulting editor with Mint, and Surinder will be spearheading the fireside chat. But this afternoon, we have a veteran investor whose 3-decade journey from research desks to running one of India's most respected boutique investment firms truly exemplifies mastery, vision, and conviction. We have with us Madhusudan Kela, founder of Invexa Capital, who will be part of the discussion. We're really delighted to have him here. So with that, let me go ahead and invite Mr. Madhusudan Kela, and I'd also like to invite Surinder Tirumurthy to spearhead the session. It's a fireside chat. Can we have a feisty round of applause, everyone? Because we're loving the insights flowing in from this side of the hall. Let's keep that coming. And with that, Surinder, over to you.
Thank you, Mr. Kela, for joining us today. Well, I would call Mr. Kela the quintessential stock market investor. These are the kind of people, on one hand, they will tell you that they are learning, they're the students of the market every moment. On the other, they would be betting their shirts off in the market. They would sort of make very risky calls and good investments that you will see benefits over a long period of time. So I'm going to give a very short intro of Mr. Kela because I guess that people want to hear what he's got to say about the markets at this point of time. So a short introduction is that
in a very short time, Mr. Kela was the Chief Investment Officer of Reliance KMK Ventures, which is his proprietary firm, and he invests largely in the market and is one of a very, very active investor today in the market. So that's Mr. Kela for you, but I'm going to really start off because there are several questions about the market at this point of time. So the first being that in the last quarter century, I mean, everybody has been saying that India is a growth story, and that's a very constant statement that comes. Let's keep that aside for a moment. Can you tell us which were the years in these 25 years that has been the best in terms of making returns in the market? And why was that so? And how does the market currently look in terms of what you can expect out of it in the next 2 or 3 years?
First of all, thank you so much for having me. Appreciate it. It's a pleasure interacting with you. So, I would say that I would like to break this question into 2 parts. One is the broad markets as a whole, and the second are individual sectors which have done really, really well within the broad markets. So if I look back my own journey since 1991 till today, I would have come across many, many large themes which have done well. And there are periods in which they have done. Let's say, for instance, between 2009 and 2014, markets were in a terrible condition, but the market cap of pharmaceutical went up from 1 lakh crore to 10 lakh crores in that time, right? From 2002-03, when we really started building Reliance Mutual Fund, the whole market was in favor of economy-related stocks, power, public sector companies, public sector banks, EPC companies, etc. So that theme really, really worked well.
Right.
So I would say, if you are an investor, that is what you're looking for. You're not, and what has rewarded, at least from my perspective, is to stay convinced on the India story and not get perturbed with, 1 or 2 years of return here and there. Because the people who have been stalwarts and who have made money, even like the likes of Rakesh Jhunjhunwala and all, they actually stayed convinced on the market, and that's how they could make the money which they made.
Right. Were there pockets of years in these 25 years when the returns were outsized? Like, for example, when Reliance Capital actually grew in those 5 years between 2003 and 8, were there some outsized returns?
Of course, there were very outsized returns between that period of 2003 and 2008, I would say. And this last 5 years, except the last 12 months, from the COVID crash, if I may call it, and the preceding next 4 or 5 years were really exceptional. So if you want me to single out one period out of these 25 years, then I would say this period was the best. And to just give you a context, at the bottom of COVID low, our market cap was $1.2 trillion. Today it is close to $5 trillion.
Right.
So you have added close to $4 trillion worth of market cap in the last 5-6 years.
Sure. So which means that when you are at this high, does the next 2-3 years look good or tough for the markets in terms of returns? It's already been a not so great 15 months, right?
So, let me say that, market over a period of time will give you average returns. So if you have had an exceptional period of return, reasons will be something or other. Right. But markets will find a reason to take a breather, right? But over a longer period of time, I don't know what will happen in the next 12 or 24, honestly. But over a longer period of time, I would still say equities will continue to be one of the best asset classes to invest in India. Sure. And as we have done maybe 14-15% compounding for the last 25 years, I see no reason for that not to continue even for the next 10-15 years.
Right. Usually outsized returns that we speak of is when you buy a stock or a market at a low cost, or you latch on to an idea at a very early stage. And therefore, you can make those, like for example, in Divi's, you latched on to that idea much before people thought of CDMO, and today it's the second most valued stock in the pharma sector, right? So therefore, if you were to look at the Indian markets, they're not a very cheap story today. And especially if you were to look at the large indices, the index stocks, so as to say in Sensex or in, say, the Nifty, they don't have growth stories that were there in, say, 2003 and 2005, right? And therefore, how would you look at the large indices, and therefore, are those indices actually relevant today to sort of judge the market?
So it's a very relevant question. You know, most people actually mistake ki bazaar kya lagta hai. And when you say bazaar kya lagta hai, you are essentially asking ki Nifty or Sensex ka kya lagta hai. In fact, that is the actual wrong question to ask. Because at the end of the day, what will you do? But if I tell you that Nifty will go up 500 points or it will go down 500 points, unless you are a trader and you are really wanting to make money, you don't benefit out of those kind of moments. But what you truly benefit is what you rightly said, that if you are able to identify a right sector, and within that you are able to identify right companies, then only you make outsized returns. So that is what is true for Indian market. It has always been a bottom-up story. And people who have really made success out of these markets are not the ones who are looking at where the Nifty is going or where the Sensex is going, but the ones where these companies which have tremendous potential, you put disproportionate effort into these companies or these sectors. You identify them early. But more than identifying early, sir, the important thing is that when they go up 100, 200, 300%, do you have done enough research for you to hold on to those stories?
Right.
Otherwise, you will end up selling your winners.
Right.
Like what a typical investor will do, that is gone up 100%, let me book profit.
Right.
And then typically you will end up losing positions which have been loss-making.
Right.
So what is the real relevant thing is that if you have a winner, like what Warren Buffett did, he put 30% of his portfolio in Apple. That's how he made those outsized returns.
Right.
So any large or good investor will like to back the real winner. And those winners are few in life. So when you get them, you have to really back them.
So when somebody says that the Nifty is going to be at 50,000 or the Sensex is going to be at 1 lakh, are these just statements that to capture imagination, or do they really mean something?
Sir, 1 lakh bhi hoga, 2 lakh bhi hoga. ये कब होगा ये मुझे नहीं मालूम है. But ये तो India का जो growth story है. See, if your earnings are going to grow 15-16%,
right.
Sensex is a derivative of your earning growth.
Right.
And it has to rise. I remember I gave an interview way back in 2003 when the index was like 3,000, and the journalist asked me, "ये 30,000 होगा क्या?" You can go back, and I said 30,000 भी होगा और 1 लाख भी होगा. ये कब होगा ये मुझे मालूम नहीं है.
Sure.
So I can tell you that ये 1 lakh भी होगा और 2 lakh भी होगा. It is not an imagination. In a country like India which is growing,
right.
these numbers will happen. The question is that we don't know whether it will happen in next 6 years or 8 years or it will take longer.
Right. So one more question on the broad market theme only. That see the IT stocks in the last 25 years has really carried a lot of weight in the index. And they are at the lowest ebb right now. We don't know whether it's the low ebb also. So do you think that they will still continue to play a big role in the index stocks?
They have a weight in the index, but if you look at the composition of Nifty changes, so if I take last 25 years back, if there were 50 companies in Nifty 25 years back, only 17 of them are there today in Nifty.
Right.
And at one point of time, you would have not imagined what kind of companies will go really out for what reason.
Right.
So obviously next 10 years or next 10, 15 years, the Nifty composition will be very different.
Right.
Maybe the IT companies will be there, maybe the composition will change.
Right.
Maybe the nature of those IT companies will change. Today you can say that Policymakers is also an IT company.
Right.
Or, Paytm is also an IT company.
Right.
We don't know whether the traditional IT companies will dominate the markets or some of the new age companies will come and dominate the markets.
Sure. So another story that's been playing out despite, I'll come back to the broader theme of this poor FI interest, weak rupee, but one of the star highlights of this market has been that public issuances in the market. There has been issuances about 5 lakh odd crores that has come in this calendar year, right? And this is actually new capital raised from the market. Is it just transfer of wealth? Is it new money? How do you, as someone who's been investing in this market, see this phenomena of capital raised by companies?
So, in my opinion, this is the most significant thing which has happened in the market in the last 25 years. That markets have absorbed 5 lakh crore rupees of issuance, out of which 3 lakh crore rupees is actually the IPO, the QIPs, the preference issues, and this is the money which has gone into the companies. And roughly 2 lakh crore rupees is gone out of the market, which is basically the private equity firms have sold, and roughly 1,20,000 crore rupees is sold by the promoters itself.
Right.
I can tell you, 5 years back, we were saying 30, 40, 50,000 crore rupees raise will be a lot of raise. So this is kind of a new era for India. On one hand, that market can absorb 5 lakh crore rupees and can give 3 lakh crore rupees of growth capital. So if the companies have raised money, clearly the money has gone into the market. And in one way, even when the promoters raise money, directly or indirectly, it will come back to companies or in one form or the other. So markets have come a long age, and this is like the retail participation. The likes of my friends are sitting here, Nilesh Bhai, Sandeep. They are the ones who are enabling such large absorptions of equity in the market. It is happening indirectly through mutual funds, but by retail investors only.
Sure. So one allied question is that there's been a complaint that...
And I want to add, one of the reasons why we are seeing actually sluggish return in the last at least 12 to 15 months is because of this large scale issuance of primary paper on this kind of liquidity coming by way of promoter selling and by way of private equity selling.
Right.
Because that money which could have otherwise gone into the secondary market is getting more or less absorbed by the primary market itself.
Right.
And that is why, contrary to what people believe, that there is a bull market going on, there is a actually meaningful correction which is happening in the broader market, specifically in small cap and mid cap companies, which have really corrected. I was just looking at the list. There are more than at least 100 companies which are down more than 40% in last 1 year.
Right. I mean, you took away another question of mine, but I'm still going to ask you that. But before that, in this whole public issuance that has happened, there's a debate whether the OFS part of the issuance, where promoters are taking away the money and this meaningful money is not coming to the companies. I mean, it's correct that promoters want a sort of return for the investments and hard work that they've done, but also they could get capital into their companies when you have a growth story going forward. And there has been debate on this. The regulators have been saying that, oh, this is not the right way to do it. So what do you think about it?
To be honest with you, what is the value of my opinion on subject like this, sir? It's an open market. Anyone can buy and sell. And what is being done is legally. Even if I say right or wrong, it actually doesn't matter. And I would say promoter wants to sell, but investors have to keep their eyes and ears open as to what they're buying.
Right.
And to some extent, I must say, since I have come from a mutual fund industry, mutual funds in India, at least in the primary issuance, in my opinion, are doing a tremendous job of making sure that some of these valuations are kept under check. You know, they are actually, and that is indirectly kind of benefiting the smaller investors only. If you see the latest issuance, like the Grow IPO happened, I am sure the pricing, maybe mutual funds had a lot of role to play. And there again, if you look at the regulator stand, that some portion of issuance have to be done to the local mutual fund. So actually you can't get away in any issue, any primary issue, unless you end up having some of the mutual funds by your side. So this is actually a very, very good check from a primary market perspective that mutual funds are keeping a very close tab on valuations and ensuring that they don't end up paying berserk valuation and berserk pricing, which is very, very good from a retail small investor perspective.
Right. But as an investor who looks at smaller companies, what would you think of a promoter who sort of takes the most money as OFS? I mean, would you have any advice to him in this sort of a market? Because you see that India has got a growth story, and therefore the company needs a lot more money. Is there an...
Sir, I think if the company needs a lot of money and the promoter is taking money, I will not touch it, honestly. But yes, if the company doesn't need money and the issue is done at a very attractive level, wherein the promoters are ethical and they are doing it in a very transparent manner, then it doesn't matter to me.
Sure.
Who is selling? Sir, हम लोगों का जो philosophy है ना, and I will say it in Hindi.
Yeah, sure.
My guru was Rakesh Junjunwala, and he taught us one thing: लड़की खूबसूरत है ना, तो ब्याने वाले बहुत आ जाएंगे. So we don't ever bother about who's selling or who's buying. We only bother about what companies in which we are investing. Do those companies have fundamental? Do they have returns? Do they have growth? As long as they have growth, I don't care who's selling.
You just said about, a lot of small cap and mid cap stocks actually not performing well. But if you look at the November data, still, small caps and mid caps almost got 6,000 crores of net mutual fund money, which is after a substantial portion have been sort of sold off in those mutual funds by the same investor, almost half that, and this is more than large cap and large cap stocks. That's what the statistics show. So on the one hand, you say that these stocks are coming down. Does it show a sign of confusion? Does it show a sign of...
No, sir, this is a tremendous sign of clarity. And it is a sign that the industry and the whole ecosystem is evolving. And I would say to the extent that they are doing the right things. Because if there is this kind of correction, then this is the best time to put money in companies and stocks which have corrected. Right? So if there are so many companies which have fallen 50% from the peak of last 1 and 2 years, there will be value somewhere or the other. Right? And this is the time to invest money. So I would say most people often say that the retail investors in India have not become smart enough. I would say they have become really smart. They are the one who have made maximum amount of money. The retail guys who have stayed invested. Like the fund which we used to manage, the 10 rupee Reliance Growth Fund is now 4,000 rupees. Just imagine a guy who just done nothing and just has stayed invested. Where in the world can you make 400 times return, even in 25-year time frame? Right? So my point is that money coming into small and mid-cap funds is a sign of maturity and smartness, and is not a sign of any confusion.
So, you were a part of a large regulated entity in the early stages of your career, right? And it came with a lot of rules. And earlier we had the SEBI chairman here. But now you're operating on your own. So what are the advantages and disadvantages of not being in a large system and being out there, being able to... Are there some advantages of actually looking at not taking say you can go up to 10% in a company just overnight. So are there advantages, are there disadvantages, and how do you navigate that?
First of all, sir, regulation has to be adhered in spirit. So whether I'm representing a large organization and I'm representing as an individual, I'm still regulated. You know, and I still have to operate within the broad boundaries of whether a mutual fund operates or we operate. I don't think there is any change in the spirit of our participation in the market. The other thing is, you know, the large setup has its own big advantages, that we have large resources, we have large access to people, we have large capital to play for. That is its own advantage. But see, my journey, I have enjoyed the markets, whatever format they were. So I enjoyed that part of the journey. That has its own advantage. Today I'm a free man. I can invest today. You know, I don't have to answer anyone except my wife, who rarely asks me any question. I am not answerable to anyone that whether I am holding some share for 1 year, it did not give me any return. And we are able to buy any cap stocks. We don't have restriction. I can go and invest in a 200 crore market cap company also, and I can go and invest in a 20 lakh crore market cap company also. Right. It's a free way of operating, but to be honest with you, I have enjoyed that instinct as much as I'm enjoying this one.
Sure. So today is a day of where celebrities interview celebrities, you know, in the sense that, and they post it all over social media. And most of the investors also look at that. So how much time do you spend in social media watching these interviews, or how much time do you spend on, say, Twitter or any other forum to sort of get information, to know trends?
Honestly, not much. It comes a lot of, I have a decent team, so they keep track of it. So whatever comes to me in a very curated format, I do it. But I personally love to watch podcasts because they are a good medium and they are very, very relevant. So some of the podcasts, it will take 1 hour. So whenever I am traveling, I listen to some of these podcasts which are highly recommended by my team, and I enjoy that.
Right. So you said that, I mean, of course, Mr. Jhunjhunwala you said that he was your sort of guru. So where do you, what is the best thing that you learned from him?
So I think just to say that he was my guru is understatement. I would say he was my friend, philosopher, guide, and someone who really taught me the difference between income and wealth. So if I have to single out one thing, before I met with him in 1998, 1999, I was a happy man, maybe making 3 times more money than any of my college mates were making, and I was very happy, right? But after I came in contact with him is when I discovered that this is not about making income, but this is about actually generating as much wealth as you can desire, right? So that is one fundamental change. And second thing, you know, he taught us how to fish and never ask for a fish. So we had completely different portfolios. I have my completely different portfolio than what he had. Hardly 10-20% in common. But he always encouraged that, and he always used to tell me that, you know, the only thing which I love about you, that you have your own independent thinking. Right? So we have learned all of these things, and today I proudly say, sir, that, and I tell it to all the younger generation, that I want to be a better version of Madhu Kela every day, rather than copying anyone.
Right.
You know, I think if I can just keep on improving my own self, I am sure I will reach somewhere.
Right.
But if I keep copying A, B, C, D, let's say I literally copied Warren Buffett, neither I will ever become Warren Buffett, nor I will remain Madhu Kela.
One of the strong points about your Reliance Capital journey was that you were able to assemble a great team of people, and several of whom are still there in Nippon. And I guess that some of them work with you also. So if you were to do it today, would that be possible, or is it very tough to create that sort of a team in this market?
So that was one of my biggest pride. And I would say that, often people give disproportionate credit to individuals. But it was not any individuals who won in Reliance. It was actually the team which won, right? It was the team, and we literally used to work like a family. All departments, we work like a family. And I'm so happy and proud that a lot of the good work which was initiated by us at that point of time still is carrying on in Nippon. And a lot of people who left Nippon have also doing really, really well. So I am very sure that we ended up doing something nice. So today, what I feel that, is it possible to assemble a team like that? It is possible. But in the younger generation, sir, people have become a little impatient. They want quick returns, quick results. In our team, we had a lot of patience. We stuck to each other for 15 years. Not a small time frame. Right. And some of them are still there. In the younger generation, this is the problem which I see, that they are very impatient. And they want very quick results.
Let's leave out Divi's for a moment. Apart from Divi's, what do you think would rank as an outlier idea that you discovered in the market?
So first of all, I don't talk about individual companies, but and that's a disclaimer that we are only talking it for educational purposes.
Right.
In my life, Divi's has been I think, if I may say, it's a crown jewel. And not because of the money which we made, but because of the person we discovered, because of the business we discovered very, very early on. Like, one of the very few companies which has not visited capital market after its listing, and maybe giving 5 times more dividend than what the company was listed, the whole market cap was. So it got listed at 140 crore market cap. They may end up giving 800,000 crore dividend in a year. So it was different company, but we have had many, many winners, sir, in life, and some of them have been, my recent big win is Wari, in which I invested. We invested in liquor sector. So we bought roughly 8-10% of Radico Khaitan at a few hundred crore market cap. Today it is a 45,000 crore market cap company. Right. So we have had many stocks which have given good returns.
One more on a stock idea, that which you thought was a great idea and you worked on it for a long time, but you never made money out of it.
Oh, sir, I have to write a book on that. I can't answer that question in 1 minute. So we have had our own share of hits, but we have of course had many misses in the, and most of those misses were because, I thought those stocks were expensive. And this is one of the things which I now tell people, that, you should always have a very open mind in evaluating company. If you're only looking at one single track, that I want to buy companies which are below 10p or below 15p, then you may end up missing a very large portion of the market. Companies have different parameters to evaluate. So one of my true regrets is not participating in HDFC Bank. We evaluated many times, right, even for personal investment, and HDFC Bank made such tremendous success and tremendous return for investors, but somehow could never participate wholeheartedly.
Okay. Thank you. I think I've hogged all the time. There's some few more seconds for people to ask questions. So, yeah, go ahead, Justin.
Sir, what's your take on crypto? Do you hold any crypto? And, as an investor, we would like to hear from you on your views about investing in crypto.
So I think this is like they said, grapes are sour. So I must honestly, candidly admit that I have not invested in crypto. If you ask me, this is the thing which I was telling him. We should have definitely evaluated it. Forget after evaluation, if we did not participate, that was fine. But we did not even evaluate. हमको लगा ये क्या पता coin का क्या value होगा. The fact is that it has become billions of dollars of industry. So even though we did not make money, but there is a lesson that you should not like completely give away any asset class which comes in front of you. Hopefully, in future, we'll be more watchful.
We have time for exactly one more question. Yes, please.
Following up on the question regarding the misses in your portfolio, the stocks that didn't end up working out. Sure, you don't want to exit the position too quickly. You don't want to have any sort of seller's remorse. But at what point do you acknowledge that, okay, there's some information that you've missed out on, and you exit, like you acknowledge that you've made a mistake in evaluating the stock and exit the position?
I think we are now more quicker than what we used to be in the past. So whenever I think your thesis gets broken, and when you realize that you invested in a particular company based on certain thesis, either about the industry or about the company financials or about the promoter or about the broad environment. And if you think that thesis itself is broken, then I don't care how much is the loss or profit, I'll get out. And one thing which we have changed, wherever we have a situation like this, we first square off our position and then we calculate how much we lost. Because if you keep looking at your losses, you will never be able to take that decision.
Thank you.
Yeah, thank you.
Thank you so much. Very
Lots of
nice
good
interacting with you.
insights, yeah.
Thank you so much. Thank you.
Thank you very much. Can we have a round of applause one more time for that candid yet an insightful session? And Madhusudan, I'm going to request you to please remain on stage for a minute because I'd like to also request Surinder to please present a token of gratitude to Mr. Madhusudan Kela. And we also enjoy the interaction that we have received from the members of the audience. We'll keep that interaction on for all of our sessions. We'll keep those questions coming in as well. It was wonderful to hear it from the veteran investor himself. Thank you once again for joining us. And with that, let's now quickly set the stage for our next session. And again, a very interesting topic coming your way because it's all about the big question around mutual funds. Are they market drivers or mere riders? Now, we all know that mutual funds sit at the heart of India's investing boom. But the big question is, are they true market movers? Or for that matter, are they just passengers in a larger cycle? We all understand that in a market that's been powered by sentiment and by speed, it's also time to ask if mutual funds will be the engine or the echo. So with that, looks like we're all geared up for this session. And let's also find out if mutual funds still have that kind of muscle to move markets. And let's do that by inviting our speakers on stage really quick. Now, this particular session will be spearheaded by Jash Kriplani, Senior Assistant Editor, Mint. So Jash will be extracting all the relevant insights for us all around this incredible topic. And we'll continue getting those insights coming your way. Meanwhile, I'd also like to urge our members of the audience to continue participating, sharing your thoughts across social media. And if you do that, don't forget to use the hashtag MintBFSI Conclave. You can also go ahead and tag us at @LiveMint, but don't forget to use the hashtag MintBFSI Conclave. And with that, looks like the stage is set. So first up, let me please invite our session moderator, Jash Kriplani, Senior Assistant Editor, Mint. So Jash, let's have you on stage so that you and we can welcome your panelists. That being said, let me go ahead and invite our esteemed speakers for the session. We have with us DP Singh, Deputy Managing Director and Joint Chief Executive Officer, SBI Mutual Fund. So if I could please invite you to please join on the stage. I further please invite Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company, and Sandeep Sikka, Executive Director and CEO, Nippon Life India Asset Management and Chairman AMFI. And on that incredible note, Josh, over to you.
Check, mic check. So we have all industry veterans here. Without wasting much time, we'll just get into it. We had Mr. Madhusudan Kela ji who spoke a lot about markets, and probably they took a couple of my questions. So but I'll still ask them. So first off, sir, we have seen, we'll start with you, DP sir. We have seen, we used to see markets swing a lot when FIs used to sell. But now we are not seeing that much volatility in markets despite, a lot of selling happening in FIs in 2025 as well. Is it because of, now DIIs, domestic participants like mutual funds are playing a bigger role, and is that a reality now?
I think both are the correct statements. Yes, FIs seem to be selling stocks, but at the same time they have been putting money in other categories, like they are coming into IPOs, they are coming into other asset classes. But yes, the retail money, which is coming almost 30,000 crore, the SIP book, of which is coming every month, is definitely a balancer. And see, that's the reason that we are not seeing the kind of volatility which we would have seen otherwise. But yes, but I rightly put in my view, Mr. Kela has already talked about what are the basic rules, and when the money is coming in, there are enough stocks where we can still create a lot of wealth for the investors.
Right. And Nilesh sir, would you like to add something to this?
I just want to thank FPIs. They are selling. That's why we are able to buy.
Sandeep sir, like to add?
Yeah, I'll just add, when we were invited to the dais, the question, it was mentioned, do the mutual funds still have the muscle to fire the markets? I do not know about whether they fire the markets, but the mutual funds have the muscle to create wealth for investors, and we'll continue doing that. I think this FI selling is just basically, I think these are signs many times, with their timings. For them, it's good. Indians are investing in the India growth story. For them, India is a stock. They'll keep looking at different markets. But I'll say, there cannot be a better time to be in India, where the Indian growth story is fueled by domestic household saving.
Right. And sir, also, how are you, maybe we'll start with you, Sandeep, how are you seeing the mutual fund penetration in smaller towns and cities? Are you seeing more, households in the smaller towns and B30 towns getting into mutual funds now?
It's a very interesting today. I think recently we celebrated 30 years of AMFI. And I think one of the biggest achievements for the mutual fund industry, and I thank all the mutual funds, all the veterans of mutual fund, many of them who have retired at this point of time. I think the hard work done by them, over the years. Today, I think we can proudly say 100% districts of India have mutual fund investors. 99.9% of pin codes of India have mutual fund investors. Now, I think just look at this, just what happened about 10, 12 years back. SEBI had to nudge the industry where something like B30 was created. Today, it's a matter of, we feel proud that the B30 has moved to almost B300. I think we are in so many small cities and towns. And I would request and urge each one of you to go, if you to Google, nowadays I think with Chapity and Google, life is very easy. Just go to the Google Trends and check up, search mutual funds. You'll be pleasantly surprised to see the word mutual fund is being searched for smaller cities more than the bigger cities. Now that is how things have changed. So, and I think from our point of view, the best thing that could have happened was that mutual fund growth is happening faster in smaller cities and towns. And the beauty is, even more, their confidence in mutual fund, many times when I look at, I think we are a very big retail mutual fund. The stickiness of assets coming from smaller cities and towns is much better compared to bigger cities. Many times because they want to participate in the India growth story, but they're not trying to time the market. So I think it's a phenomenal change that has happened, and it is a hockey stick. Directionally, we are moving in the right direction. Have we achieved that? The ultimate answer is no. But today, again, I would like to say 100% districts of India, 99% of pin codes of India, would not have been possible, unless central mutual fund would have penetrated in small cities and towns.
And Nilesh sir, would you like to add about this? And how are, you travel a lot, all of you all travel a lot. What kind of, interactions you have with investors in smaller cities? How are they, receiving mutual funds? If you can add a bit.
So एक मिर्जा गालिब का शेर है, हजारों ख्वाहिशें ऐसी कि हर ख्वाहिश पे दम निकले, बहुत निकले मेरे अरमा फिर भी कम निकले. तो जो संदीप भाई ने बताया कि we have done well, but when we look at the potential, we have barely scratched the surface. Today we have about 5 crore plus investors. we should be at 50 crore. Today, we are present in every district and every pin code, but we need to be present far more so that every Indian is financially secured. And industry, under the guidance of regulator, is doing a reasonably good job. But as I mentioned, बहुत निकले मेरे अरमा फिर भी कम निकले. We still have a long journey.
Would you agree, DP sir? Or you have any other take on this?
Can I afford not to agree with Nilesh bhai? It cannot be done. Yeah. So he's always right. And but yes, what you are saying is absolutely right. We have done a great job. We have reached out every nook and corner of the country. And mutual funds is no more a push product, it's a pull product now. And as Sandeep rightly said, people are watching for this. But one thing I've said, more and more people coming into mutual fund fold, the responsibility and accountability of industry is growing every day. Because we are responsible to all those small investors who are putting money. And as was said, when mid caps, small caps are correcting, why we are still getting. We are getting money because the people have signed up for this SIPs in the mid caps and small caps. And that is our responsibility, how to handle that money in a more responsible manner. And the best thing which has happened in India is that most of the money put in by the smaller investor is coming through mutual fund routes, and they are in safe hands. That's I think is a blessing for all the small investors.
Nilesh bhai, I wanted to ask you, now mutual fund industry is at rupees 80 trillion. Recently there was, SEBI proposal about, cutting brokerage costs. So do you expect now mutual funds will get cheaper and that would further drive penetration?
So undoubtedly mutual fund is industry where interest of all the three participants are in equilibrium. As a manufacturer, I don't do any charity. I charge my fees. As distributor, they are also well rewarded. And investor also is well rewarded. There are industries where investors benefit disproportionately higher than manufacturer and distributor. And there are industry where manufacturer and distributor gets disproportionately benefited compared to investors. At least we have ensured there is equilibrium thanks to our regulator. And as Madhubhai mentioned, we have to follow regulations not only in letter but also in spirit. And as mutual fund industry will abide by what SEBI says, the best part about SEBI is that their doors are always open for discussion. And including on the new circular, they have heard us out. Now, after hearing us out, whatever they say, happy to execute.
But sir, historically, we have seen that, there has been, mutual funds have become cheaper as and when the industry size has grown. So going forward, you see that not maybe immediately or maybe at some point in future, we could see another, cutting of expenses.
I mean, there are index fund operating at 2 paisa. Usme cut nahi hoga, baki mein hota rahega.
Sir, would you like to add anything?
I would like to, I'll again, Nilesh bhai mentioned, it's a SEBI consultation paper, and by virtue of being a consultation paper, I think we are blessed to have a regulator which is very open, which hears views from all stakeholders. And right now also we do not know what will come. But I'd like to also highlight the fact, many times whenever a consultation paper comes, some new regulation comes, we have a lot of ambiguity in our mind. And typically it is seen with a little bit of a negative thing. But you go back to history, you go back, every regulation that SEBI has changed has been in the interest of the investor and has helped the industry grow. I think we would like to also see this, whatever has been done in this consultation paper is with the interest to keep, is with the intent of keeping the investor in the center, making the whole thing more transparent, making it more accessible. And I think from your point of view, I mean, the question, will the industry grow because of it is, the expenses are reduced? I will not like to put it there's a direct correlation to that. But the idea here is that if the industry is growing, if there's economies of scale coming in, how that can be passed on to the consumer. That is the objective. Because, like Nilesh mentioned, index funds are available at 2 basis points. Logically speaking, then all active money should only go to index fund. It doesn't happen like that. So I think we are very, very excited about the future. But this correlation that if expenses come down, more investors will come in is not right. It is ultimately directly, only thing it is linked to is how much value you can add to the investor. If you are able to create wealth for the investor, I mean that has to be the barometer. If you can continue creating wealth for investors, industry will grow. And the testimony to that is the fact that today we are 80 lakh crores is A, because of very sound regulation. But the second most important thing is mutual fund industry is the only industry which has created so much wealth for investors. I think you name one other industry which has created wealth for so many investors, 5 crore investors. So I think it is the wealth creation for the investor is going to be very, very critical.
Got it. So would you like to add?
No, I think a combination of both. One thing is that the present regulator in India are actually hearing out, they are friendly, they are collaborative, they hear you out and then they come out with the decision. But if I go back into the history, all those regulations which came into being and were being seen as very draconian in nature, but the industry has kept on growing and growing and growing. But yes, these are the headwinds. I think industry is strong enough to handle this. But yes, I absolutely agree with Sandeep that the ultimate, the taste of pudding is in eating, that the investor, ultimate investor should be paying less is very important. So that is something where there are some issues, but overall the schemes things are in order.
Again, something was touched upon in the last panel, but I'll ask, we have seen a lot of IPOs coming in, and we have seen like one recently IPO that came in, which was at steep valuations, and it created a lot of buzz, a lot of mutual funds bought. So how should investors react? Because sometimes there is concern among investor community when, funds buy like a steeply valued, company. So would you like to add, sir? Maybe we can start with DP, sir.
Yeah. No, I think, see, when we are looking at the valuations of a company where mutual fund is investing, or any company where the investment team is working on, we always stay away from the noise. Noise can be manifold, it can be coming from any corner because of vested interests. What we have to do is whether we are able to create value for our unit holders or not, that is most important thing. The valuation, the price discovery criteria is very, very stringent. The analysts, the research team, they do hard work, and I think the whole industry has done a tremendous work in that. So this is always, anybody and everybody can say this is cheaper or this is, but the people who have worked on it, they know the value, they know the story, they have seen the financial, they have met the management, they have seen the growth story into that, and then they do it. And we are proud that the whole mutual fund industry, most of the cases, today you have seen the IPOs which are 40%, 50% down from the issue value. But hardly any mutual fund, I'm not singling out, hardly any mutual fund has participated in those because they could read out. So that is what I'm saying is the best thing, that the small investors' money in whatever stock is going through mutual fund route. And we are proud of what we are doing. I mean, all these noises, immaterial, this will keep on happening. There are so many interests which are working in the market. We don't bother about that. What we are bothered about is the interest of the investor, whether we are buying the company at right valuation or not. That's the.
I mean, as DP mentioned, you have to evaluate fund manager on his total portfolio return. And if I am adding value to customer by outperforming benchmark index, then you should invest, otherwise there are passive funds. Now, sometimes I also request people to use their common sense. In the issue which you referred, one of India's most respected investor put in money. And then there were people on the social media whose track record of investment is fairly unknown, and they have been cribbing. Now, you can always apply your common sense. If fund managers were investing and not the smartest investors, maybe you need to ask question. But when 140 institutional investors invested, India's smartest investor invested, then you can give benefit of doubt to the fund manager.
Sandeep sir, would you like to add anything?
No, I think I'm broadly, it's exactly on the same theme. I think many times what happens, we get carried away with the seasonal themes. You know, I mean, there's an IPO happening and there's so much noise around it. I think just see it as just one stock. I mean, in mutual fund, every mutual fund portfolio, there are 70, 80, 100 stocks. You don't track that on a daily basis. And ultimately, I'll go back to what I mentioned earlier. Our job, our duty, our responsibility is to add value to the investor. And we'll continue doing that. If we have taken a wrong call, either we'll exit, and if we take a wrong call over a longer period of time, we'll be punished. Investor will move out. So I think analysis of which AMC invested in which IPO, I think it's more, it's not warranted. I would like to go to the other extreme. And exactly what Nilesh Bhai mentioned, you should be worried that I think if you're questioning the mutual fund, how many retail investors who have a limited understanding are investing in the IPO? Logically speaking, if you're questioning this, you should question that hundreds and thousands and millions of investors, they've taken a wrong decision. It doesn't happen like that. So I think it's important many times to differentiate between noise and sound, and it becomes very fashionable to bash mutual funds, many times. But I think see the track record of the wealth creation that has happened.
One question I would like to ask, we have seen passives also grow quite a bit. All of you all have, now huge, lot of products on the passive side. Sir, since you're holding the mic, maybe we can start with you. How do you see passive going from here, and are you also planning to, because we have now seen a lot of products already, so can we expect even more beyond this?
So just the way I see it is that this is something, I go back to 2017-18, at that point of time we had acquired Goldman Sachs. That time passive was not a very, very big thing in India. And this question also would not have come at that point of time. But the philosophy at that point of time and philosophy today remains the same. We are no one to decide where the investor should be investing. Our job as asset managers is giving them an access to Indian capital market, Indian growth story, and we'll give them different routes. We'll give them active, we'll give them passive. And it is up to the investor to decide. And this dramatization of is active better or passive better, or will this thing eat away the margins of the other one, it doesn't happen like that. I think from globally, world over, both of them coexist. And I think I'm very, very confident, and we are one of the largest in ETFs, and we have both sides, and I can thumb the table and say, even if we sit down here after 2 decades, I think we'll have a scenario where both will coexist, both will add value to investors, but the ultimate choice is with the investor. It is not with the manufacturer to decide what is good or what is bad.
Nilesh Bhai, like to.
So as Sandeep mentioned, investors have a choice. You should invest in active fund only if they add value to your portfolio, which means outperforming benchmark indices. And if not, then passive is the best option available. But while evaluating active fund managers' performance, do give them level playing field. None of the index has any cash. Most of us keep 3, 4, 5% cash to pay day-to-day redemption. In index, stock can be more than 10%. In fund, we are capped at 10%. In index, stocks comes in and goes out at closing price. In market at our size, to buy and to sell, there is impact cost. And finally, there is transaction cost in a fund. In index, there is no transaction cost. Put together, decide if active funds are giving alpha, invest. If not, passive funds. Will there be more innovation in passive space? Answer is undoubtedly yes. Globally, thanks to partly because of tax arbitrage, active ETF has taken off. Hopefully someday in India, we will see active ETF coming up. Today, all indices are on public indices that is constructed by established agencies. Tomorrow, we hope and pray that SEBI allows private indices. Then as a fund house, I can run quant to create smart beta strategies. Today, if I create one, I have to give it to an index creator and he can share it with everyone else. So there is no value remaining for me by sharing my secrets out. So active ETF and private indices will result into more passive indices coming out.
Sir, I'll just ask you a follow-up question. Now, recently we have seen, mid-cap funds underperforming, indices. Is that a concern for the industry or investors?
So undoubtedly, when your funds underperform, you have to have a look at the strategy and the mistakes you are making. Now, in some cases, underperformance is coming because of certain calls you have taken. In mid-cap, impact costs are higher compared to large cap. And you have to build position on size. Gone are the days when we were running speedboat, now we are running oil tanker. U-turn लेने के लिए थोड़ा आगे जाके लेना पड़ता है. So as long as you are convinced about your investment call, will you be able to outperform benchmark indices with your sector and stock call? If yes, stay with it. But don't be under the wrong impression that I cannot be wrong. When you are underperforming, you have to test your hypothesis multiple times.
DB sir would like to add.
No, both things actually what Sandeep said, the active and passives are going to coexist, and whatever Mr. Nilesh said, that this is a public domain, everybody is having the same thing, so hardly any value creation. But one more thing, that who is investing in the passive fund is very important. And today if we look at the overall size of the passive funds, I mean, I heard when Mr. Madhusudan Kela says that I'm a free man, right? A free man, I can put money wherever I want to. The same is the difference between active and passive. If I am an investor, investing on behalf of somebody, I have been interested to invest. My first thing will be I should not be questioned, let me put money in the index fund or the ETF or something, so that everybody knows that what has gone up, come down. So 50-60% of the overall passive funds are coming from the investors who are putting in a fiduciary capacity, like the organization, the provident funds, etc., so that they don't have to carry the responsibility of choosing a fund manager. Because fund managers, as I say, errors may happen and they will perform differently in different cycles. So that is one part. And second, the people who want to take a passive call, okay, I just want to put money in the market. So that is one. But this number is growing, number is increasing, innovative products are coming, and we really look forward when the index providers are the responsible index providing is being given to the fund houses also, or privately we can do it, which is not known, and we can work on that. That's one thing. If it happens, then definitely the growth will be much faster. But yes, both will coexist and both will create value for the investor.
Has the industry reached out with this proposal for active ETFs and private investors?
Not as of today, because in US, ETFs get tax exemption over mutual fund. In India, ETF and mutual fund has the same tax exemption. So active ETF will come in different form in India over US. But these are the, futuristic projection, not that anything is in pipeline right now.
Sure. And going forward, what do you think will be the key growth triggers for the mutual fund industry in in 2026 and beyond that?
So I think we started on a note that I think at this point of time there are about almost 6 crore investors in India. Very difficult to put what will change in 1 year. And as I mentioned earlier, ultimately it's the direction, vision for AMFI and the mutual fund industry is that every Indian household should be a mutual fund investor. As we talk today, out of 140 crore Indians, if we go back, divide by the number of households, we are about 35 crore households. I think our endeavor will be we reach every Indian household. Can it be done in the next 1 year? I don't know. And it is not possible. But I think maybe a decade from now, I think we will be saying, today we talked this example of whether active ETF, a lot of times we look at US. The reality is almost very high percentage of households are investing in capital markets, either directly or through mutual fund. We'll be at that stage, maybe a decade down the line. So I think it's, there's nothing that anything specific data point that you can give. But one thing is very clear, Going forward, you'll continue seeing everything. I mean, as portfolio manager also, we bet on India growth story happening in small cities and towns, the wealth that is getting created in, you know, the tier 2 and tier 3 cities. The drivers of the mutual fund will be the tier 2 and tier 3 cities. That is for sure. And that shift will happen very fast. You'll start seeing it. Even right now, some of our data points tell us the action that is happening, it has a lower base, so it is not visible. Because today you can have the HNI sitting in Mumbai investing 5 crore rupees, but the retail investor there is investing 500 rupees. But the growth that you will see going forward for the next decade or so will happen in tier 2 and tier 3 cities.
Nilesh bhai, like to add?
I mean, again, एक वाक्य है, मैं तो अकेला ही चला था, लोग जुड़ते गए, कारवा बनता गया. हमारे केस में हम अकेले नहीं चले थे, 40-50 लोग मिलके चले थे. But two things matter. One, push. Second, pull. Push is literacy. As Madhubhai mentioned, Reliance Growth Fund NAV moves from 10 to 4,000. Other mutual funds also have delivered that kind of return. And yet, total investment in mutual fund, excluding mark-to-market gain, is less than currency in circulation in India. All of us have put more cash at home than we have put into mutual fund collectively. किसी ने आज तक घर पे पैसों का झाड़ उगता हुआ देखा नहीं है, बट सब लोग बिलीव करते हैं कि आज नहीं तो कल उगेगा जरूर. So there is need for literacy where people realize that you need to have appropriate investment to beat inflation and generate real return. And second thing will be pull. I need to reach out to customer, to communicate, to make transaction easy, to give them confidence that they can trust us. So between push and pull, our industry will continue to grow because every participant's interest is aligned.
Are you seeing some, so one second, I'll add a follow-up. Are you also seeing some pull? Because now a lot of direct, you know, you're seeing a lot of participation through direct plan. There's a lot of tech also. Sandeep sir can also add. Are you seeing that maybe first Nilesh sir?
Undoubtedly. Today, every parent, whenever their kids are starting a career, advice will be, beta, beti, ek SIP chalu kar do. The richest person is also telling their kids, and the poorest person is also telling. So financial literacy is spreading undoubtedly, and the role, you know, played by Mint and other media is truly exemplary. Your personal finance column, your podcast, all those things have mattered a lot. If I keep on saying that mutual fund sahi hai, it will have limited impact. But when you say that mutual fund sahi hai, it has far more impact. So literacy is spreading, and that is why push is coming.
TP sir, and then I'll come to you, Sandeep sir. Sir, you can add. You can add about, you know, growth triggers you're seeing in 2026 and beyond that, and also, you know, how important tech can play a role in that.
No, tech will definitely play a role. I'm taking your second question first, because the capacity creation, as sir said, from 5 crore plus investors to 30 crore investors. So we don't have a bandwidth, neither as manufacturers, nor the distribution network is so strong that it can handle such a, tech will definitely play a big role, and that is evident from the fact some of the robos who are playing a great role in getting more and more number of investors through tech intervention also. They don't have any brick and mortar offices and all, and today when we see they are the new fresh SAPs, 30-40% of the fresh SAPs are coming through those tech platforms. So it's proven. It's not something that I'm saying today. But the only point of concern which I feel is, we talked about the new IPOs. Last year has been the IPOs. I think number of IPOs have to be manifold from what it has been. Because unless and until we have that, the more and more money coming into the markets and following the same set of stocks which are there, same set of companies, then there can be a, what you call, demand-supply mismatch. I think the speed in which we were trying to get more investors and more money into the market, we need to work on getting more and more businesses being listed so that we have enough pool to be invested and create value for the investor. That is something as a ecosystem we have to work on. Of course, mutual funds will work on all the IPOs which come, but now the whole ecosystem has to work towards that the more and more companies are corporatized and more companies got into the listed mode. That's
already we are seeing some AMCs coming up with IPOs. Sandeep sir, we can add.
No, I think the question on tech is definitely going to add a lot of value. Tech is adding value, it's giving reach, going to smaller cities and towns, and I think let us also give credit to the growth of the industry that we are seeing. The tech is so well integrated, the online onboarding that is happening, that's making it easy for new investors to come. Tech has also been used in various other facets of asset management. While normally we think it's only about distribution, I think whether it's research or other things, I mean a lot of these things it's adding value. But I want to also add one caution here. Many times I think we try to think when it's about tech, it's very fancy, it's everything is exciting about it. I think we are in an industry where advisory also plays a very big role. When you are trying to, Blinkit, Zomato, impulsive behavior is very important thing that plays a role. But in investing, impulsive behavior does not work to your advantage. And what I mean by that is because of this, many times these platforms, they do it yourself. It may work for an IPO where you're investing in an IPO, you want to after that sell and not immediately after listing. But in mutual funds, you need to be investing for a long period of time. So many times what will happen, there will be certain platforms which will be based on algo. You'll keep coming out giving which are the top 5 funds based on last 6 months, 1 year. And the risk you run is basically as an investor is you'll perpetually you'll always be in the churning mode because the top 5 will always keep changing. So I think my advice will be, I think to the investors, I think tech is going to play a very important role. We should use it, but we need to also be cautious of the fact that the human touch, how that also will continue playing a very important role if investors have to create wealth. And I want to just take one data point which is very critical. I think it's very fashionable to talk about tech everywhere. But the reality is in the last year, financial year, Indian banking industry opened highest number of physical branches. Now, if tech was everything, why are these branches opening? Similarly, for mutual funds also, tech is going to be very, very critical, but there is going to be human touch and advisory, which has to be built, whether it's a part of the tech or it's otherwise. And that's why, again, what I talked earlier about active, passive, both will coexist. For me, the concept that I believe will continue operating in India for many years is going to be research online, and some of them may go and purchase offline. So tech is not going to be only everything impulsive. And I would strongly discourage people to get impulsive when it comes to investing. That is good for Zomatos and Blinkits, all, but that is not good when you're investing in mutual funds.
Right. Great. That's a great point. I'll just open the floor for questions if we have anything from audience. Okay, we have 2 or 3. Okay. We can start with.
I know you've already answered a question on valuations in the IPO, but increasingly when we talk to investment bankers, we are told the mutual funds and the DIIs have become a force to reckon with. They are very aggressively pricing these IPOs, and that is why we are seeing a lot of OFS being cut down because people do not like the kind of valuation where DIIs are sitting. FIIs are taking a cue from the DIIs on pricing. So do you want to talk a bit about, you've been very aggressive in rightly pricing these IPOs, and especially tech-led IPOs where we've seen a lot of room being left for incoming investors.
And my only request to investment bankers is that why don't you apply for a mutual fund license and start a mutual fund and then give your clients the valuation they want. SEBI will be more than happy to give them license if they are appropriate. But as long as I have a job, my job is to my investors. I'll try to do that.
Anybody else has anything? Okay, there is one. Okay, we'll come back.
Hi, my question is on fixed income. I want to ask, is fixed income dead in the mutual fund industry? Because retail investors, I think, are putting money in equity only. And the conversations everywhere is always centered around equity, and with the expectation that equity will give 12 to 15% return in next 10 years, and with the taxation change. And the follow-up question is in the SIF model, do you see that fixed income can have a better role to play?
No, I think let me, I should have answered when Josh asked me this question for next year and future. I think it is, if you see as a mutual fund industry, that is our work in progress or a regret, both the things, A fixed income should have been a bigger part of the overall portfolio. As we talk today, you are 100% right. Somehow the perception is coming out, mutual fund industry is more of equity, which is not reality. And unfortunately also, maybe not within the control of mutual fund industry, in 2003, the long-term capital gains was taken away. And fixed income is the only asset class which does not have any capital gains. So I think we need to work on it. But thank you for highlighting. Ideally, as a panel, we should have, but we really believe it is very important for the country, not mutual fund industry, that more investors are coming into bond market through mutual funds.
Just spare.
In a lighter vein, me, Bala, Navneet, we were all fixed income fund managers. And as long as I was managing fixed income, I was outperforming all equity mutual funds. And Franklin Templeton became second largest asset management company after UTI because of its fixed income, not because of equity. Now, why did people whose first love was fixed income unfortunately had to move out? One, we all benefited because interest rates came down from 14% to 5%. And then we expected them to rise. So the best thing was to shift investors from fixed income to other asset classes. At Franklin Templeton, I launched floating rate fund, India's first floating rate fund when there were no floating rate instruments, and yet we created something. So it's not that debt fund managers didn't try to push debt products to investors. Globally, how does debt fund manager make money? There were giants like Bill Cross. They make money through leverage. In India, leverage is not possible. Globally, debt fund managers make money through hedging. There is no interest rate futures market in India in depth. It's on paper. There is no interest rate options market. If I can't hedge risk, if I can leverage when I believe risk and reward ratio is favorable, how do I generate return for investors? Over a period of time, my feeling is that there will be evolution of debt funds. On the credit side, we will see performing credit AIF coming, more for HNIs who understands risk rather than for retail. Eventually, we will have derivatives to manage interest rate risk, and there will be leverage to generate better return. Combination of leverage and derivatives for hedging will create new sets of debt fund managers and who will give tougher competition to equity fund managers.
Yeah, there's one last question and then we can all have lunch.
Hi, I'm Apurva from Mint. We've seen 3 odd mutual funds launch an SIF. There were several others who made an announcement, but there's not been visible progress. So do you think there's more that needs to be done, especially from the regulators' end, to help accelerate growth in this segment? Another question on if you have any estimates in your mind on what you expect for the inflows into mutual funds in 2026 calendar year.
So I'll take the SIF question. Regulator has done its job. Now it is up to us to deliver. Now, how do I deliver long-short product? For 30 years in my life, I am only long-only fund manager. Long-short is a different skill set, different talent. There are very few people in India who possess that kind of talent. So first I have to get the talent. I have to test my model. I have to perfect a product and then I can give it to customers. Many of us are in the process of various stages in launching the product. Over next 12 months, will you see more number of mutual funds coming and launching SIFs? Quite likely.
So maybe if I was to just add a little to it, I think I see it as a sign of the mutual fund, maturity of the mutual fund industry. I mean, the license being given does not mean you need to go all out. I mean, you have to go keep shouting that I have launched it, and you being the first one. As Dinesh mentioned, I think we are in the other category. We have acquired talent, but still not launched it. So the objective is there's no brownie points to be earned by being the first one. I think this is a sophisticated product. The risk management has to be very strong. And I take it, once I repeat this, it is so the industry is maturing. If 20 would have come till, in the last 3 months, I would be worried. I'm so happy everybody's taking time before they're coming. And to your last question on the flows, I wish any one of us could answer it. I wish any one of you could answer it.
नहीं डीपी साहब काम करेंगे तो आप जो नंबर बोलेंगे आ जाएगा.
But only thing I can add is the numbers, the way the SIF flows are going, there's a lot of stability. So I think at no point of time you'll see a reversal of flow at any given point of time. But I think we need to remain positive.
I think with that we can call it a close. And thanks a lot. Thank you, my panelists. Thanks to the audience for their questions and participation. Thank you.
Thank you very much. If I could request our speakers to please remain on stage. I'd like to request Josh to also please present a token of gratitude to all of your panelists. What an incredible, incredible session that turned out to be. And I request all of you to please come together. We'll also have a quick photo op as well, a group photograph. We'll do that as well. So we'll have you all come together. We managed to gather the right food for thought from our speakers. Now let's put your thoughts on food, because it's time for a lunch break. The scheduled break is for 1 hour, but on the other side of the break, we'll have the incredible presence of our Deputy Governor, Reserve Bank of India, Shri T. Ravishankar. So we will be having that session immediately after lunch. So I'm going to urge all of you to please head to the pre-function area, enjoy the lunch, and enjoy the conversations. Let's keep them coming, but see you all exactly by 3 p.m. for our next set of sessions, featuring none other than Shri T. Ravishankar. Thank you.
How can I achieve my targets? How can I target the remotest markets?
You only progress when you ask better questions. Mint. Think ahead. Think growth.
We'd like to request everyone in the pre-function area to please come back inside the hall. Let's have you take your seats. We'll also continue keeping those mobile phones on the silent mode as we deep dive into our next keynote session that's about to begin within the next couple of minutes. I request all of you to please take your seats. Thank you. Welcome back, ladies and gentlemen. As we move forward with our next segment of the 18th edition of the Mint Annual BFSI Summit. And that being said, we're also in the august presence of one of the central pillars shaping India's financial future. We have the veteran officer here who in fact began his journey around 1990 and now has culminated in one of the highest regulatory roles in the country. In fact, it is under his leadership that RBI is navigating the future of payments, digital currency, fintech regulation, and capital market stability, making him a central architect in India's financial resilience and growth story. Ladies and gentlemen, we are deeply honored to have the presence of the Deputy Governor, Reserve Bank of India, Shri T. Ravi Shankar. And can we have a huge round of applause as I invite you, sir, to please share your thoughts right here on the stage. And after this, we'll move on to the incredible chat that we're eagerly looking forward to. Firstly, sir, over to you.
Good afternoon. I see some vacant seats. So should we wait for a minute or we can start? Yeah. Gone for that cup of tea. It's okay. I'm going to speak on stable coins. And the reason I thought I should speak on stable coins is because of the increased traction that this particular instrument has had in the last couple of years. I have spoken about cryptocurrencies in general and stable coin as well. In fact, I've spoken formally in 2022. So I thought the gap is long enough for me to put down on paper what my views on stable coins are. The idea is to invite debate. The idea is to spread awareness. If I'm right and that I'm right about the risks that they have, I think others should know. If stable coins have advantages that I do not quite see at this point in time, I think it's a good thing if those advantages are also discussed rigorously in public. The purpose of this talk is to start that discussion. Therefore, I have a prepared speech, so, pardon me. It's a bit long. I've tried to cut it down, but I thought since it's going to be a formal speech, one must cover all aspects. So, I will read through the speech now. Thank you. It's a privilege to be able to stand here and talk to such a learned gathering, and I'm thankful to Mint for inviting me. Money, as we know it, has been a central pillar of human society for centuries, enabling trade, facilitating economic activity, and underpinning the very notion of trust in social and financial interactions. Over time, the form of money has evolved with technology, from commodities to metal to paper to balances in deposit accounts to now digital tokens. While the forms of money have evolved with technology, the fundamental character of money, what it represents or what gives it credibility, has always been that money represents value that has users' trust. The value is either intrinsic, if it's metal money, gold coin for example, or derived from a promise to pay, paper money or deposit money. A currency note is a promise to pay by the central bank. A deposit balance is a promise to pay by the bank with whom you have the deposit. So they are either intrinsic, the value is derived from the fact that it has intrinsic value, or there is a promise to pay by a trusted person, by someone you can trust, users can trust. Theoretically, money can be used by any person as long as he has the trust of users. The more stable forms of money in history have, however, always been issued by sovereigns. There have been stages when there was private money, but the more lasting phases, and over the last couple of centuries, the phase that has pretty much stabilized is where money is issued by sovereigns, not by private issuers. Examples of private money can be found in history, but they have not really been stable arrangements. In practice, therefore, money has credibility because its value is promised by the sovereign. Now, this fundamental character of money is under challenge from cryptocurrencies. Not in terms of technology, because money in the form of digital tokens can exist without changing the nature of money itself. You can have CBDC, that's a digital token. But the fundamental challenge of cryptocurrencies is that they claim to change the very nature of money, because cryptocurrencies do not represent value, either in terms of intrinsic worth or in terms of any promise to pay. In this talk today, I propose to explore what the nature of such a challenge is, what the exact nature of such a challenge is, and what are the implications of cryptocurrencies for the financial system as we know it. But to be able to understand the nature or character of money, we need to look a little bit deeper. I explained a little bit about how the character of money has evolved, but what exactly are the attributes of money? In a modern economy, there are two types of money: currency and bank deposits. Currency, physical, is issued directly by the state through its central bank, while deposits, digital, are issued under license by commercial banks. All money is issued either directly by the central bank or indirectly through banks authorized by it. Thus, all money in modern economies is effectively fiat in nature. It is this fiat or sovereign aspect of modern money which creates trust in money and provides it stability. It's important to remember why fiat is important for money. It's evolved historically, but there seems to be a tendency to forget it of late. It's important to remember that. A second defining feature, other than being fiat, of modern money is singleness. Again, something that is not discussed very widely. This is the property that different forms of money in an economy, cash, deposits, are denominated in a single unit, rupee, dollar, whatever, and interchangeable at par. This singleness also arises from the fact that settlement of all transactions take place in central bank money. This is important to understand. It's a bit technical for people who may not understand how settlement happens. It's important to remember that all settlements are complete only when there is a settlement in central bank money. There is a concept called finality of settlement. That happens when ultimately the entries are passed in the central bank. You make a UPI payment. The payment happens. Money goes from A to B. The transaction is not settled yet. The transaction gets settled when that money moves from A's bank to B's bank. And these banks have an account with Reserve Bank of India. So the final settlement happens when money moves from A's bank to B's bank in the books of the Reserve Bank of India. And when that happens, settlement is final. It cannot be reversed legally or otherwise. Singleness of money ensures that trade and commerce is smooth without any concern for the value of different types of money. It doesn't matter which bank's deposit you have. Everything is denominated in rupees. Everything can be converted at par to rupees. Ultimately, in modern economies, the fact that all money is fiat also ensures that money is single. This is a very important fact. If you want to understand what the risks of money that is not single is, just imagine a country where anyone can issue a currency, any corporate can issue currency. Let's say there are 10 corporates and including the fiat money. So there are 11 currencies. You will never know what price to pay for a particular good depending on in which of these 11 currencies it is priced. You will have to look at an exchange rate between currencies even within the economy. That is not a stable arrangement. Singleness is extremely important. Now let's now sum up our understanding of what money has evolved into. So I'm just summing up that money represents value. Please remember, trusted by users, that money is fiat and that money is single. These are the attributes of money. Now, why am I spending so much of time in telling you what money is? It's important. It's important if you have to understand what cryptocurrencies are, what stable coins are. It's important for you to have an understanding of what money is. Now we will proceed to cryptocurrencies. What are the attributes of cryptocurrencies? The historical evolution of cryptocurrency is the outcome of decades of search. To the best of my knowledge, started sometime in the 50s, may even be earlier, for a cyber solution that for total anonymity of transactions outside of state control. For those of you who want to understand this, there is, I think, a 1989 or 88 document called the Crypto Manifesto. You can just search on your net. You will find it. It's a one-page document. It actually gives the philosophy behind the crypto movement as such. But please read that. The creation of Bitcoin in 2008 was the result of that search. Bitcoin, or rather the blockchain, the technology underlying the Bitcoin, demonstrated that a digital token can be transferred between unknown counterparts without the need for an intermediary. Now, this technology was revolutionary. It can have many uses if People can, in a trusted manner, exchange assets or goods without someone else guaranteeing that or authenticating that. But while the technology was certainly revolutionary, but the Bitcoin itself was just a tool to demonstrate the technology. It had no value, either intrinsic or as a promise to pay. It was not money. The price of Bitcoin today does not represent value in the same way money has value. This value is purely speculative, like the price of a tulip during the tulip mania of the 17th century, as some of you would be familiar with. As long as two people are willing to pay a certain price for a commodity or for anything, because as far as I understand, Bitcoin is not even a commodity, for anything, there will be a price for it, but that does not mean that there is value to it. To summarize, cryptocurrencies have no intrinsic value. They are not backed by any promise to pay. That is, they have no issuer. Since they do not meet the basic attributes of money, I reach the conclusion that they are not money. In fact, since they do not have any underlying cash flows, they are not financial assets as well. Please think of any financial asset that comes to your mind. It has to satisfy at least two things, that it is someone's liability or there are underlying cash flows. So, cryptocurrency is not a financial asset as well, or for that matter, any asset at all. It is just a piece of code. How about stable coins? So far we have been talking generally about cryptocurrencies, but what I probably have in mind is more like the unbacked cryptos like Bitcoins. How about stable coins? Which are cryptocurrencies against which the issuer holds reserves to maintain a stable value. Since they are pegged to a fiat currency, they can perform the function of a currency. Also, they are backed by financial or other assets. Because they are backed by financial or other assets, typically treasury bills, gold, they do represent value. Therefore, they have some of the basic attributes of a money. However, before we rush into a conclusion that they are money, we need to keep in mind two things. One, is there a promise to pay? For stable coins to be money, the issuer needs to promise to pay par value to the holder. The fact that it is backed does nothing for the holder unless someone promises the holder that I will pay you. All currency issued by Reserve Bank of India is backed by financial assets. But you still need an assurance of I promise to pay the bearer that you see on the face of your currency note or your bank note. So that promise to pay is important. Is there a promise to pay for stable coins? It is not clear, whether stable coins have the liability of their issuers. It would appear that neither of the two major stable coins in use today make such an unconditional promise. That is my understanding of it, but please check. There is no unconditional promise to pay. Second point that we have to keep in mind. Assuming that such a liability exists, that there is a promise to pay, let's assume it for a moment. The next point to keep in mind is that stablecoin is private money. It is issued by a private person. Therefore, stablecoins fail to satisfy the two defining features of modern money which we have discussed at length a little while back. What are these? Money as fiat and the singleness of money. Right? There can be 100, there can be 1,000, there can be 10,000 stablecoins in an economy. You will have 10,000 currencies. Imagine an economy working with 10,000 currencies. Singleness is violated and clearly they are not fiat. It is possible that in a stablecoin system, there would be hundreds or more currencies in an economy, making any such system inherently unstable. Since we can reasonably establish that unbacked cryptocurrencies are not assets and merely speculative bets, akin to betting on a gambling event, we would focus in the rest of this talk on stable coins, who are at least backed and which has some characteristics of money, which are close enough to money to pose a significant challenge to the financial system. First, let's look at the benefits of stable coins that their proponents claim they have. The proponents of stable coins present a range of claims, the more important of which, we'll focus on the more important ones, are improved cross-border payments, cross-border payment efficiency, greater financial inclusion, and the ability to drive digital financial innovation. First, efficient cross-border payments. An oft-cited benefit is that stablecoins can make payments, particularly cross-border payments, faster, cheaper, and more efficient. In the domestic space, real-time fast payment systems such as UPI already enable fast, low-cost, and reliable payments. And there is no reason to believe that stablecoins would be superior from the point of view of either cost or speed or reliability. In the cross-border space, that's as far as the domestic space is concerned. In the cross-border space, stablecoins can potentially enable faster and perhaps cheaper payments than what the current corresponding banking system provides, mainly because stablecoins do not face settlement risks. On the other hand, it is not certain that stablecoin issuers would have the same degree of acceptability as international banks that are closely regulated and backstopped by central banks. Also, the purported efficiency is doubtful when there is a large number of stablecoins in the ecosystem. Please remember, when this claim is being made, there is an underlying assumption that there is just one stablecoin issuer in the globe. So you just have to get onto one blockchain and you can transfer money instantaneously without friction. There is absolutely no reason to believe that that will be the situation. Second, improved financial inclusion. Another claim often made is that stablecoins enhance financial inclusion by providing access to digital money for those outside of traditional banking systems. Now, financial inclusion requires solutions that are accessible, affordable, and safe. Many countries have made substantial progress in financial inclusion through digital public infrastructure and simplified account opening frameworks without the need to create parallel private forms of money. The inherent instability of stablecoins, we have examined some of those, means that they are clearly inferior alternative to fiat money as tools for financial inclusion. As stablecoins remain dependent on smartphones and digital wallets, internet connectivity, and technical know-how, they may not be available to those segments of the population that are most in need of financial services. Third, stablecoins as a bridge to the real economy. Finally, supporters of stablecoins often argue that they can act as a bridge to the crypto ecosystem, to the real economy. Yet, the evidence today indicates that stablecoins remain primarily used as instruments to facilitate trading and leverage within the crypto system itself. Their role as meaningful transactional currency in everyday economic activity remains extremely limited. To sum up, many of the benefits of cryptocurrencies are stablecoins are neither unique to stablecoins, nor have stablecoins yet established any of the benefits that the proponents claim. Most of this is as yet claims only. By their very nature, they are in many ways inferior to available forms of money. We have seen the attributes of money and we have seen what stablecoins lack in achieving these benefits. On the other hand, the risks they introduce to financial stability and broader macro-financial stability are extremely serious. We will now take a closer look at these risks in detail before considering how India should approach stablecoins. Risks of stablecoins. Beyond the facilitation of illicit payments and circumvention of capital measures, stablecoins raise significant concerns for monetary stability, fiscal policy, banking intermediation, and systemic resilience. Risk of currency substitution, the first risk. A core risk of stablecoins is currency substitution. Their design as currency-like instruments introduces the potential for currency substitution, particularly in emerging markets, where they could compete with domestic fiat money. Stablecoins, whether denominated in domestic currency or foreign currency, this is an important point for you to remember. Please park it. We will explain that a little bit later. Whether denominated in domestic currency or foreign currency would reduce demand for the local currency and raise the risk of dollarization and other risks. Now, risks to monetary policy. Widespread adoption of stablecoins would undermine the central bank's ability to control money supply and interest rates. The IMF FSB paper of 2023 actually says this: if both an official currency and a crypto asset are used for pricing goods and services, domestic prices could become highly unstable due to the inherent volatility of the crypto asset. If residents increasingly hold and transact stable coins, changes in domestic policy rates may have limited influence on economic decisions, weakening the effectiveness of monetary policy. Weakening capital account management. This is something that is very well understood. Stable coins pose challenges for capital flow management as households diversify their balance sheets by including foreign currency denominated stable coins. This trend could make it difficult for authorities to implement capital controls, which are a critical instrument for financial stability in many emerging economies, including India. The pseudonymous nature of blockchain transactions compounds these risks, as it creates channels for unmonitored inflows and outflows, diluting the effectiveness of capital flow measures and complicating both macroeconomic management and external sector oversight. Bank and credit intermediation. Now, banks are the primary entities that intermediate between savers and investors in an economy. This ability derives from banks' role in credit creation. To the extent stablecoins replace bank deposits, banks would lose their role as financial intermediaries, as the primary financial intermediaries. This would result in either a rise in the cost of credit as banks lose access to low-cost deposits, or banks having to depend on the central bank to provide the liquidity required to fund credit. A financial system that has to increasingly depend on central bank liquidity to fund commercial credit would not sustain. Loss of seigniorage. This is another point that has of late been getting more attention than it was getting, but an extremely important point. When a central bank issues money, it receives equal value that is invested in assets like government securities, which are used to back the currency that is issued. Now, these assets earn a return, which is significantly higher than the cost of printing and issuing money. Now, this difference, higher returns versus against the lower cost of issue, is what is called seigniorage income. This, which is transferred to the government by central banks world over. Since currency issue is a social function, seigniorage income rightfully belongs to the government as the representative of the people. There is no case for seigniorage to accrue to private profit-making entities. Yet, this is exactly what stablecoin issuers earn as income. Seigniorage, which is inherently a sovereign revenue arising from the issuance of fiat money, is thus diverted to private operators, often located outside the home jurisdiction, if stablecoins are denominated in foreign currency. It is likely that most countries would see a leakage of seigniorage income to private issuers of dollar or any other international currency linked stablecoins. This loss of government revenue does not receive the serious focus it deserves, not even from central bankers. Just think of the transfer, central bank transfer, the volume of that to the government, you would understand how significant this point is. Domestic coins, stable coins are not risk-free. Often argued by stablecoin issuers that, okay, issue it in domestic currencies. If you don't want to issue it in dollars, allow domestic currency. While such instruments, domestic currency instruments, may reduce risks to capital account management, the fundamental vulnerabilities such as currency substitution, a rupee denominated stable coin called, let's say we'll call it rupee 1, will replace fiat rupee, but it will still replace the fiat rupee. The fundamental vulnerabilities such as currency substitution, bank intermediation, reduced monetary price control, monetary policy control, most importantly, singleness and loss of seigniorage. All these would still remain even if you issue it only in the domestic currency. Can I have a bottle of water, please? This is the reason why advanced economies are also not immune to the risks posed by stable coins. So stable coins introduce real and severe risks ranging, we have seen, from monetary and fiscal disruption to banking disintermediation. The risks are perfect, thank you. The risks are significantly higher for EMDs, but there are also major risks for advanced economies. Understanding these vulnerabilities is critical before considering regulatory frameworks or policy adoption. It is not surprising then that global policy bodies and standard-setting organizations continue to highlight the risks of stable coins. In the interest of time, I would not go into this section about what these international bodies have said about stable coins that I want to bring to your attention, but the speech will be uploaded on our website. You can read this portion if you are interested in that. Basically, these bodies like IMF, FSB, BIS, Bank for International Settlements, have all highlighted that there are very clear risks with stable coins. BIS, for example, says that stable coins fail the basic tests of singleness, elasticity, and integrity that any form of money must meet, and hence structurally unsuitable to anchor a monetary system. That is quite, that's very clear about what the risks of, stable coins are. So what does all this mean for a country like India? How should we deal with stable coins and safeguard financial stability and monetary sovereignty? These questions naturally lead us to consider the domestic policy imperatives that must guide India's approach in this evolving global environment. For India, the approach to stable coins must be guided by caution and an appreciation of domestic imperatives. Stable coins can undermine trust in the currency and finance system. India already benefits from a payment landscape that is highly efficient. This leaves little justification for the integration of stable coins into the financial system for domestic payment systems, even before considering the broader risks they pose. I mean, even if we ignore the risks they pose, we already have UPI and other systems that are as efficient as any in the domestic space. There really isn't a case for stable coins to give added value here. At the same time, India must acknowledge the promise of innovation that technologies such as blockchain and tokenization bring. A central pillar of this strategy is the adoption and cross-border readiness of central bank digital currency. Or CBDCs. CBDCs are digital tokens like stable coins, yet they are inherently superior since they satisfy all the attributes of money. They are fiat, they are single, they are trusted, and they represent value that users can trust. And they do not pose many of the risks associated with stablecoins. I say many of the risks, I don't say all of the risks, because they do pose challenges for the banking system, which is one of the reasons, Reserve Bank has been a bit cautious about, launching it until you have an understanding of what that impact is. Some risks remain, but most of the important risks of stable coins are not there when you use CBDCs. They can perform all the functions stable coins claim to offer, such as programmability, atomic settlement, lower cross-border frictions, while being fully anchored within the existing financial system. Encouraging CBDC use domestically is essential and can be done by making CBDC functionally similar to physical cash, especially with respect to tiered anonymity that cash has. For example, ensuring anonymity of small value CBDC transactions, much like cash, would provide users comfort and trust while preserving safeguards for high value flows. Such an approach also avoids disintermediation risks for the banking system. The cross-border dimension is even more critical. Much of the appeal of stablecoins lies in their promise of cheaper, faster international payments. But the same efficiency can be achieved through bilateral or multilateral CBDC corridors. This is an area where India can play a shaping role by helping the case for interoperable CBDC arrangements among emerging markets and beyond. The third pillar of India's approach to stable coins should be interlinking of fast payment systems. The recent linkages between UPI and several partner jurisdictions are important steps that India has taken, increasingly reducing the need for any private digital alternatives to remittances. Finally, as we weigh policy choices, we must also address a central argument often made by proponents of stable coins, who claim that the associated risks can be managed through regulation. Regulation can indeed mitigate some risks, but the larger questions continue to remain. Can we afford to experiment with the foundations of a global monetary and financial stability that have been carefully built over the years for instruments that lack the safety features of money, that are inherently risky, and that remain untested at scale? As highlighted in the BIS Annual Economic Report of 2025, society faces a clear choice, which is either to strengthen the monetary system using proven foundations of trust and advanced programmable technologies, or to risk repeating the hard lessons of history by relying on unsound private digital currencies with real societal costs. This is what the BIS has said. I will now conclude. We have seen that stablecoins lack the basic attributes of money. Their advantages are neither unique nor unambiguous, and their risks are all too real. It may be noted that we have not, in this talk, that we have not referred at all to the risks associated with the assets that back stable coins, which is one of the risks you most commonly hear about, that those assets can fall in value, create instability. I have not referred to it. There is a reason for it. This is because it does not matter for either the benefits or the risks of stable coin to materialize. In fact, the bigger threat is a stable coin that works well. India stands at a decisive policy crossroads. Despite India having good macroeconomic conditions and sound policies, the domestic factors and compulsions must be considered when evaluating policy options for stable coins. The choices made today will impact the future of our monetary system and financial sector integrity. India's strategy must therefore be clear and coherent, anchored in 4 key principles. 1, preserve trust in the national currency, monetary and payment system. 2, safeguard monetary sovereignty and macro-financial stability. C, encourage responsible innovation through CBDCs and interoperable payment systems. And finally, D, ensure that innovation strengthens rather than bypasses the regulated financial system. What I didn't tell you initially was what the title of my talk was. The title was Stable Coins, Do They Have a Role in the Financial System? I will end with my response to this question posed in the title of the speech. Do stable coins serve a purpose? It seems to me that they do not. At any rate, they do not serve a purpose that cannot be served better by fiat money. Thank you so much.
Firstly, thank you very much, sir, because we managed to also understand the challenges as well as the opportunities around stable coins, and most importantly, you addressed the big question that was also on our mind, so thank you again for that. But on that note, I'd like to now once again invite Mr. Ravi Krishnan, Editor-in-Chief, Mint, to spearhead a very important discussion over here. We'll take this chat forward, and with that, Ravi, over to you.
Thank you, Deputy Governor Ravi Shankar, for that enlightening talk, very professorial. But the approach which you have outlined seems to be the extreme opposite of what the US has done with the Genius Act, where they have kind of given legal banking to stable currencies, but not to a central banking digital currency. Is it because of their unique macroeconomic position and and where the dollar is? Is it because of that, or is there any other reason?
It will be difficult for me to to talk about what are the motivations or the reasons that US has. Clearly, US has certain advantages that virtually no other country has. Its currency is used in 90% of global transactions. And the 2 largest stablecoin issuers today, which account for, I think, more than 90%, or at least around 90%, of global stablecoin supplies are American companies. It is in their national interest, perhaps. Nonetheless, if you remember, one point I emphasized in my talk, that the risks that I highlighted also apply to advanced economies. They have these risks as far as I can understand it, but on balance, there have been statements that this is to perpetuate the global dominance of the dollar and all that. I have no idea whether that is the objective, but the basic point is that they would have their reasons, but I really don't understand why. But clearly they are in a much better position than most EMDEs, countries like India are.
What has been the experience with the central bank digital currency? Wholesale seems to be doing better than retail. Is that due to a lack of genuine retail demand or some other factor?
Again, if we go back to this talk, one of the pillars that I highlighted that India should follow as its response to stable coins is to promote CBDCs. Why did I say that? I say that because it can do everything that stablecoin can do, just better. But it requires one underlying requirement, which is that it's presumed that every other country has stable coins. Now, for many reasons, privacy issues in some countries and for many other reasons, this was not happening at the rate at which the adoption of CBDC should happen. And the advantage of CBDCs will be reaped when a lot of other countries have CBDCs. It wouldn't really show the benefits of CBDC, especially in the cross-border space, if only we had it and others did not. And there, I think I have very clearly noticed in the last 1 year when stable coins are becoming more and more prominent, that many countries, many large jurisdictions, certainly not US as you said, but many other large jurisdictions are looking very closely and very seriously at CBDCs as well. So I think it is very important for CBDCs to exist across countries and connected to each other so that you can actually show a use case which is superior to stable coins.
You have recently talked about, programmable CBDCs for specific use like subsidies, etc. Is there a concern that there will be privacy risks associated with these kind of programmable tokens?
That concern is there. I think that's one of the main concerns in US and in a few other countries. There are two things, I would like to say that for retail use of CBDCs, if you want CBDCs to have the same demand that paper currency has, then anonymity is unavoidable. It has to be provided. At the same time, these are digital transactions. Paper can be just handed over, there won't be a record. But digital transactions always leave a footprint. So it is difficult to anonymize transaction. It's possible. There are technologies which make that possible. But more importantly, we would require a legal backing. Even if it's possible to wipe out a transaction technologically, I think at least most public institutions would not do that unless there is a legal backing to such anonymity. So we'll have to build towards that anonymity to create that unique case for CBDCs for domestic use by retail. The advantages for wholesale, especially cross-border, is simply saving the huge amount of capital today banks employ in managing the settlement risk. All that can be saved. That is fairly clear. But for that, as I told in the answer to the previous question, we have to have other countries have CBDC as well.
If CBDC adoption takes off much more than what it has now, would the Reserve Bank consider, a formal regulation for broader cryptocurrencies?
I didn't, see the link, but it is not really, what Reserve Bank considers, because CBDC is something issued by the Reserve Bank. So Reserve Bank cannot issue something that, regulate something that it issues itself, like paper currency. But Reserve Bank is the central bank, so we would take all, all safeguards that are necessary to make CBDC work and strengthen the existing financial system and avoid weakening that financial system. Whether we would have a regulatory approach to other stable coins or cryptocurrencies, I think what I told you is largely my view of what stable coins are. We live in a country, different people have different views. Ultimately, it is for the government to decide what the approach of our country is. I just gave what I thought my my contribution to that was. But I'm sure when all stakeholders sit together and decide, we will decide on what the final approach of India is going to be.
So there have been these ongoing discussions about the 30% market share cap for UPI apps. The deadline has been extended till December 2026 now. But what is the RBI's current thinking on that?
It has been extended. So very currently, I'm not thinking about it. But the basic issue is it's difficult to implement. How do you implement a cap? Can you ask an entity that is actively doing business to say that you stop acquiring customers? And this is on number of transactions. How do you tell someone that, okay, when your transactions hit 30%, then you stop doing transactions? You can't really do that. Even if you give that instruction, how would that entity, unless it closes down access? So it is difficult to implement without actually affecting the access of the UPI system to others. It has been postponed. We are just hoping, and we are encouraging, and we are taking steps to ensure that more and more people come in. We are seeing that now. I think the best way of achieving that result would be if other players come in, at least 3 or 4 other players, and that is more evenly distributed.
So there are 2 related issues. One is, of course, concentration risk. We see in another sector recently where an entity which has a 65% market share has virtually arm twisted the regulator. The second issue is many of the top 3 players are all foreign owned. So what about digital sovereignty and de-risking the Indian system?
2 things. First of all, on concentration, I'm not unduly worried. It is, strictly speaking, not market share. You see, these are third-party apps, right? UPI is a transaction between 2 banks. So the share of business that the third-party app has does not matter so much for a system that facilitates transaction between 2 banks. It is very distinct, very different. And even if the concentration risk, even if something happens to one of those 2, there's no risk to the system. I think most people in any case have more than 1 app installed. But even if they don't have it, it's a matter of time before you just install another app and do it. So in terms of concentration and what risk it can cause to the UPI system, I don't really see that risk to be very significant. Well, sorry, what was the second part of your?
About digital sovereignty, how these are foreign owned.
You see, we are open. We have an FDI policy. We want foreign capital. Foreign capital comes in, invests in according to the policy we have. So I really don't think that is an issue, that I would really be thinking about when I'm talking about UPI.
The other thing I wanted to ask you about was digital arrests. We see quite a number of instances where people are losing their life savings sometimes because of this, and it is getting more sophisticated by the day, these kind of attacks. And many victims of digital arrests whom we have spoken to in course of our reporting, they are not quite happy with the role which the RBI Ombudsman is playing as a protector. Is there any plan to revamp the system? Are you looking into it?
There was recently a Supreme Court order on that, on digital arrests. Investment frauds, digital arrests are some of the more potent frauds. They're the more severe in terms of quantity and number than payment frauds, which tend to be small ones and can be controlled. But they are very severe because people have lost large amounts of money, people have lost their life savings. This is something that has to be approached very seriously, which is exactly what the Supreme Court has said. I think we have to put in a lot of efforts. One effort is, of course, on ensuring that such frauds do not happen. There are certain efforts in that direction. There also has to be efforts in ensuring that if they have happened, then how do we develop a system that maximizes the possibility of recovery? A lot of effort is involved. Reserve Bank has a role to play. Banks have a role to play. Other, in the ecosystem, law enforcement agencies have a role to play. We are looking at that. There are, we have developed some technology, for example, a mule hunter, which we expect that over a period of time, as its efficiency continues to improve even further, we will be able to identify mule accounts and, therefore improve the chances of recovering money that has been, taken out through frauds, including through digital arrests. There are other efforts as well, but this is something that is serious, that needs to be addressed and requires coordination across the ecosystem.
Any information you can share on the success rate of the mule hunter? Has it been successful in curbing?
So far it is working on roughly 20 banks. The success rate of that is about 90%, which is good. But then this has to improve further. We have to take that to the 99s. But that will happen when this machine learning system learns more from more data and keeps learning and relearning. We will get there. We'll get there. Most of the banks have come in. Once the remaining large banks come in and all that data becomes available, we should be able to get there.
We are out of time, but one audience question we can take. Just one. Yes, Ms. Kuriakos.
Sir, you have made your stance on cryptocurrency, that is RBI's stance on cryptocurrency and stable coins very clear. So why isn't the regulator and government taking, complete step against stopping this trading? Because today India is among the top 3 countries, I believe, as per news reports, in terms of cryptocurrency adoption. And now we are hearing that in villages or tier 2, tier 3, people used to buy land, and now it is land plus crypto. And there are crypto academies flourishing, etc. So why don't we just have an outright ban on exchanges who give this, etc.? Because it's very clear that it will undermine our monetary sovereignty and all the other risks associated with it.
Agree with you. It's very clear to me. It's very clear to other people from RBI have also spoken about it, and I'm happy to discuss it or debate it with anyone who thinks that any of those arguments are not justifiable. We are happy to do that. But then, you see, at the end of the day, that is our view. As I told in an answer to an earlier question, we live in a democracy. There are different stakeholders. There are cryptocurrency or stable coin issuers. There is the government. There is the banking system. It might also have a view. We have to look at all these stakeholders before a final decision can be taken. I think what you're saying is that decision should be taken sooner rather than later. I think that's essentially what you're saying. But I'm sure, it is under consideration. It will be taken early. Ultimately, we'll have to all finalize our approaches and our actions based on what that decision is.
So, in your eyes, is investing in crypto equivalent to real money gaming?
I think I strictly don't understand what real money gaming is. I have not done one, but I think it's clear in my mind that unbacked cryptos are pure gambles. They're pure gambles in the sense of mathematical bets. So an event has to happen, you just bet on that event. I give one example for people to understand how, if they don't have any value, do you think people are fools to pay $100,000 to buy those? The point is, you could have asked the same question to people who bought those, tulips, right? A flower which has a shelf life of probably a week, I don't know, maybe less, but people were willing to pay the price with which they could buy, riverfront chateau or something. People were willing to pay that. So that craze happens. It happens when you think, you don't really think what it's worth. You only think whether I'm able to sell it for a price higher than what I bought it at. And that craze, as time and again history has shown, happens all the time. You see, you and me, if we pick up this bottle of water, I sell it to you for 100,000 rupees. You sell it back to me for 100,000 rupees. We put it on a, on a ledger. Then this bottle has had 2 transactions worth 100,000 rupees. I have given you nothing. You have given me nothing, right? But that, if more, another 50 people do that, there would be another 100 people who will think, oh, there must be something special with this. So let me see if I can buy it, around 100. That will be the price. That won't be the value.
Thank you.
Thank you. Thank you very much, sir. And thank you, Ravi. If I could also request Ravi to present a token of gratitude to Shri T. Ravi Shankarji for joining us this afternoon here and for taking us through an interesting masterclass, if I may put it that way. And on that insightful note, we're now about to march ahead to our next Fireside Chat, which is all about the playbook for a $5 trillion India. When we're talking about unlocking productivity at scale through digital infrastructure, or for that matter, through bold reforms and a growth model that empowers every sector to accelerate, this is where we get to decode that playbook. And joining us this afternoon, we have starting a whole new bold course aiming to democratize access to formal finance, modernize financial infrastructure, and shape how millions of Indians borrow, transact, and secure their future. So as part of the Fireside Chat, first up, we have with us none other than Hitesh Kumar Sethia, the Managing Director and CEO, Jio Financial Services Limited. And to spearhead the session, I'd also like to please invite Shayan Ghosh, Editor, BFSI Mint. We're talking about the playbook for a $5 trillion India. Can we have a wealthy round of applause, everyone? Please help me welcome our next speaker for the session, Mr. Hitesh Kumar Sethia. And with that, Shayan, over to you.
Hi, a very good afternoon, everyone. So we have with us Hitesh Sethia, who's making a rare public appearance. So, the first question, Hitesh, is, we have an array of financial services providers in India. You have banks, non-banks, you have fintechs. There's still a lot of under-penetration that we see in India. Yeah. What is it that India requires urgently to make financial services available to more number of people?
I think good question, Shayan. And it only becomes more prominent as we march towards becoming a $7-10 trillion economy. We obviously need to improve the breadth of financial services. At the core of it, I think the answer is quite obvious. Financial services needs to be first and foremost simplified. Think about smartphones. Smartphone proliferation started much after financial services and has leapfrogged so far ahead. Every smartphone has the ability to download a financial services app, but financial services has not got that amount of reach. So clearly, while a lot of progress has been made in the last 2-3 decades in terms of simplifying financial services, has it really been simplified for the masses completely? Perhaps the answer is no, and there is still a long way to go. So I think that's the first thing that needs to be done. Second, I would think modern customer expectations are completely changing. I mean, look at the quick commerce movement that's happening around us. Look at the OTT movement that's happening around us. Now, if my e-commerce website can actually tell me, or an app can actually tell me what I'm likely to shop next, my OTT knows what I'm likely to watch next, why does my financial services app not predict what's my next financial need? So I think we have to move from digital first to intelligent always. I think that moment is needed for us to become more and more penetrative when it comes to financial services. I think these two are very vital.
So Jio, I think, says that one of the objectives is to simplify financial services, what you just said. Could you give us some more details on what you mean when you say simplifying financial services?
Yeah. Okay, that's a good question. See, when we say simplify financial services, for example, let's say I want to buy a car insurance today. Now, there is so much cognitive load that is there for customer. Even in a simple thing like buying a car insurance, I go on a website, I look for what's my make, model, I put all the details, and then I get, okay, these are the possibilities. The most expensive one may not be the best one. The cheapest one may not be the fit for purpose for me, because my context is very different. My context of driving the city, I'm driving the car, make, model, everything is different. And therefore, is there any simple tool or what I call an artificial intelligence that works for customer to say that, listen, based on your profile, this is what is likely to be most suitable for you? I think that can simplify financial service. Let's take another example. On the day I get my salary disposition is going to be very different from that of many people in this room, because my lifestyle is different, kids, school, mortgage, whatever we say. And simply put, financial services has to work like Wi-Fi. When you need it, it is available, and when you don't, it's quiet in the background. It really has to get down to that level, and that is what is going to make a difference in financial services. Everything, whether it's investing, there is so much cognitive load, there is too much choice perhaps that is available for customer. And personalization in its real sense, not just customization, not just making cohort. We are truly living in a world of what I call n equal to 1. 1% cohort is where the world is moving towards. That has happened in e-commerce, that has happened everywhere else which we see. It should happen in financial services. That will simplify it, and that will make it then a delightful experience.
Taking forward the point that you made about maybe too many options, too many choices available for the customers, what does Jio Financial Services want to do in this overcrowded market?
Now, it's interesting. So at one end, certainly one feels that the market is overcrowded. We are a data-rich, digitally very advanced country. Payment space is certainly overcrowded. But if you look at insurance penetration in the country today is 3.7% of our GDP. The global average is 7%, so we are half the global average. Investment, India is still a nation of savers. 6% of the country is investing, the rest are still saving. A country like China, which is generally considered a close comparable to us, is more than 2x of that. US is, of course, ahead of half the country is an investor. And as we become a developed country, the opportunity spectrum is going to massively grow. So I think that's one aspect. The market itself is going to need a lot more differentiated and big players. And we hope to play a role as we go along, as this nation continues to build. That's one aspect. Second, within this overcrowded market, I think what we want to bring is what I just spoke about. 3 aspects. Can we make finance truly simple, truly personal, truly invisible? And not just in one sliver of finance, not to just say we will make investment simple. For example, Mutual Fund Sahi Hai has done a fabulous campaign over the last 10 years. The results are there for us to see. But kaun sa mutual fund sahi hai? That's the next question to answer. And even in mutual fund, let's say the country, and if you look at West, there is enough to say that the country must move from single stock to mutual funds to model portfolios to managed investments. So there is a full journey that needs to track. Similarly, on insurance, there is a whole journey that needs to track on what's the appropriate protection that one must have. And same is the case in lending. So I think the whole country is set for what I call constructive disruption in these spaces, and we hope to play a role in each of these areas in a material way.
Right. On disruption, see, you must be having the burden of expectations given what the parent has done in the telecom sector. But the financial services sector is much more tightly regulated. It is different. How do you balance between the two? Between the expectations and adhering to the regulations that you have in the sector?
So 2-3 points. So one is, in my view, regulations are mandatory, necessary for a healthy financial service sector. They facilitate responsible innovation, and we just heard from one of the senior most RBI officials on how regulation has shaped the country, has kept the country stable. So to us, regulation supports innovation. So everything is good on that front, and we are a firm believer in that philosophy. Now, when it comes to expectation, yes, the telco world has a different playbook. Price has been a disruption. For us, In financial services, we hope to be what I call constructively disruptive. We certainly have to be price competitive. It does not mean we'll have to have a price war that will have to be taken. We'll have to be constructively competitive by making sure that there is cost engineering at scale, because at the end of the day, the moat can be driven by permanent or structural cost reduction or cost engineering, what I call, so that benefit can be passed on to customer, a benefit can be retained for the shareholder, and scale. So I think these two moats is what we intend to work on to make sure that we build a formidable financial service firm.
And beyond lending, is cost something that is a priority, that, lower costs for people buying financial services products from you?
So not, as I say, we have to be price competitive. At the end of the day, to compete in this market, one has to be price competitive because that is true value for the customer. We'll have to play on the advantage of cost. We'll have to play on the advantage of scale. And with today's technology, there is a real chance, given that we have no legacy. We are a completely last entrant in this field. Given that, we have the advantage to set everything from zero base. And if we are able to set everything from zero base with today's modern technology, with the brand and capital that we have, we believe there is a good chance that we have in creating value for customer and capturing value for shareholder. That is an equation that can be solved.
And is there some sort of a late mover advantage that you have in this field? We spoke about how crowded the market is, but in terms of technology, if you could tell us.
Absolutely. I think there is clearly, late mover has, let's call out, late mover has the disadvantage that, as you said, the market is crowded, degrees of innovation, one has to work harder. But certainly there is still scope for innovation because customer expectations have gone up so much and today's technology allows for that. But late mover advantage clearly plays out in technology, and within technology, I would say particularly plays out in many areas. Specifically, I will say data. Again, there's a lot of talk about AI. I do believe that AI has a definite use case, but before even we get to AI, Shayan, I think one has to solve for data. And given what we have seen over the last 30 years in terms of how this whole body of data science, data analytics has evolved, I think there is a lot of learnings which we are able to incorporate from day one. Let me just take a minute to explain that. A lot of people talk about data analytics and how nice it is, but to me, 90% of the work is in the plumbing. Take a simple example. We can build a beautiful house. We can make the interiors as beautiful as we want, but if the plumbing and wiring of the home is not good, we are never going to be able to enjoy the comfort of our home. Data plumbing, getting the data infrastructure, getting the data architecture is very important. And because we are a last entrant, we've been able to do all those things, whether it's a unified customer view and a lot of operational stuff. And finally, the real test for us to be able to use AI is my data retrievable in 5 seconds? If a data that is to be used for AI use case is not retrievable in 5 seconds, we are not AI ready. And therefore, because we are born when AI use cases have started mushrooming, a lot of development has happened in the world of data science. We are able to internalize all of these things. And so that gives us tremendous advantage in terms of capturing. Finally, we have to capture right customer, right time, right product, right channel. It's an equation, easier said than done, but requires a lot of wiring and plumbing, and followed by data analytics, insight, action, then make sure AI use cases reach that equation. So that's the ladder in which we are pursuing.
Is it all being done in-house, like your focus on AI, if you could talk about that?
So I would say we are working with a few partners, and a lot of it is certainly being driven in-house as well. Today, the Indian Fintech ecosystem has evolved so dramatically. So a lot of point solutions are available from a lot of Fintech partners. So we work in a combination of in-house and Fintech partners. Certainly the data analytics bit is always going to be in-house because that's going to be let's say a moat for us. And the customer experience bit, the UI UX, is always going to be in-house for us.
In terms of investment products, there's some data that suggests that primarily it is distributor-led when it comes to mutual funds, etc. Can technology alone, let you stand out in this market? You would need people's presence on ground, distribution. How are you going about that?
It's a very, very interesting question. In fact, there is this whole debate that goes on between a direct model versus a distributor-led model. Let me say this. In the last 30 years, if the country has seen whatever financial penetration that has happened, it is thanks to distributors. 30 years back or 25 years back, when mutual fund and insurance companies were coming up, how would you reach tier 2, tier 3, tier 4. And it would not have been economical with physical branches all the time. So the distributor ecosystem has done a fabulous job. I think with increasing financial literacy, with increasing simplification of financial services digitally, a lot of products are now amenable to DIY. Take the simple example of credit cards, personal loans, simple term insurance policies, car insurance policies. Most of us perhaps have the first-hand experience of doing these end-to-end digital. There are a lot of products which are high involvement. Let's take one example, mortgage. For most people, buying a home is once in a lifetime, maybe twice in a lifetime, but it's a very involved purchase. That still requires a lot of, a high degree of physical involvement. So technology alone, can it overnight eliminate disruption? If that was a question, I believe no. But technology can certainly make a lot of products DIY. Technology can also digitize the distribution channel. You can digitize the distribution channel, make that intelligent, make that far more efficient, and that is happening as we see. So on the mutual fund industry, you look at that. Almost 25 to 30% of the retail AUM has now moved to direct. It has moved away from distributors. Having said that, there is a whole body of advisors that is picking up. So I would say the ecosystem is evolving. It's not just digitization, but can it also move to advisory? Can each Indian have finally a trusted CFO co-pilot kind of a scenario? I think we are moving there.
But given how cost-conscious Indians are, does having an advisory, as you're talking about, an advisor, is that feasible for Indians?
See, again, you absolutely hit the nail on the head. The key is to make it cost effective for Indian people. At a per capita GDP that we cannot afford to compare ourselves with US, because then the cost equations and everything gets disrupted. We'll have to make sure that unit economics of everything that is done in India is 1/10 the cost of the West. And with today's technology, it is certainly possible, Shayan, I would believe. Let's look at, for example, there are investment in mutual fund which one could make at 500 or 1,000 rupees in India. I would think it's very difficult to have a parallel of that in US or Europe. It's going to be very difficult to make that economically viable. In India, we've made that viable thanks to DPI and thanks to everything that the fintechs have been doing at a price point that is possible with modern technology, with data.
And on the lending side, you know, what is the strategy there? Because bankers say that it is easier to lend than to recover.
Of course.
So having a presence on ground, establishing that brand and franchise for customers to be able to relate to.
Yeah. So thankfully for us, we were blessed with two things at birth. Though we are a startup, and we are literally a startup, 2 years back or approximately 2 years back is when we got listed, a bit over 2 years, and started business literally at the time of listing, at the time we got listed rather. I would say we were born with two things which most startups take many years to build. One is brand, because literally the Jio brand is in people's pocket or homes, and half the country uses the brand and the whole country is perhaps aware of the brand. And the second one is capital. Now, given that these two are available for us, the goal is really to build a stable, steady financial institution from a lending perspective, which is not only adding value to customer, but is able to last for decades and weather the cycles that come with lending. So that is why we have begun our journey with secured lending right now. And as we go along, we will look at other products that may be needed.
Also, Jio brought BlackRock back to India. What's the strategy there in the wealth management business?
So BlackRock, again, we are extremely delighted with the partner. And let me talk about collaboration, the way we think about collaboration. So there are, broadly, the way we look at collaboration, there are three vectors of collaboration. If you think about it, we are present in MyJio, which is a part of the Jio telco. And the MyJio app has got a few 100 million users, monthly active users. That gives us a funnel for Jio Finance as well. Customer in their lifetime go, what I say, horizontal. On the same day I use telco, I buy groceries, I may end up buying a shirt, and I need financial services. Whereas industry is organized vertical. So there is clearly a case for collaboration between industries, like in this case, telco and financial services. And we see that. We see a collaboration between e-com and financial services all the time. That's happening in the country, and many such examples are there. Second is collaboration in the nature of BlackRock, where two partners are bringing complementary strengths to the table. We bring clearly distribution and brand, and BlackRock is the largest asset manager. I think their size and scale speaks for their credentials that they have. And the approach there is clearly to see how we as Geo BlackRock can modernize investment for the country. Now, whether we do it through the asset management, wealth management, or broking, those are vehicles that will be done. Eventually, we want to get to a point where managed funds is available not just for the Uber HNIs or the HNIs of the country, but can we, with the help of technology, make it available for the middle tier of the group. That is really the goal that we want to bring. And of course, with our partner, we've been able to get access to systematic active equities, Aladdin systems, and the best of the world's risk management and algorithms that are available. That is a part of the JV. So that was our thinking there. Just to cap off the way we think about collaboration. Collaboration between competition is also something which is par for course today. And the best example is the co-lending framework of RBI. So I think collaboration is the way forward. BlackRock is one example. Allianz is another example where we've already brought in, on similar vein as BlackRock, we've brought in with Allianz as well, which is work in progress for us right now.
So you'll be going to smaller towns as part of this partnership?
Yeah. In an eventual scale, Shayan, we expect to be a full-scale service firm. We will span across the entire length and breadth of the country. Even today, with our payment bank, we are present in over 200,000 points across the length and breadth of the country through corporate BCs and our own BCs. On our app today, we have combined over 18 million users of the app, which span over 19,000 postcodes. So we are already present across the length and breadth of the country, and that will only deepen and widen further.
A connected question on wealth management. There are a lot of players, like in other sectors, also in wealth management. A lot of banks are coming up with their own strategies. Two of my colleagues also recently wrote how the listed wealth management players are seeing either a compression in their margins or are seeing, no growth in margins because of competition. How do you deal with this? This hyper competition in wealth management.
So again, I think the game has to be expanding the market rather than trying to eat up just the existing market share, because there is a whole body of wealth management services that can be offered to what I call the middle of the pyramid. Clearly, the top of the pyramid is well served and can be better served. So there is an opportunity there as well. But the middle of the pyramid today is an area which we believe there is a great opportunity to serve. Somebody who's let's say 5-7 years into work experience, earning a certain amount of money, may find it difficult to get a white glove service from a wealth RM. It may also be economically unviable for a wealth house to offer physical RM, but can we offer wealth advisory digitally? Can we offer wealth checkups digitally for such person? Can we offer model portfolios which are automatically rebalanced? So there is a whole, let's say, series of possibilities that one can imagine which could make a difference to what is perhaps less served today as a segment. So that is an area which we think can be a good starting point.
And if I zoom out a little and talk about NBFCs as a sector as a whole, they have gone to places where banks have not been able to penetrate. For you, what do you think the role of the NBFC is currently, the sector per se, that you are one of the newest entrants in the market. So what do you think about it?
So as I say, we are a late last entrant. And Sayan, again, the way we think about it, the regulatory playing field is more or less leveled out. So it's not anymore, I would think, NBFC versus banks, but it's really about legacy mindset versus agile mindset. Technology has also become available to everybody. I mean, there was a point when people said, because if you're an existing institution for 30, 40, 50 years, you may find it difficult to adopt technology. Perhaps some of it is true. It is harder. It is not impossible. Some of the newer institutions are what I call digitally native, and therefore they're able to adopt technology much faster because they don't have any back base. But I really think the way forward is not going to be bank versus NBFC. Of course, there are some advantages banks tend to have, but it's more going to be legacy mindset versus agile mindset. Even within agile mindset, I would say the future belongs to not just being digital first, but being intelligent always. And I think that leap is not going to be trivial. It is a leap which I think is going to be in the benefit of customer. And again, what I mean by that is today there is a lot of talk about AI. But people talk about AI for enterprise. How does it reduce my call center cost? How does it reduce my operations cost? What is the efficiency that it can drive within the organization? We need now AI to act on behalf of the customer. I need my trusted co-pilot to say, this is the right insurance policy for you, this is the right credit card for you, and this is the right loan for you. For example, my travel habits and eating out habits could be very different from yours. And therefore, my credit card should be different than yours. But there isn't anything which says what's the right credit card for me. So I think those vectors is what will differentiate more than NBFC and bank.
So then if AI start advising on where to invest, what to do with your money, would you still need that many wealth advisors, or it would be like an IVR system where the AI takes the first set of questions, the queries, and then it goes to the
I
caller?
think human in the loop is a big body of discussion and has a lot of value, because we have not yet reached a point where AI can replace humans. I don't think that should happen in financial services, because it is too vital. I mean, I can get a wrong movie recommendation. That's fine. It's not going to change my life in a big way. I can get a wrong shampoo recommendation. It ain't changing my life beyond a point. But if something goes wrong with my money, that's going to have a deeper impact in my life. Of course, I want the first two also perfect. It's not that I don't want that perfect, and the industry is already there. So I think human in the loop is going to be there. There are a lot of ethical guardrails that are being put in terms of making sure the models don't hallucinate, etc., etc. But human in the loop will remain.
See, when you look at the when you look at the list of RBI's top 15 upper layer NBFCs, a lot of conglomerate-led NBFCs are there. Do you see in a future where your NBFC is also part of an upper layer NBFC in terms of assets and the scale at which you're growing?
That is for RBI to decide. I wish I could decide that. But I think they published the list, and I mean, I would say from a governance and operating standpoint, we already operate at bank standards. So for us, those classifications, as and when they come, certainly whatever additional rules are there, we are well prepared to adhere to those rules. That is what I would say. It's not something, I think that will happen as a function of our growth and outcome, but as and when it happens, we will see.
One last question before we close it. You come from a background from an institution that's been known to create a lot of leaders. A lot of CEOs come from there. What would be that one or two thing that are the takeaways from your tenure there, and something that you have implemented in your current organization?
So, identify talent early, give them freedom to operate within guardrails, and always back up people when they make bona fide mistakes. I think those are the three principles I learned in my former employment, in my former stint, and which I think are timeless lessons. Whether you're living in a digital age or analog age or AI age, it doesn't matter. I think people need that motivation, freedom, and backstop. I think one should pursue that to build a leadership slate.
All right, great. Thank you. Thank you so much.
Thank you very much.
Thank you, Hitesh. Great talking.
Thank you. Thank you very much, Hitesh. We'll have both of you come together for a quick photo op. And if I could also request Shan to present a token of gratitude to Hitesh Kumar Setia. In a way, an unfiltered conversation there, gathering not just about the industry, also the principles, his guiding principles as well, that ensure that his vision moves forward, moves ahead. Thank you so much again for joining us. But with that, let's now quickly set the stage. We're about to move forward to another panel discussion. And this time we're talking about rewiring credit, Fintech's next chapter. Moving from rapid innovation to sustainable impact, where smarter data, sharp risk models, and embedded experiences redefine how consumers access and manage credit. This particular panel discussion will be all about an entire focus on Fintech's next chapter. So let's also get it from the very leaders who will be sort of driving this discussion with their valuable insights. So we're going to pick on those insights. We're going to get the session started, and kindly oblige with us for just a minute while we set the stage. And while we do so, I'd like to also inform you that we have placed the feedback forms on the tables. So please do take some time off, a minute or two, in order to fill your feedback as well. So please don't forget to do that. At the same time, we also have the tent cards that have been placed on the tables. One of them is for the survey that actually allows you to also share your priorities and your thoughts with regard to the upcoming budget. And the other tent card is also an AI-powered sort of initiative for the summit. So we'd love for you to explore that in order to continue the collaborations and the connections here. So please don't forget to scan the QR codes on the tent cards that have been placed on each of your tables, and don't forget to fill in the feedback. Okay, looks like my team is set with the arrangements here on the stage, which means that I'll now go ahead and invite our session moderator, because they often say that to get the right answers, one needs to ask the right questions, and this time we're in the able hands of Sneha Shah, Editor, Deals and Startups, Mint. So Sneha, let's have you on stage. I know you've been asking questions as an audience member as well. Now let's have you on the stage to ask questions as a moderator. And joining Sneha, let's actually go ahead and invite our incredible speakers. I'd like to firstly invite Madhusudan Ekambaram, CEO and co-founder Credit B, Sandeep Singh, CEO Trillion Loans, and Akshay Mehrotra, Managing Director and Group CEO Filed. All right, if you're excited about FinTech's next chapter, let's have an exciting round of applause. And I'm going to hand it in the able hands of Sneha. Over to you then.
Thank you, everyone. Thank you to my panelists for taking time out for this, and I couldn't have asked for a better panel than this. Half a decade back, lending startups were on a brisk lead. You know, they came up with a promise of serving those that traditional banking system couldn't. Tech-backed underwriting, armed with a lot of capital, they were the darlings of the FinTech world. And then came a wave of regulatory changes, the scrutiny that reset the rules, and especially around unsecured lendings, P2P lending, small ticket credit, and models such as FLDG, just, you know, that blurred the risk of ownership. Today, those who have survived have emerged stronger. They are here to rewrite what we will call the FinTech 2.0. And on that note, you know, we should dive deep into what is likely going to be this 2.0 of FinTech. And Madhu, if you can take this up first, how has the RBI's tighter stance on unsecured lending reshaped the market?
Yeah, thank you, and good afternoon, everyone. Right, so first of all, I think, you know, this entire FinTech lending per se is almost a decade story. You know, so most of us who are sitting here, we are all that 2014, 15, 16 kind of guys, right? So when we started, I think it was entirely an unregulatory world. You know, so the regulator did not take a note of such industry because the size of the companies were very small. I don't think there was a lot we were adding to the AUM or to kind of make any difference, right? So suddenly what happens is just about pre-COVID I'm talking about, right? So just that March of 2020, we were very actively tracking the number of apps on Google Play which would be doing lending, right? So, you know, just take a second to kind of have a guess about that. The number of apps that were lending, that was a staggering 2,300 apps, right? So that's the number of apps which were literally lending, right? So that was the point when COVID happens, which basically tests out the entire market in terms of what was the business model, how sustainable were those business models, underwriting mechanisms, were they even prudent, and how many of them even really followed any kind of a regulatory norms itself. I mean, forget about, you know, following regulatory norms. A lot of companies didn't even have a license to lend as well, right? So either NBFC or a banking license, there was no license, there was no backing NBFC which would do that. I think that was the era pre-COVID, right? So then comes 6 months to 1 year after the COVID, post-COVID. I think this number of apps and then the regulator also became active to first time to kind of start talking about a draft guidelines of digital lending guidelines, what we call it. 6 months down the line, the number of apps on the Google Play, same, which was about like 2,400, had come to about 85 or 88, right? So that was the wipeout of the market that what COVID saw, right? So I think that is when the digital lending guidelines came in and a lot of things came in. I mean, regulator did not really make it too much of a difference into the overall world of fintechs. If I have to put 3 to 4 categories of what lender is for regulator is looking at is, one is if anyone wants to do lending, do the heavy lifting of lending like underwriting, collections and everything, they like you to be a licensed player like an NBFC player. So there was some asset light models, there was like platform models. I think basically they came and told that if you are lending, then you better be kind of licensed and come under our purview. The second thing is they wanted a little bit of an asset heavy skin in the game kind of a play. They did not like that you just have an NBFC for the namesake to do KYCs and access to bureaus, but you really have to kind of build your book, because once we are trying to supervise you, we want to understand what's the extent of your business activities are, right? So third thing which largely relies is on the fairness with which you are operating, right? So the transparency, what you are showing to the customers, the fairness in terms of the collection practices, what you are doing it. So any amount of fairness in all the guidelines adherence is the third factor. The last fourth factor is something what you said is, what I've understood is like regulator really does not like you to be too tomboyish or too smart enough with the regulations. I mean, if they have told that credit card can be only done by a bank and not by a NBFC, so multiple models came in terms of trying to mock a credit card, let's say. I think that is where they had put an end, saying that with one regulation that this is something what we don't like, right? So, or even in P2P, the investors were told that they would get a fixed returns on the money that they are lending. I think those are the models which they kind of scrapped it off. I don't think they have acted very insane or anything to say that there was too much of tightening that has happened. As long as somebody is following and then complying to the regulations, I think there's a lot to achieve in this lending world.
Building on that, Sandeep, do you think that this entire regulatory tightening, has it really strengthened the ecosystem or it has slowed down innovation?
Thanks, Neha. Good afternoon, everyone. Just a brief background. I manage Trillion Loans, which is the group NBFC of Bharat Pay. We deal in a lot of MSME customers and consumers where we do lending. Coming back to your point, Sneha, I think what Madhu touched base upon the evolution of how digital lending of where it was to where it is, certainly there's been strengthening in the entire ecosystem. The whole point that the core thing was outsourced to certain unregulated way of underwriting or collections or sourcing, itself was not sustainable. And therefore, today if we look at, I think the way today underwriting is being played out by all fintech lenders is more about understanding affordability, and that's where they are getting innovation in than looking at historical data to really underwrite a case. And therefore, that's what fintechs are now at the forefront when they look at underwriting. The second is the depth on customer acquisition and the way innovation is happening. Earlier chapter of fintechs was build a width, get more and more customers on board. Today it's more about depth, and therefore how well you can give that customer the entire financial services suite. And therefore, width versus depth is being played out. Earlier, innovation was about UI UXs, the 10-step physical world changing to 3-step to 2-step clicks. Today, the innovation is on the back end of how well you know the customer before that need arises. I think these are the 3 points of how innovation and therefore how the stance has actually changed over the last 3-4 years.
Right. And Akshay, if you can, get on to explain us how has the industry improved in terms of discipline? What kind of disciplinary steps has the industry taken, and what are the kind of models that have got weeded out in this entire process?
So, very interesting question. Majority of us will say that
in a regulated business, what's the problem? Right? I'll joke and say that in a school, there's a principal who enforces rules, there's a monitor who enforces correct action in a class. Right? And this was where we see our industry was going through a lot of fun actually. There were a lot of naughty boys also who were managing to pass the high school, right? And the regulator put a whip on us. The good boys in the class said, what can we do better? Right? So Madhu and me, in fact, helped set up the industry SRO. We said, we'll try to monitor it so it's better and the industry can grow. But there came a very interesting opportunity. I call it regulatory arbitrage, right? When you understand the right way of doing business, actually it opens up a phenomenal larger business to build and make. This is because you know the guardrails, and once you have defined the guardrails, you can really expand in that territory in a great manner. So what we saw, see, majority of the guidelines came just after COVID, right? Market was cleaned out. Whoever had to go bad had gone bad, right? Which meant there was a plain level field between a traditional institution and a modern institution, which meant we could really go expand businesses. We knew the guardrails of what is right, what is wrong, right? And as the regulations kept becoming very clearer, what was gray became absolute black and white, each of us expanded phenomenally, right? And that is what is different from catering to a small niche, having many apps trying to build a consumer understanding. The regulator himself brought in front page coverage about what is right and what is wrong. Consumer understood that. Players like us, which were very well governed, we took the opportunity to expand phenomenally well, right? And today when you look at the evolution of the industry, it's a very sizable, large, impacting institutions getting built, right? And it is a time where fintech lending has come to a great era. Like you said, 2.2 is something that we will see in a very large manner. But now it is a industry just like you have banks and non-banks, and there are fintechs. Right? It's very clearly established, and you can build larger outcomes because the segments are well governed. Look at the market, right? While we talk about large banks, we all at the same time talk about how big Bajaj is, right? Similarly, we'll start looking at how a market can really help build a new category in fintech, right? And that's what we will see with this regulatory arbitrage coming to a benefit of the industry.
Right. And are the big boys able to access capital better, Madhu?
No, I guess accessibility to capital I don't think has been a bigger problem, but at what cost we are able to access is the problem, right? So I think cost is a determination of your vintage, your performance across cycles, basically, which all comes down to the ratings, what the NBFCs kind of govern. I think that's what defines the cost of funds per se. I think that is what probably all the lending, the ones who have grown on a significant size, today we are all competing or we are all trying to kind of get our cost of funds lower, because that's what is a kicker for your ROEs and ROAs, right? So as an entire cost, the overall availability of funds, I don't see that there has been such a struggle. At least, I'll talk for most of us here. I don't think there has been probably any month that there was certain demand and we couldn't kind of go and comply to that. Funds are available in India if you are ready to pay for the price here.
So maybe I want to add one point to that. See, I think Madhu put a very good point. Funds are available at a given price at any time in the Indian market. But we have seen this dynamics change specifically over the last 2 years. As industry became larger, the separation took place of who are the big boys and not the big boys. I think what typically took place in NBFC for almost 2 decades, they had to build credibility for 2 decades before they could symbolize their liability side well. Right? The new age fintechs have been able to do it very well and in a much faster space. Right? And that's what's happening. Our credibility is getting built very well. Our ratings are happening much better. It's only a question that when these will be more accepted, where cost of capital advantage will come into equal to, let's say, other financial institutions. But the bigger point is what took a fair amount of time is got accelerated with clarity in the market available.
Right. Capital is available, but is the opportunity as large? has the Indian credit opportunity, I mean, is it still as large, Sandeep, as it was projected earlier?
Oh yeah, I think it will be in our lifetimes for sure. And if I look at MSME opportunity, right, and that's real in nature, and it's very well governed by, if you look at the GST data, the UPI data, merchant transactions data, and therefore the sheer volume now properly monitored and transacted itself gives a lot of opportunity on the MSME space. With the macroeconomic environment and the way we all are looking up to Viksit Bharat, I think MSME as a segment will continue to grow. Even on the consumer side, I think both Akshay and Madhu will agree, it's here to stay and will grow. And therefore, in the previous question, I think Akshay alluded, it's the separation of serious fintech lenders playing out and capturing that market that will only accelerate from now on. People who are governed well can work on unit economics profitability, will be able to scale well and gather that opportunity.
But I asked that because only a handful of them have been able to scale up beyond the 10,000 crore AUM mark. So in that sense, is the opportunity that large? Do you see
so
more
I think, and I think we were discussing, Akshay was mentioning, I don't think the 2.0 NBFC Fintech 2.0 is about building AUM, it's about liability management. I think the first wave was more on small ticket, short tenor, and therefore that had its own treadmill effect. And therefore one would never was able to capture the way traditional banking looks at AUM. But look at their sheer disbursals that would have happened right in here and here, right? And therefore, as we get into the depth of the customers, the way credit penetration is being helped out by the fintech players, the customer itself is graduating. And slowly those cycles will start building into a little higher ticket size, more bigger tenor will start reflecting into AUMs, right? So I think it's the depth on the customer monetization / customer lifetime value that will play out. And I'm sure 1-2 years down the line itself, you'll see many more players reaching that 10,000 crores mark.
Right. So surely the depth is there.
So Sneha, just want to add to that, right? So I guess there are some recent bureau reports, right? What it talked about is there are two ways to look at the impact on lending per se. One is what is the volume of loans, or one is in terms of number of customers served or number of loans that have been given, and other one is what is the value of loans that has been given, right? So in terms of value of loans, definitely the banks and the NBFCs have a elephant share, right? So but if you look at the number of loans or the volume of loans, I think fintechs are almost crossed about 60-70% of the entire loan accounts, right? So in terms of impact, reach, and trying to kind of serve as many as customers, as it was told, like, it was started with the nature of a shorter durations and everything. So it's largely, it becomes like a dispersal impact rather than an AUM impact. So with respect to fintechs, we have to see in both the context, so what's the AUM that has been built up and what's the disbursement that they have done. Just to put you a figure, probably I don't have a right number, but if you take even the top 5 fintechs, lenders, and if you look at their disbursement, I think that may be equivalent to even the entire NBFC sector itself, barring Bajaj, let's say, right? So I think that's the kind of disbursements per year what fintechs would be doing. Yeah.
Right. So surely depth is there, but has the asset quality improved? Akshay, how are we seeing?
I'll first, I want to add a point to your previous line. It is our biggest impact is not that we give loans or we build a process of giving a more efficient, faster loan. Our biggest success has been that when we give the experience to a customer, he comes back to us and says, I like this experience. I find it dramatically different. I will continue my relationship with you. See, the power of compounding takes place here. What we did last year, if we can do the same business to the same consumer again, our efforts get diminished and every new customer that we do is an incremental to our business. And I think that is the single largest point that fintech could do, which traditional lending ecosystem could not be that successful, right? That's causing a huge compounding effect. And to that point, you will see the differentiation moving from count to value, accelerating because of the advantage. The second part is true sense impact coming in, right? Like when you were coming in, I'd asked you this question, can you differentiate between one fintech to another? Majority of the time we come and say, oh, he has a mobile app. It looks like he has a few crore installs. They all look identical to the consumer, right? And that's a very important point. Each one of us is trying to solve a specific customer demand and exist in the ecosystem. Like we are known for two products. One is young people, let's say who's middle India across from tier 2, tier 3 or metros. If they need, let's say 100,000, 200,000 rupee, they can come to our mobile app and borrow. That's our first product. But over time, we evolved into the concept known as impact lending, which you go to any hospital, any clinic, where you can actually get a healthcare loan or a skilling education loan, right? And many of the time, people didn't realize that almost 50% of the customer that we originate today come from these categories, right? What was seen in the fintech origination process, the 1 second loan, when it comes to an impact category side, imagine you're in the experience in a healthcare, right? Suddenly you come and say, oh, they're causing real impact. They're able to demonstrate that impact. And that is what I would call as the moment where there's a challengers getting built in the category. The categories are creating subcategories which are larger than life, right? And you can really build enterprises which will sustain time, cause acceptance in the market, able to differentiate themselves. And majority time in financial services, unless you differentiate yourself, you cannot raise quality debt, you can't lever better, you can't attract good quality equity or debt. And all these things are now coming to life, where we see high amount of differentiation coming out, separation coming out, and strong business model emerging.
Right. To that point, Madhu, what are investors more excited about today? You know, what is attracting investors to? Is it MSME, home, gold, co-lending, embedded finance? What are they? What is the flavor of the season?
I think today there are. It's no more fintech lending is no more a nascent industry. You know, so I think there's been a decade which has gone through, and therefore it is somewhere in between growth to maturity kind of a stage, right? So that's what it is. In that, one thing that what investors today look at is probably your right to exist and right to win has to be kind of proven very strongly. You know, so if you take any form of lending, you talked about gold, there are multiple players. You talk about MSME, there are multiple players. Consumer lending, there's a bunch of players, right? So then, what is your right to exist even? You know, why do you think that you can sustain your business? And what is your right to eventually win, or why you are winning today, right? So I think these two things are very predominant for them to understand, because the supply is large. Today there is no dearth of supply, right? So unlike some different industries where you just see that there's a monopoly with one specific player, or one specific player has more than 50% of the market shares, I don't think that happens in a lending sector, right? So therefore, there's a good amount of supply. Then this becomes one of the key factors. And of course, you know, so while this becomes from an investor perspective, but there are a lot many other hygiene factors, right? So growth is whether it is going to be sustainable, whether your ROEs are meaningful, your performance during the credit cycles, right? So has they been consistent? What kind of an impact that you actually do bring about on the table? So many of these are pretty hygiene, but since there is a larger supply, I think it always comes to right to existence and right to win. Yeah.
Yeah, you surely, you know, want to build a right to win, but how are you, you know, trying to, how are fintechs trying to ensure that they make their businesses future-proof from regulatory shifts, or, you know, if both of you can just take it one by one.
So maybe I'll first talk about it,
Yeah.
right? First is, see, businesses are only going to be large, stable and consistent in result if three rules are followed. One, you have to create moat in some element of business, right? The moat cannot be, I understand risk better, right? That is the core of the company. The moat could be how you ascertain a problem better. For example, distribution moat, we saw that phenomenally well in a traditional world. The large NBFCs exist because there's a distribution moat they achieve. Today, fintechs have done some of them where they have built diversified distribution moat coming in. The second is that technology is available to everyone, but can technology lever to give you an OPEX efficiency, which is itself a very large differentiator, right? And third is if your model itself has the ability to cater to a larger segment and grow in that category segment. Is the category growing? And within the category, can you really build penetration within the three? All investors look at these three elements of business, and these are very grassroots to any other business in the economy, right? And that's why accelerated growth investment comes in these category, right? Financial services is phenomenally impactful. India is a credit-starved country, but it's a very interesting economy because consumerism is just coming in, right? And this is because of the consumerism coming in, you will see credit becoming a part of your life, right? We saw that in the Western countries first. We saw how China adapted to it. We're going to see the same impact to an Indian economy coming in the same manner. And that gives an exposure that the industry will continue to grow, right? If you keep finding your diversification within that and your differentiation and moats getting built in, companies will get resilient and able to sustain the toll of time to keep building something larger.
Right. Sandeep?
Yeah, you mentioned about how do we future-proof from a regulatory, in future regulatory concerns. I think, and the way we understood regulator over the last many years is about how do we put customer and customer protection in the center of what we do, and therefore, something like how well we are handling their grievances, customer service, how well we are protecting their data. The entire DPDP Act coming in, data sovereignty and localization, of how well we are guarding customer privacy. If we are aware and continue to work towards it, I think that's one area to look at. I think another is, what at least we all have learned over the last 4 years of regulations around digital lending guidelines is it's more or less black and white. I think it's not left to someone's imagination. And if one works towards the spirit of certain guidelines of why regulator wants it certain way, I don't think so there are any regulatory concerns that may happen. What happened and what Madhu in the start took us through the journey of last 8 years was in certain people's mind of how regulation should be, or in the absence of regulations. So I think it's more to do with spirit than the letter itself, working on customer protection and data sovereignty.
Right.
Very quickly, right? So this is one observation which if the fintech founders, if they evade, I think there's a lot amount of clarity will come in. Okay, so what happens is, whenever there is a guideline that comes out, suddenly there's a lot of importance given to a lot of literature, English language. Okay, so why there is a but and why there is not an although, and then why there is an etc. being kept over there. So suddenly these guys will float to the legal companies to get their interpretation. And I've seen many interpretations which are never clear. They're so ambiguous. So it has gone to the next level of ambiguity. And therefore, I've seen even more instances that why don't we go to RBI and ask them. Then there is one more incident what I've seen where investors telling that, yeah, if you go to an RBI and ask, what if they say no to it? Right? So then you will not be able to do it also. So there's a hell lot of ambiguity that what people build in. Right? So once I was discussing about this with some of the folks from RBI, right? So they told we are not a literature research company, right? So we write in a very simple language. Even if you go to any commoner who knows some English, ask him to read that, and whatever he understands, that's all we want to write, right? So don't go too ambiguous about what we have written, try to misinterpret, interpret whatsoever. So I guess this sounds very laughable incident, but if you look at many practical situations, people are so oriented in doing this. The second thing, at least in my experience, is if you are in a doubt, just walk into them. They are actually very receptive. Sit with them and talk to them. Even though you don't get a direct answer, but they will definitely give you a lot of directions, which will tell you a lot many answers. I think that approach is way simpler than going through this entire cycle, falling into a trap of building something with certain assumptions and finally seeing that regulator actually meant the other way, right? So yeah, I think that's some practicality around that. Yeah.
Right. And surely, listening to all of you, it seems that the ecosystem is emerging stronger. Also, I think with the kind of growth some of you guys have seen, you all are at the threshold of hitting the public markets, and some of you have, either openly stated plans or are, some of them are in work. So, do you see meaningful IPOs coming out of the fintech ecosystem over the next 4 to 5 years? If you would want to just talk about it, are these companies, is the ecosystem matured enough to hit the public markets?
No, I guess any investor-backed companies, unfortunately, I don't think any of us are born with some silver spoon or a wealthy family. So more or less a middle class, upper middle class. I don't know about you two guys. I'm assuming that, right? So in that factors, we had to always go to the investors to raise capital, and any company which is investor backed ultimately has to get into an IPO, because that is seen as a good exit point or a liquidity kind of improve. So I don't think there is any doubt in any such companies. Now coming to even financial services, especially lending companies, I think by nature of the company, the requirement of equity is continuous. I don't think it ever stops, right? So if it is growing, then we have to continuously raise equity. Maybe the frequency changes, right? So in that ways also, even from the regulatory perspective, I think after a certain scale and size, it is kind of expected, although there is no clear mandate around that, but it's an expectation that you list, because a lot of transparency and governance kind of becomes a super solid, right? So with all that said, and also the industry aging almost close to a decade now, I think that probably the next financial year we would see that multiple players being traded in the market. I think that's what, because if just one guy has to blink here now. If one guy goes and lists and everybody is in a hurry to get themselves listed, and that's how this industry works. So I hope some of us will blink first. Yeah.
Right, Sandeep.
Yeah, I think lending itself is very capex intensive, right? So eventually one has to always pump in money. I think the signs for hitting, or rather before the urgency creeps in, I think what I think are 3 most important fundamentals that as a business standalone should achieve. One is looking at unit profitability over a sustained period of time. The second is predictability, either in terms of asset quality and the business that we do, and create a moat around it. And the third most important is being public ready governances and transparency, So for example, today, while we are not public, but we do kind of try and manage quarterly the way once if you are public, how do you manage those governances, disclosures and transparency. Being public is just the start of the game and not really the end of the game, and that's the way we see it. But of course, over a horizon of next 2-3 years, you will see a lot of players coming in and scaling up.
Right. Before we open the floor for questions, one last question to Akshay. What are the white spaces that you think fintech lenders can chase going forward?
I think the opportunity in every segment in consumerism is phenomenally large, right? I'll stay to the B2C side of it by demonstrating that. I would say every segment credit will come into picture. See, when mobile phones and TVs can be bought on credit, right? It's not only the e-commerce categories that you'll see a lot of evolution taking place, but let's say we have like our efforts on healthcare, efforts on travel, efforts on solar, efforts to finance specific goods, services, etc. are taking place. And we see each of them becoming very large outcome-based businesses. And we will see that continue to keep coming in, right? And that's where it is not that the segment is evolving. The segments are large, and we'll see the segment itself becoming very large because of that.
Right. Any questions from the audience? I think we at Mint cover fintech so well that, I don't think the audience, anyone? Okay, so on that note, I'll wrap up. Thank you so much, Akshay, Sandeep, and Madhusudan for taking time out and speaking to us. It was really nice having a great chat with you. Thank you.
Thank you so much. I'm going to request all of you to come together for a group photograph first up. Also request Neha to please present a token of gratitude to all of our speakers for joining us here at the 18th Mint Annual BFSI Conclave. Thank you once again. All right, with that, we're also about to set the stage now for our next Fireside Chat, and this is where we are about to focus on the opportunities in cross-border payments. I'd like to urge all of you to continue being seated as we begin the Fireside Chat in just under a minute. All right, with that, time to rejig a little, set the stage, and let's move ahead to our next Fireside Chat. As I mentioned earlier, this is all about opportunities in cross-border payments. Now, that being said, as we all understand cross-border payments, they're entering a whole new era, driven by real-time rails, clearer regulations, as well as rising global commerce. So as the businesses expand internationally, streamlined payment pathways offer unprecedented efficiency and, most importantly, scale. When we're looking at emerging technologies as well, for example, tokenization to AI-driven compliance, all of these are also opening fresh opportunities in order to reimagine how money moves across the borders. Which is why this afternoon we have a seasoned professional who comes armed with more than 20 years of rich experience in the Indian banking and fintech sector. She's someone who's highly passionate and is an entrepreneurial business leader who's about to join us this afternoon. We, in fact, have with us Paroma Chatterjee, the Chief Executive Officer of Revolut India. And first up, I'm going to invite Anshika Akayastha, who's the Assistant Editor Mint, to please come on stage so that you and we can go ahead and welcome our next speaker for the summit. We have with us Paroma Chatterjee. So let's put our hands together, everyone, and let's welcome on stage Paroma Chatterjee.
Hi, good evening. I think to start off with, I think where I would want to start off with is, it's been a long journey for you as well in India. You started off in 2021 is when you started setting up shop. And it's been a 4-5 year journey. I think last we spoke, you said setting up shop in India has been akin to building a new Revolut in India, if not less. You have the 2 licenses in place now, the AD2 and the PPI. Is it smooth sailing here on? How do you expect, or is it going to be an ongoing battle journey? How do you see growth here on?
Hi, good evening. Awesome to be here, and thanks for having me. No business journey is ever smooth sailing, Anshika, we'd all know. So in 2021, when we first came in as a global company, the first order of business was to get our company registered in the first place. That itself in India can take anywhere between 3 to 6 months. So by 2021, we were a bona fide registered company to be able to operate in India. Then we had to look around to see what are the licenses we wanted to get. There are two paths to get into the financial services industry in India. One is by securing your own licenses organically. The other is to partner with banks or other financial institutions and have an entryway. Now, this is something Revolut is very focused on, to secure our own licenses and build our own products and our own customer experience, therefore, and then launch in any market. Now, when you had to look at the landscape, the domestic payments space standalone was quite crowded with quite a few players offering various digital apps to cater to the domestic payment use case of Indians. Lending use case, likewise. There were multiple digital lending companies which were offering different types of loans for different customer segments. Again, trading also was beginning to get crowded with a number of companies coming in. But the one area which needed to be disrupted was the whole Forex space, which is why we started out by acquiring our 82 license as the first license, and that we got inorganically by acquiring a company. So 2022 was pretty much spent in acquiring the new company, and you know about when there is an M&A, right? Integrating the new company, their ways of working, all of it, to change the management to Revolut ways of working completely and get an NOC from the regulator in our favor of the new management, and got it rechristened to Revolut Forex India Private Limited. So that was the second order of business in 2022. Once we had the license which gave us the right to launch products in the Forex space, we started building out the product. So 2023 was twofold focus. One was to build out the entire tech stack, which is almost like building another Revolut in India for the Forex payments and business, and in parallel apply for the domestic payment license. Because once again, Revolut's overall ethos is not to be a one-dimensional player. We're present in 41 countries now, with India being the 41st. Out of the 41, in 22 countries, we're a full-fledged retail bank. So the end game is to offer the full suite of financial services to Indian consumers. And if we have to start as being a holistic payments provider, we want to be the only app that provides both domestic and international payments. So while we were building out the Forex products, we then applied for the domestic PPI license as well. So 2023 was about that. 2024 is when our Forex product was ready. We launched it with our employees, and at the same time, we got the in-principle authorization for PPI. And then over the last year, what we've done is also built out that integrated payments platform with domestic and international, submitted it, got the full authorization from the RBI to convert and launch. And then, you know, we announced the launch 2 months ago, sorry. And we're humbled by the kind of response. We have more than 400,000 people who are already on the wait list, and we're gradually beginning to clear the wait list. So we have another philosophy. We're not in a hurry, really. We want to be slow and steady and do it right. So even when we start clearing the wait list, we clear the first set of users, and then we get their feedback. And if anything needs to be corrected, whether it's on the product or it's on the proposition, we correct it, and it's only a really acceptable product that we launch full-fledged in the market. That has been Revolut's secret of success in every single one of the countries that we've launched in, and we're hopeful that that strategy will play out well for us here in India as well.
I think globally, Revolut's philosophy has been simplifying multi-currency payments. Comparative to maybe some of the other economies, India's regulations are a bit more constrained, or at least a little more conservative. In that sense, how has been your approach in India in terms of looking at payments? Even today, the Deputy Governor spoke about, unfortunately or fortunately, cross-border is one segment where you're also dependent on other countries and their sort of economies' acceptedness for building those bilateral sort of arrangements or looking at those sort of tie-ups. How has that approach been to look at payments in India?
Actually, more than the regulatory aspect of that, let me answer it from a consumer lens. Sure. If you look at consumer behavior, look at yourselves and your families, the people who are sitting here, I think India is becoming a more open global India. Right? Kids from our families are going to study overseas. Do you know the number of kids who went to study overseas in 2024? 750,000.
Okay.
Do you know what they're pegging after this admission season that is currently on? The number of students who will go overseas by the end of this year to study next year?
About,
They're pegging it to be more than double, and more than 1.5 million kids from India will go to study overseas. So that's a phenomenon that's growing, right? Do you know how many Indians went overseas to start working in another country last year alone? 13 million. So 7 million students and 13 million people going overseas to work. 20 million people out there going out to build their futures in other countries. Do you know how many Indians went to travel overseas for leisure? 20 million, another. So we had 40 million Indians going overseas with the need to spend money in an affordable and efficient manner. So the consumer need is a burgeoning need overall. And that's the lens with which we as Revolut are also approaching the market.
Right.
If the consumers need a solution and that solution is not easily available, we will go out there and solve for it. That has been the lens. And if you ask me within that, what are the things to solve for? That was going to be, okay. There are two main things and another supporting thing, okay? The two main things are affordability. Since I gave you the statistics of the number of Indians who went overseas, do you know how much Indians spent overseas last year?
You're answering one.
Indians spent $40 billion overseas. And out of that $40 billion, do you know how much was just in charges alone? $400 million. So to be paying $400 million just in charges and cross-currency markups, it is abominable.
Yeah.
Right? So that is one of the things which really has to be solved for, to make it affordable for Indians to just do what they're required to do, pay their kids' fees, pay a travel agent, dine outside when you've gone out. You shouldn't need to pay such exorbitant charges to do all that. So that's one thing, one opportunity, which definitely we're looking at solving for. The second thing is time.
Yeah.
So if you have to send money overseas, from the time that you initiate your transaction today, it takes anywhere between 3 to 4 days, depending on the country that you're trying to send the money to, for that money to show up in the recipient's account. Now, if it's an emergency, again, if it is a college fee deadline, God forbid somebody needs a medical emergency, or if there's sensitivity around booking a hotel room which is going to go away for an international holiday, anything, there could be sensitivity around time. But that is, again, something which hasn't been solved for. That's the second thing which we need to solve for, and that is one of the areas that we're working on. So those are the two main things from a consumer standpoint. The third is transparency. Today, if you're sending money overseas, and typically these are high-ticket transactions, from the time that the money gets debited from your Indian account, you don't know. It goes into a black box. And then you have your heart in your mouth, right? And how many days is the money going to show up in the recipient's account? When will I get a confirmation? Even when the money does show up, how much of it will show up? How much charges will get deducted on the way? It is not transparent at all. So the third thing is to be able to open the hood and for consumers to be able to track their money flow at any given point of time. That's the third thing we're looking to solve for. That's kind of the approach with which we look at this space.
You touched upon travel and education, of course. When you look at these issues, what are the main use cases that you see that you're trying to solve for?
Use cases are pretty much linked to these consumer segments, right? If I pick up the top 5 segments, the student segment, it's definitely college fees, right? Second is their maintenance, their monthly maintenance to pay their rentals, living, etc. The third thing, which I like to call, is making it an everyday payment experience. Like if your kid has gone off to college overseas and they're having their birthday, to just be able to send some money to go out there, buy something for yourself or treat your friends. What UPI did within the country to make payments from one state to another, today if you have you're sitting here in Bombay and you have your kids studying in Bangalore and you just want to send them money, you can do that. But instead of Bangalore, if they're studying in London, you can't. And it's about making that experience possible in terms of making even overseas payments an everyday payment. That's sort of the use cases that we see surrounding students. Then the second is surrounding the entire travel space. Yeah. In the travel space, it is basically payments which are made in advance to tour operators, etc., to hotels, to international airlines to book. And secondly, actual expenses which are made when people are traveling, which is whether for sightseeing, whether for dining out, whether for shopping, to make all of those affordable, rewarding, and instantaneous. That's sort of the second set of use cases around travel. The third thing that our studies have propped up is also another type of tourism that is increasingly on the uptrend is medical tourism. Yeah. So a lot of Indians are not, I wouldn't really call it tourism, but for specialized treatment, a lot of Indians are going overseas and spending a lot of money. That's the other use case that we see in terms of spending money for hospitalization and medical and healthcare overseas. The fourth is a slightly different segment, which is the business segment, which is your entire importer, exporter, as well as freelancer segment. That's another economy that is booming with the online and digital presence. You have a lot of freelance workers in India who are doing freelance work, whether it's for advertising, content creation, anything for people overseas. To be, as well as availing of services from people from other countries, to be able to easily make payments and receive payments from them. That's sort of the fourth use case. And last but not the least is the biggest, which is the inbound remittances. So India, as you know, is the largest recipient of inbound remittances by far. Last year alone, we had $129 billion of inward remittances. The largest, I mean, more than double of the $67 billion that Mexico got as the #2 inbound remittance country. So the amount of money that Indians are sending back, whether it is the professional Indians working overseas sending money for their parents' maintenance back in the country, or it is the blue-collar workers sending money back into the tier 3, tier 4 locations in India for the upkeep of their families, that is just growing. And to be able to make that affordable and seamless and timely is the last segment that we see. So these are the 5 segments and use cases that we see and we're going to be focused on.
I think remittances is a great point. We've seen the rupee depreciate for all the negative side effects of that. I think it's a great time for remittances. Do you think it's a great opportunity in that sense to relook at how remittances are done, how remittances are, especially inbound remittances that come to India, how do you see that shaping out as a segment?
Oh, 100%. I think this is one of the biggest areas for the different countries and regulators to collaborate on. I know because the governor was here. Yes. These are conversations which are happening between the governors and regulatory bodies of different countries where they're trying to converge on some kind of an alignment on rails. Now, if you look at it, we've got UPI, which we're trying to export and internationalize. There are 3 corridors which have been activated bilaterally to make UPI international. But on the other hand, LATAM is trying to export PIX. They have made PIX into almost an equivalent success in LATAM and trying to export that as the default payments rail from LATAM. In Europe, they've got PassPay, which is trying to do the same thing. So now, with different geographies trying to create their own payment rails, does that simplify or does that make it more complex? That's something to think about, right? With each country trying to put forward its own native payment rails, it can actually create more complexity in the international ecosystem. Think about it as 3 different alternatives to a single SWIFT that exists today. Unless the regulators come to create some kind of a common guideline, like an ISO certification equivalent, if you will, that all of their standards are common, and therefore payment handoffs between each of the rails can happen smoothly. I think those are the kind of things that we'll need to converge upon for the different regulators and countries to come together to make it really seamless. And the second thing which I like to talk about is one common global identity. Again, think about it. When you travel, your passport is taken by every country, agnostic of which country it is issued in, if you leave aside the OFAC countries, where your passport is taken as a valid transport proof of you being a global traveler. There is no equivalent of a global financial identity. If you today are opening a bank account in India, India takes certain proof to know your customer, to authenticate that you are indeed Anshika Kayastha, and then opens a bank account for you. If you have to go and open one in London, you have to repeat the entire process all over again. There's nothing that can hold, which is a passport equivalent, to go and say that here, this is Anshika Kayastha's financial identity, and we take this identity. And kind of like the visa analogy, where every country layers on certain visa requirements based on their specific requirements, They can be free to layer on certain requirements from theirs for the financial identity as well. But I think that one common global financial identity and one common standards for global financial rails, if these two things can be arrived at, that can truly make borderless finance possible.
I think one last point, because you touched on a global identity. You also touched upon UPI being limited to domestic payments. We're seeing so far UPI linkages has so far been very focused and merchant-based and in certain pockets. But recently we saw the EU-led TIPS linkage happen. Now that we're seeing government-led initiatives for bilateral sort of agreements come in, how do you navigate that sort of ecosystem as a private player in this market?
It is brilliant for all players. If this is actually a really good move. If there can be a bilateral agreement between two countries like ECB, the EU and India for a TIPS to use UPI overseas, there has been a Singapore-India bilateral as well. There are talks about a Middle East-India bilateral. Let's see where that goes. So bilateral-wise, it can then has the scope to create smooth rails between those two countries or those two geographies, which then private players like us can leverage on those rails, right? But with bilateral way of going about things, it's limited to those long, drawn-out conversations to arrive at two countries agreeing to do it between themselves. That is why I was focusing more on the platform and common rails as a topic. Like, to give an analogy, from the card network side, a MasterCard and a Visa are accepted everywhere in the world, right? Once something becomes accepted standard everywhere in the world, it's much easier to globalize. Then it doesn't depend on bilateral conversations on, oh, it's accepted only in this country and not anywhere else. Then it becomes universal standard. That, I think, is what can create true borderless finance. And that goes with our company thesis as well. We actually believe that the financial world is a borderless world. People inhabit a digital world that's a borderless world. So the financial world should also be a borderless world by putting in the right controls digitally, but making the standards common.
I think, thank you, that's been very insightful. I think we'll have to wrap it up. We're running out of time. I think if we have time for one audience question, if somebody wants to.
Yes, that table.
Thank you so much for the talk, by the way. I have a few friends from abroad who've been raving about Revolut, so there's clearly a lot to look forward to. What I wanted to ask you regarding the point you mentioned about different payment gateways across countries. Correct me if I'm wrong, because I just found out about the app yesterday. But right now it's a pairwise clearing system, right? The two currencies are sort of netted across, all those transactions are netted.
I didn't exactly get your question.
So if I have to make a payment in USD, it's just netted across the app itself, right? That I'm able to pay in that currency and those transactions are cleared. So do you see any scope for, as and when Revolut becomes more prominent across the world, do you see any scope for there being a global currency that is made use of, where you have indicative of a basket of currencies which can be used across locations?
That is a much longer conversation. I don't know if you have time for that right now, but that is, by the way, what stablecoin is trying to solve for, to have an alternative currency. But I don't think we're right here to discuss stablecoins. We can have an offline conversation on that.
All right, thank you.
All right. Thank you so much for your time. Thank you for joining us today. I think we'll wrap it.
No worries. Thanks a lot.
Thank you. Thank you very much, Paroma, for joining us. And I'd like to request Anshika to also present a token of our gratitude to Paroma. We also managed to gather some very interesting data points from this discussion. And thank you so much again. We're quickly about to shift the gears and move on to our next Fireside Chat. And this time, we're talking about why the NBFCs and fintechs need each other in order to win the digital-first consumer. Now, while we all know that fintechs bring the speed and seamless experience, while the NBFCs, they provide capital depth and regulatory strength. So together, they're creating the trust and agility that today's customers expect. So that will be the underlying theme of our session. And we're about to have the session spearheaded by Shubhana Sheikh, who's a special correspondent, Banking and Finance Mint. So with that, we're quickly setting the stage, and we're about to bring on board our next set of speakers as well. And this is very aptly titled Fireside Chat for us all, which is all about from rivals to partners. So let's do that. Let's get to gather all the insights from our next set of speakers who are about to join us. And once again, we'll take probably a couple of seconds. We'll set that we'll set that on the stage, and then we'll get the next discussion started. Meanwhile, ladies and gentlemen, continue being seated. Our next session is about to begin right here, right now. So on that note, let me go ahead and firstly invite our session moderator. I'd like to please invite Subhana Sheikh, Special Correspondent, Banking and Finance, Mint. And joining her, let me please invite our speakers. We have with us Nirav Shah, Managing Director, Investment Banking, Equirus Capital, and Ravi Narayanan, Managing Director and CEO, SMFG India Credit Company Limited. Let's also invest in a round of applause there so that your energy will be the cue for our speakers and for Shubhana to get the session started. With that, over to you.
Good evening, everyone. We'll try to keep it short and ensure nobody gets bored because it's evening. Sir, I'd like to start with you, sir. You're a former banker, now you know, running the whole NBFC show. So I really wanted to ask, let's just get into the basics of it. How does NBFCs benefit from partnering with fintechs, vice versa, and how would they each, cannot achieve alone?
Yeah, thank you, Shubhana, and good evening to everyone. Thanks for having me on this panel. I think broadly speaking, in terms of what the customer is looking at today, is all about speed, transparency, trust. And I think a combination of all of this is what they expect from the financial intermediary. And so whether it is fintech or NBFC or a bank, I think broadly speaking, these are things that today a digital first customer is very keen to understand and also get back in return. Having said that, what does a fintech bring to the table? I think a fintech is all about innovation, it is about agility, it is about tech first, and therefore the understanding of the customer is much more superior because of the data that they are able to massage and bring to the table. And what does an NBFC do as a regulated entity? Brings trust, brings governance, risk understanding, and possibly nuances of underwriting that are much more sophisticated because they look at a customer in those angles and perspectives. So therefore, when these two entities come together, they are in a position where they are able to give a complete 360 for a customer. And this contractual arrangement benefits both, and therefore the customer at the end of the day, because the customer is able to get trust, is able to get transparency, and is able to get technology. So in these kind of elementary availability of all these three T's, I think the customer comes out the winner, and therefore, which is what all of us in financial intermediation are looking for. So I think the two of us, platform and a happy customer. And what else do you want?
Yeah, I mean, that's a good combination. Nirav, I'd like to move to you. You work with a lot of fintechs and NBFCs, you know, financing IPOs and, lots of other instruments. What is the biggest struggle that, fintechs and NBFCs both face in today's time? And especially when it comes to digital first customers?
So thanks for having me here. I think the primary basis on which all the fintechs are started was the distribution at scale that they can do versus some of the other NBFCs. But at the same time, it also has lots and lots of data on one side, which helps them to do a lot of behavioral analysis of the data. An NBFC typically looks at a certain data set, right? One of the fundamental struggle that I have seen where fintechs and NBFCs find today is not having the common set of data. I mean, as basic as what an NBFC needs, from an assessment and what data the fintech is able to provide. The second, which is very, very important, is the legacy systems on which NBFCs have been built so far. The kind of data pipes that the fintechs need are not the data pipe that probably an NBFC is able to do.
Right.
Third is how fast an integration or an API first approach can be done between both the parties. Typically, everybody says, I'm a low code, no code fintech, which may be true, but at the same time, are you able to integrate with a large bank? Are you able to integrate with an NBFC swiftly? It really doesn't happen. I mean, it takes lots and lots of months for both of them to come together. I'll give you an example where in my erstwhile organization, used to work with a lot of fintechs on co-lending opportunities where as basic as somebody who's doing co-lending of 1 lakh rupees, on one side we have an NBFC offering 80% and the fintech offering 20% from their balance sheet. The loan EMI schedule didn't match because the principle on which the whole EMI schedule is based is somebody is actually offering 80,000, the EMI schedule is very different, and somebody is offering 20,000. Put together will not be the same schedule when you are offering a 1 lakh rupee loan. So I think that's very, very important. Second very important point is the governance. On one side, the fintech wants to obviously scale very, very fast. And on the other side, NBFCs wants to make sure that the compliance is not weakened, right? Because they are answerable to the regulator. They are being audited by the regulator. So I think these are two. So both of them are converging to a similar road, currently, but at the same time, there have been a little bit of struggle with respect to both of them coming together and working on the same kind of a customer base.
Right. I exactly wanted to touch upon that. You spoke of data sharing, tech, and also compliance. Given the rise in AI and tech evolution, how can both NBFCs and fintech, speed up their credit decisions without compromising on the compliance and the risk standards?
So needless to say, you have to comply with DP rules. I think that's becoming the norm today. So make sure that the data is not compromised. Okay. What one has to make also very, very important, strong at the outset is to make sure there is a common set of fraud detection that happens at the upfront, right? Because today and lots of other panelists did talk about the frauds and so on and so forth. I think anti-money laundering rules are also there, is coming up in India today. I think making sure that all the kind of data that is being there is localized, following the DP rules, and making sure that you have a robust fraud detection technique. I think that's very important at the outset, is what I believe.
Ravi, so you'd like to add?
So I think I'll just put up a stack, which is governance, resilience, and sentience or salience, whichever way you look at it. So obviously, as Nirav correctly said, governance is all about ensuring that statutorily and regulatorily you are able to bring in robustness, right? And therefore you have to ensure that all the necessary contractual obligations are brought into play, whether it be the law of the land or whether it be your own internal contract between the NBFC and fintech. As far as resilience is concerned, I think it is again about data practices. It is about ensuring that there is complete transparency. There is, all elements of cyber, strengthening, which is there. So, because at the end of the day, it is not merely speed or the availability of money to lend, which is important. It is also about ensuring there is sustainability of what you are providing. And third, as I said, you call it sentience or you call it salience or you call it explainable AI, whichever way. How do you use this data? And how do you ensure that the underwriting, the policies, the risk management is different for each different person, right? And therefore, it has gone beyond bespoke and personalization, And it is about ensuring that you understand each customer basis available and derived data to ensure that the offering and the solution that you provide has much more meaning to each individual differently. I think that's what it is. So governance, resilience, and salience is the way I look at it.
Also, sir, what models are working well under the current regulatory environment? The regulatory environment seems to have been eased, the recently that we've been seeing. And the RBI has also, they've repealed a lot of circulars, they've tightened the regulations, in the sense the number of regulations. So which are the ones that are non-viable for the NBFC and the fintech space, and for both to work together?
Yeah, I think first of all of us as regulated entities must salute the regulator for doing 5,000 knockoffs dating to decades, right? I think, and that's something which I told people in my company, saying that if they can do it, we can do much better, right? In terms of the size and scale between a regulator and a regulated entity. Having said that, I would say that in terms of risk alignment, I think that's the most important part in any partnership where there is financial contracts involved and ultimately a customer involved. So I think any model which is risk aligned in sharing of the approach to a customer, that digital partnership will always be very strong, and that model will continue to work. So it is not just about risk sharing, which is how it started, but it is about risk alignment. So which means you have moved many more steps in terms of understanding what you are doing. The second, of course, Nirav talked about it in terms of co-lending. I think people are getting better and better at understanding what it will be. I think it's already a 1.3 trillion INR, growing at 40-45% clip. So I think that's a very large space. Yes, there will always be nuances as part of the evolution of any new model, but I think that is a model which has moved out of nascency and is beginning to take solid steps post the crawl. Then of course there is embedded finance, which I think is slowly coming out in terms of your ability to proposition lending as a vehicle in non-financial platforms, right? So I think you hire a cab on Ola and then you find an opportunity to do some kind of a lending because you understood the customer who has hired the cab, a little better, right? So stuff like that. So I think embedded finance is something which is coming up, much more runway left for it to take a flight. And obviously, if I just turn it around and look at exactly what is the opposite which has not worked. So for example, as I said, risk sharing. So, if you just got into a contract and said that, this is your risk and this is my risk, and then we'll figure out the customer later and so on and so forth. Those days are truly, away and gone. Second would be, the DLG part of it. If you just thought that a mere default guarantee in a loan will take care of the model and the way you function, I think too much of kind of a dependence on that model is also something which has stopped working, and obviously the regulator has also figured that out and cautioned and strengthened and tightened that part of it. So I think this is the way I would say.
So co-lending and embedded finance.
Just to add, I think things which potentially has not worked out in my mind is basically there were fintechs who used to have partnership with NBFC just for renting out their balance sheet. So I think that is I think has not worked out well for the regulator and also for the fintech companies and the NBFCs. I think so renting out balance sheets is completely kind of gone. Second, I think also the fact that in spite of having certain guardrails in terms of what percentage FLDG one can provide, but there used to be some arrangement beyond this. So there used to be uncapped FLDG commitments that used to happen. I think that potentially is also not worked out for some of the fintechs because many of them have gone down the drain because of some of these other commitments being done on the sidelines outside what the guardrails actually RBI. So I think these are the two things which potentially, to my mind, have really not worked out. One other point of what potentially has worked out is likely to work out is some of the sub-sectoral lending. When I say sub-sectoral lending, is there are certain fintechs very good, say for example in EV financing, right? Which is where an NBFC cannot have a separate vertical, but there are fintechs operating in that space. You know, tying up with fintechs makes a lot of sense. Or maybe in, say, rooftop solar financing. I think that's another area which is kind of picking up. A lot of green credit is picking up, etc. So to my mind, I mean, just I think there's a lot to be done together as well. A lot of symbiotic relationship is now happening within the industry, and everybody is looking up to each other in terms of what more they can do it together.
Yeah, you touched upon co-lending and embedded finance. What would be the next big opportunity between the two, NBFC and fintech collaboration? You mentioned EV finance. Is there something else that the industry should look out for?
I think more of this and some more. I think the way one would look at opportunities which are there, as far as SMFG and SMFG India is concerned, because we are a global conglomerate, what we look for is fulfilled growth, right? As in business that can be monetized, commercialized, but is also inclusive. And I think any model which is able to bring those elements into play would be things that we would look at. So green financing could be areas that we could consider as possible growth, as long as it makes commercial and economical value sense, right? Does it make today? I don't know. EV financing, if one were to look at it in terms of how manufacturers are looking at it, either you are too small or you are too big. So I don't know which way the financial intermediation can support that element. But inclusive growth, which is sustainable, which brings in your element of, let's say, Viksit Bharat, or being able to create financial inclusion, I think those elements would always be something that can be pursued, because in the mid to long term, those are the ones which will be able to evolve to a stronger platform. So I think broadly speaking, I would say that anything which includes many more economic strata is something that will always work.
More financial inclusion, is what I'm guessing. Sir, taking that question forward, and also circling back to the digital first consumer segment, over the next 3 to 5 years, what sort of major strategic changes, both NBFCs and fintech, should do in order to make sure that they stay relevant in the digital first, game?
So I'll again refer to what Nirav mentioned obliquely. There are 4 stakeholders in this equation, right? So there is the fintech, the youth, then there is the NBFC, which is a regulated entity, then there is the regulator, and the 4th is the most important one, the customer, right? So I think these 4 have to be looked at whenever we talk in medium to long term. So if I look at the most important person in these 4, which is the customer, I think everything to do with data practices, data usage, consent, anything which has to do with the customer or directly impacts the customer would be the most important thing which should be considered when we look 3 to 5 years. The second would be in terms of governance or compliance. So everything to do with credit underwriting, policies, risk, regulatory elements of how we function. I think that's most important. As far as the fintech is concerned and the NBFC is concerned, I think let's look at it in terms of contractual accountabilities. How both of us understand each other better, align better, and therefore realize that the accountabilities lie on us in terms of how we go about the arrangement. The second would be, as part of NBFC Fintech, would be in terms of the guardrails that you put in, and let us say how we are able to underwrite or get the data practices enabled, right? And finally, as far as the regulator is concerned, as you correctly mentioned, the regulator has been the biggest facilitator for all these models, right? And I think the regulator has been facilitating, kind of ensuring that there is enough grease in the system to create experiments. For example, we are the biggest users of RBI Innovation Hub, and that makes a huge difference for us in terms of how we do. 3.5 years back, we were the so-called pioneers in digital partnership, and we have learned over these 3 years in terms of how to get better. Now, industry is looking at us in terms of how SMFG India has done it, and they are, kind of replicating some of those elements. So I think if we are able to take care of these 4 constituents with preeminence given to the customer and how the customer is treated and the experience is given, I think 3 to 5 years we will see NBFC Fintech partnerships becoming more robust. Yes, it failed some of the tests in the past, but I think both of us have, it's easy to fall down, but with what the character is when we are able to get up, holding each other's hands.
Well said. Neerav, would you like to add?
Yeah, so I think obviously Ravi did speak, has covered almost everything. But one of the things which I feel is going to be relevant over the next 3 to 5 years is, see, on one side, the customer is becoming aware of the option he has, okay, at the outset. Which means that at some point of time, you used to have people charging APRs of more than 70%. That 70% has become 40%. And that 40% is eventually going to become somewhere in the 20s. So making sure, if you want to be relevant, product innovation has to be there. You need to be innovative all the time. Second is making sure the balance between how much to spend on technology and how much to spend on people. I think balancing these two is very, very important. You cannot be spending a lot on tech and a lot of people. Right. If the tech is not able to give you the operational efficiencies that you expect out of this, you will be thrown out of the industry. Because the unit economics are not going to be in your favor compared to some of the other people who have been. So I think from an entrepreneur, any tech company or fintech company that we speak about, somebody says we have spent so many crores of rupees, hundreds of crores of rupees, or somebody says we have spent 500 crores. I think what is the right number, nobody knows, right? So are you overspending? Are you underspending? Does it mean that you are going to be ahead of the curve 5 years hence? I think it's the major question in front of everybody else. So ensuring a very fine balance between tech, people, operational efficiency, and hence the unit economics and profitability and obviously product innovation. I think all of that is going to be far, far more important if one has to be relevant over the next 3 to 5 years.
And how do you think the rise in tech and tech spending and also global compliance could help unlock last mile credit, because NBFCs and fintechs help the underserved banking segment? So how do you see that helping?
So any global exposure always helps in terms of understanding what's working, what's not working at a much larger scale. And therefore, I can say with a lot of confidence, given the group governance standards that we follow, broadly speaking, it is no more a transactional element. It is now a strategic imperative that if you do not have your thresholds benchmarked to global standards, you are suboptimal at all levels. And second is that all of this is somehow going to ensure that there is a meaningful, decision that you are taking. So global benchmarks, credit, lending should finally make an impact. And I think that is what is most important for us, rather than saying that I have thresholds which are marked to global standards. That is now merely a form factor. What is important is, have you really made an impact? So if I were to put an analogy, the global benchmarks are the guardrails, technology is the rails, and partnerships are the wheels, right, which run on these rails. So I think that is how we have to look at it, in terms of saying that how these are helping us deliver the impact that we want.
So I think what is the way I think about it is two parts, right? Supply and demand was never an issue. I think what was more important was the trust element, and with making sure that the customer who is actually borrowing money and at some stage are also giving their loan documents or mortgage papers to a lender, I think there was some bit of a missing element. When making sure that RBI has, with all the compliances coming in, and some of it being very, very tighter for an NBFC and the fintechs, I think what is helping is everybody is coming on the same level. Second, which is say things like account aggregator. Today, everybody is able to pull the same data. If you talk about the UPI on credit becoming a credit on UPI becoming a reality, I think everybody will be able to offer the same solution and with the same compliance. I think that is where I see that when you are actually globally compliant and you are making sure that all of your system, processes, data, governance are in place, I think you are actually much ahead of the curve in that sense.
You initially spoke of data sharing. I just wanted to touch upon that. How can NBFCs and fintechs both share data and risks effectively so that they could tap new to credit customers? Because new to credit customers, lenders basically look at the cash flow, right? There is as such, no credit history there. So how do you see that?
I think what I feel is the data has to be completely encrypted. It has to be used only for the purposes for which it is meant and collected actually. So to make sure that all the data that we are actually collecting, and if there is a relationship between a fintech and an NBFC, making sure the data lake is actually unified data lake between both the parties, making sure that the same data lake is not breached upon or used by some other part of the vertical or the business verticals. I think some of these basic things are very, very, very important when you make sure that some of the data is not compromised for the customer who is actually sharing a lot of, and underlying guardrails are obviously the TPDP rules.
So, last one.
Yes, I think, in addition to what Nirav has said, I would say that it is all about governance, right? And if you have ensured that there is consent, there is sensitivity to data practices, and there is an overarching framework or architecture which is available with you to ensure that both the NBFC and the fintech partnership contractually understand and align themselves to the underlying risk, I think it would be a very happy relationship. And a long-term wedding is the way I would put it. So I think it is important for both the fintech and the NBFC not to be stuck in this role of saying NBFC is the risk guy and fintech is the agile guy, right? I think the swapping of these aspects also will make a huge difference in terms of looking at it.
Thank you, gentlemen. Yeah, thank you. Thank you for the insights.
Thank you.
Yeah. Thank you.
Thank you very much. I'd like to request you to please remain on stage. And first up, if I could also request you all to come together, we'll have a photo op. We'll capture that moment. We're actually out of time, ma'am, and we have our next session. Our speakers are waiting, so we're going to move ahead. I'd like to request Shubhana to please quickly present a token of our gratitude. But ma'am, the next session will begin, so we'll definitely open the floor for our next session for sure. I promise you that. Ma'am, I'm so sorry. Our next set of speakers, unfortunately, I've been told they also have a flight to catch. So we'll ensure that our next moderator opens the floor for questions. We did open the floor. I think we took a lot of questions. We did, ma'am. We did. But thank you again, and I shall ensure we'll inform our moderator. In fact, our next session, we have Shayan Ghosh. So Shayan, wherever you are, yes, we have an imperative to also open the floor for questions for our next session. In fact, it features some of our incredible leaders here. So we'll definitely open the floor, and we'll ensure, ma'am, we'll take your question as the first one. I promise you. But that being said, please bear with us for just a minute. We'll also ensure that we can set the stage, and we'll also get our speakers on board who've been waiting to get the session started. I'd also like to share with you what our final topic for the summit is. It's all about where the banking sector is as a catalyst for India's economic growth. And let's get to understand that on a deeper tone, because as India positions itself for the next phase of economic expansion, the banking sector stands central, not merely as a financier, but also as a strategic catalyst for sustainable growth. And India's long-term economic ambitions will hinge on a banking system that is capable of mobilizing capital efficiency, strengthening credit delivery, and also supporting structural transformation. So let's get to understand India's growth ambitions, but let's get to know that from the very leaders who will be driving it as well. And as I mentioned, once again, we'll have Shayan Ghosh, editor BFSI, Mint, who will be taking this discussion forward. We've got 3 of our incredible leaders joining us, and let's get to gather their insights really quick in the form of this panel discussion. So with that, Shayan, if I could invite you on stage so that you and we can welcome our final set of speakers for the conclave. And with that, let me march ahead and let me please invite our speakers. First up, we have with us none other than Mr. K. Balasubramanian, the CEO of Citi India. And if I may please invite you on the stage, sir. I'd like to further please invite Mr. Rajiv Anand, Managing Director and CEO, IndusInd Bank, and Mr. Devadatta Chand, Managing Director and CEO, Bank of Baroda. Thank you very much, firstly, for joining us this evening. And with Shayan, over to you.
Hi. I think we have got a good representation. We have one foreign banker, one PSU, and one private. So hoping for some diversity of views there. We don't have much time, so just jumping straight into it. The first question, all of you can take 2 minutes each on that, probably. Credit as an economic driver, especially for a country, as like India, we are looking to become a developed nation by 2047. What is the role of credit, right, for a nation like India, especially because there seems to be some lack of demand that we are seeing right now? With Mr. Chand, if you could start.
Thanks, Ann. Now, in fact, you rightly said, credit is the main driver as far as the economy is concerned. And if you look at India's bank's credit to GDP, almost at around 55%. And in case we aspire to be a developed country, I think we need to push it to something around 60-65%. Saying so, as a bank like the public sector bank, to critical sector in the economy like the agri and MSME, we are the main credit provider. And we have been doing this for decades and decades in terms of providing credit to these 2 sectors. On the corporate side also, there has been a huge, the economic development linked to the bank's credit. And as on today, if you look at the scenario we have said while announcing also the Q1 and Q2 outcome, we said the bank's corporate lending, which slightly saw a muted growth in both the quarters, it is going to pick up in Q3 and Q4. And on a full year basis, will be almost at 10-11%, which is right on the nominal GDP level. And if you see all these numbers, I think there is the demand is there in the economy. And post the GST cut, the kind of consumption demand has happened that would translate into the investment credit. So in that way, I'm quite, as a bank, we're quite bullish about the economic scenario. At the same time, I think a bank like us can play a very larger role in terms of providing credit to the economy. And in the same way, a lot of things that happen on the overall economic scenario, I think these are all positive for a stronger growth going forward.
Rajiv.
So I think that equation between nominal growth and credit growth, which used to be 1.3, 1.4 times, has actually broken over the last 3 years or so. And I think we've got to start from the deposit side. And I think what we have clearly seen over the last many years is that deposit growth, and within that, current and savings accounts has got more and more difficult to garner. And I think you've got to look at that in the context of the fact that now there are many, many more opportunities that are available to savers, liquid funds, bond funds, equity funds, pension funds, to name a few. Private credit is becoming bigger and bigger. And so therefore, in that context, one also has to look at the fact that households, the composition of savings has changed as well, meaning that at a gross level, household savings are flat. They've actually become net borrowers, which at an economy level is a good thing, that they're buying more consumption, more cars, more houses, etc. But to that extent, savings are not coming. Government savings are more or less flat, and much of the savings is really coming from the corporate sector, which is coming to us at slightly higher levels than the retail side. And I think that is a structural change that has happened. I mean, I think I saw a newspaper headline a couple of days ago that the mutual fund industry is about 80 lakh crores now, which means that it's about 40% of the banking sector. I will not be surprised that if this number does not become 1:1 in the next 5, if not 10 years. And I think therefore, to that extent, the composition of or the ability to garner cheaper deposits is going to change as we go forward. And so therefore, I think the days of just looking at credit growth, as it is to my mind, at least in the medium term, is over, because now the corporate has multiple ways to finance their capital structure: local equity, global equity, local bonds, global bonds, and bank loans from the Indian perspective. I do agree that we will continue to be large lenders to the MSME sector. Will be reasonably large lenders to retail side, but I think corporate will continue to have larger opportunities for them to be able to finance themselves. Anyway, I think the well articulated headline is that private capex in India is relatively weak. So I would be surprised if we're going to see any material increase in corporate credit growth in the days to come. So I do believe that as long as deposit growth continues to be relatively muted, I don't see that much of credit growth coming through even in the years to come.
Bala?
I totally agree with what Rajiv and Mr. Chand said. Because if you look at the availability of capital to companies today, it's very different to what it used to be, say, 15, 20 years back. And if you compare any of the developed markets, the bank's ability to provide credit is quite measured. Majority of the needs of the corporates are all funded by the bond markets, right? And as India is also moving from where it is to the developed market state, I think the avenues of capital that a company can tap is much, much more today compared to traditionally looking at the bank as the main capital provider. Rajiv talked about the size of the bond market. It's still less than 50% of the size of the bank market, but then clearly the large corporates, what they're doing is they're basically looking at bank as a backstop, and they ideally would want to go into the capital market, be it equity or debt, both international as well as domestic. So earlier that was all coming into the local bank market, and I think that is moving away to others. I think the SME and MME are the businesses which is still dependent on bank market. But frankly, today credit is not the only metrics in terms of trying to see as to where the economy is because of the various options that companies have for raising capital.
That's something I think also is evident from RBI's the data on flow of resources to the commercial sector. So taking Rajiv's point forward.
And globally, if you think about it, especially in US, the size of the bond market is actually 3 times the size of the banks. So that's how deep the bond market is. And both in terms of tenors as well as in terms of size, you get an yield curve available, which is still very nascent in India. But I would expect that, over the next several years, I think that's the direction of journey for India as well.
There's been multiple conferences, over the last decade or so on deepening the bond market. Has the needle moved somewhere? I mean, from Bala.
You cannot just look at bond market and say why it is not moving, right? You need to have the various constituent being active in the bond market. For instance, can the pension funds invest in a wide variety of corporate papers? Because, if you restrict it only to AA minus or better, then that basically narrows the pool of capital that, they can deploy. So I think there is a bunch of serious needs to be available because, people should have avenues to try and see in terms of, how they can risk manage the positions. So I think there are multiple constituents that needs to be there. And as Rajiv mentioned, as more and more money comes into the asset management companies and they start creating an active debt portfolio, eventually, that will find its way into the corporate lending space.
I'll go to Rajiv next. You spoke about private capex cycle. Is there a sense that some of the conglomerates instead, their next generation, instead of creating more resources in terms of putting up factories, there is a propensity to do more of family office investments. Is that something that's also holding back private capex?
Perhaps, but I think, once again, I think we've got to step back. If you look at what is happening to the composition of GDP, agri is doing what it is doing. We're actually seeing the share of manufacturing continues to come down, and we are increasingly becoming a more and more services-oriented economy. And we are actually seeing some incredible entrepreneurs coming through in that space. Many of these entities are listed today. For example, look at Zerodha, Grow, or Zomato and such like. And I think that in a sense is really the future of this country. We spoke about the fact that there is strong growth in the MSME sector, and as I meet my customers within that space, I find significant energy, with entrepreneurs within the space. They're doing some incredible stuff in defense, in aerospace, exporting toys to the US and such like. So fairly sophisticated work that they're doing within this space. So I think you also look at it in the context of the fact that it is not as if private capex is not happening. Yes, we want it to be much more than where it is today, but the corporate balance sheets are in the best shape that we have seen them in the last 15 years. Their cash generation is very, very strong, and so therefore they are able to support their private capex through their internal accruals itself, which is once again not a bad thing. Maybe if you're the head of a corporate bank, it's not so good, but from an economy perspective, that is certainly pretty good. But I think the short answer to the question that you're making is asking is, I think the composition of the economy is certainly changing, and so therefore this question that we've been asking ourselves for the last really 7-8 years, when is private capex going to happen? There is no shortages in this country, right? That's very clear. There is no shortage of steel or cement or whatever it is. I think the supply side is more than taking care of the demand that is required. So it is not as if the lack of private capex is creating shortages. In which case, why should we be worried about whether private capex is happening or not?
I'll go to Mr. Chand. See, PSU banks have been one of the largest funders of infrastructure projects previously. Are PSU banks and banks at large, are they back in the game of infra financing? Or is it a case of lack of demand and lack of fresh projects that are coming in the market?
Look, in terms of infra funding, we have been there earlier also and we have been there now also. So absolutely there is no change in terms of the focus on the infra. And if you look at the kind of, you referred about the funds flow to the capital market, I mean the consumer market. In that way, roughly around 1/3 of that goes into the infrastructure. And if you look many of the infrastructure projects, the demand has been there. Sometimes on the private capex, we get confused with the growth of corporate credit as a proxy for the private capex, which is not so. One data point I'll give you saying that this is a CMI data point wherein between April to October, the private investment is almost 21 lakhs crore announced as compared to 16 lakhs last year. And as Rajiv said, right, many times if the internal accrual is quite strong, why at all they should come for a bank credit? So, I mean, earlier it was so the bank's corporate credit growth was a proxy for the private capex, but then now there are multiple options for them to do it. So in that way, I don't agree that there is, we need to do more, no doubt about it, but currently also I think the demand is quite strong. On the kind of infra funding we have been doing, the growth is there. On a full year basis, most of the banks like us, public sector banks, we are looking at almost 10 to 11% corporate credit growth. The point we need to work more is if you look at future years in terms of 5 years, 10 years, 15 years or 2047, the demand that we see on the credit would be very high. In that scenario, banks continue to be the anchor in terms of funding infrastructure. At the same time, we need a lot of non-bank sources also to fund it. In any like maybe equity or a internal accrual getting into the corporate balance sheet, that allows us to leverage by 3 times or 4 times in terms of debt equity. So I think in the sense scenario, banks we have been doing it quite strongly. I think there is a demand. The growth of 10-11% is a good growth, but we need to do more, no doubt about it. And going for a future requirement of funds for India for funding infrastructure, the kind of requirement there, I think bank is going to play the anchor role. At the same time, we need non-bank sources also to complement or supplement the requirement of credit.
Are you facing a lot of competition from the non-bank sources, especially the ones that have been recently created, who have a government backing, so their cost of funds, the rate at which they're able to fund infrastructure and the specialized infrastructure financing companies, in terms of how they are pricing a loan, and especially an infra loan for that matter?
So if you refer, it's going to support to the entire, system in terms of supporting credit. So the heavy lifting of funding to the infrastructure, it has been done by the banks together, and now with new institutions coming, they are supporting us in terms of, look, the couple of things that are happening in the market now. Like, in case there is a syndication deal happening, the time to close the syndication is much faster now as compared to earlier. The time to have a financial closure for any corporate, it's improved significantly. In Indian market now, we have come out with the secondary loan market, which is in line with the SNC market globally, so that's helping. So in that way, I think the market is much more efficient, and more players there have been in the system. It would improve the system further. But at the same time, it would make definitely competition stiffer at the same time, but we are all prepared to manage those scenarios.
Okay. Coming to Bala, a question on foreign investment. You would be interacting with FIIs. We have seen a lot of outflows from India. Somebody was putting it at 200 crore a day for the last, 30, 40 days at least. There's been selling. Apart from that, there's also been the IPOs where the initial investors pulled out money, the FPOs. What I wanted to understand is, what is the concern that FIIs have on the Indian market right now?
So I'll probably answer it in 2 or 3 different ways. If you look at a country like India, and the government's objective of making India as a developed market by 2047, we are looking at a block of 4 blocks of 5 years between now and 2047. And on an average, we believe that the investment that is required for us to move from where we are into a high-income country is between $3 and $5 trillion in each of those 5-year blocks. Now, if you look at the domestic savings rate, I don't think that is enough to fund the capital that is needed to take care of this $3 to $5 trillion every 5 years. So there is dependence on foreign capital, right? And this foreign capital could be in the form of manufacturing capital, which is FDI, or in the form of portfolio investments, which is FII. Now, if you look at FDI, I think we are not doing very badly. If you look at the gross FDI, I think that's been always in the between $80 and $90 billion range. The reason why the net FDI is lower is because of the listings, etc., that is happening in the Indian market by foreign companies. And clearly because the growth potential for a subsidiary in India is way better than the parent growth potential. And therefore, they're getting a valuation multiple, which is way superior to what they get at the home market. And therefore, majority of these issuances are offer for sale. And therefore, the money is being taken out of the country. And so the net FDI is actually lower than the gross FDI. But overall, on the gross FDI side, I think we are still not bad. On the portfolio investments, I think we have seen a little bit of volatility in the last 12 months. And that's primarily because 2 or 3 things that happened. See, Indian market was always a little expensive as we came into, Q3, Q4 of last year. That's primarily because people were still willing to pay that market is because of the growth prospects that, the country had. But then since the June 2024 quarter, as well as the September 2024 quarter, the growth got really impacted on account of a variety of reasons, right? That basically shook the confidence of foreign investors. Because 3 consecutive quarters of growth being muted, that basically said that, is there a better way to allocate capital in a market which is already very expensive? The second thing that happened was some of the other competing markets became more attractive for this capital to move out, the likes of Korea, Taiwan, China, etc. And the third thing, as we all know, that is playing out in the global markets is the AI theme. Unfortunately, India is yet not a big beneficiary of AI theme. And therefore, some of the money that moved into markets like Taiwan and Korea was on account of AI. So combination of these 3-4 factors resulted in an exodus of money on the portfolio side of the last 3 quarters or thereabouts. And then traditionally, if you look at the last 20 years, whenever the primary markets, i.e. the IPO markets are doing well, there is a rebalancing of portfolio that happens between secondary and primary. And if you look at all the issuances that have happened in the last 24 months, you typically see 50, 52, 53% participation coming in from foreign investors. And some part of it is basically money being taken out of secondary and coming into the primary market. Now, with 2 quarters of 7.5%, 8% growth that we have clocked in, the corporate performance is again starting to pick up. We talked about the balance sheet of not only banks but even corporates. My sense is calendar 2026 is actually going to be quite positive for India because the valuations have also got a little muted compared to what it was 12 months back. So it was an interim pause that we went through in the last 12 months, but I generally believe that 2026 is going to be a better position than where we were in 2025 or 4.
Okay, I'll go to Rajiv with this, and then others can also chip in. This growth, because we're on the topic of growth, this growth of 8.2% that we saw, does it feel we are growing that fast? And I'm not getting into the quality of data that has been talked about, but where is the disconnect? Even the forecasters, the professional forecasters, central banks are not able to get the forecast correct. Why does it not feel like 8.2%?
If you look at data around, if you look at tax collections, for example, are muted. If you look at corporate profitability, it's muted. It's not a 8.2% kind of profitability. The problem is in the nominal, right? I mean, so therefore we can argue on, I agree with you, chalo, it's not 8.2, it is 7.5 or 7.2, whatever, but we are in that vicinity. I think the problem is in the nominal. I think traditionally we have been used to 7-ish% growth, about 4 to 5% inflation, and so therefore getting nominal of 10 to 12%, and therefore corporate profitability about 15%. So even if you assume that we will continue to deliver 7% growth, but if nominal does not go up, we will be in a lower growth environment from a corporate profitability perspective. Is it, I think a lot of us are now assuming that, oh, this is all going to go in the base effect. We will go back to 4% inflation from next year. I'm not so sure. I think you've got to look at it from the perspective of, look at what's happening to global commodities, relatively muted. Oil prices is relatively muted. GST cuts are passing through to lower, pricing in the local economy, etc. It is possible that we are now no longer going to be in the 4 to 6%. Maybe we'll be in the 3 to 5 or maybe 3 to 4%, vicinity. Which means that if nominal is 10, corporate profitability will be, let us say, 12%, and maybe the 15% that we've been used to is going to become less of a probability. In which case, I'm saying this on a slightly longer term basis. Maybe next year, because of the base effect, profitability, particularly banks, etc., might look good because much of the rate cuts, etc., is now in the denominator. But if you look at it on a slightly longer term basis, if you broadly now begin to believe that nominal growth is only going to be 10%, then perhaps overall growth rates, we should start to get used to slightly lower levels of growth as we go forward.
Mr. Chand, does it feel like world-beating growth?
Look, as far as we are concerned, we are one of the fastest growing accepted across, like whether it's IMF data, any data. I rather see the growth more from the point of view of the outcome that we have as on today. Unless and until we have very strong growth, you can't have such a strong capital market. Because typically, capital market is some kind of a lead indicator with regard to the growth that we have in the system. And looking at the Indian capital market, the way it is growing, the way, this both depend upon the current GDP and the future GDP. I think I'm very positive with regard to the outcome we have vis-a-vis the capital market, strong capital market. And no denying fact with regard to India's growth being one of the strongest in the entire world. And we'll push like more and more, we are a consumption, more of a consumption driven economy. And the last 3 months, the kind of consumption demand we have seen in the market, I think they're quite positive with regard to a strong GDP growth for this financial year and going forward.
Bala?
See, again, it's a question of, we are living in a world which is more a relative comparison. And as an investor, when I'm looking at investing money, I would rather look at countries which is showing stability, which is showing growth rate, which is comparatively better than others. And from those parameters, if you look at India, I think it's still a good place to invest in. And, we all talk about the demographics, which is very positive. We keep meeting a lot of investors across the world. And I think these are some of the stories that, that sell very well with the investors. And I think as long, and again, if you compare us to some of the other markets like China, etc., they potentially are at the peak of the curve and it's only a curve which is sloping downwards, whereas we are still on an ascent, which then means that, the allocation of capital that is going to come into the country is actually going to be better and will continue for a longer period of time. So we can keep debating whether 7, 7.5, 8, 8.5% is the growth rate, but as long as you're in the zip code, I think it is a great position that we have in the markets for us to attract capital. And that's probably one of the reasons why every issuance that is happening in the market is seeing record subscriptions coming in from investors.
Interesting. One last question to all of you. I'll start with Bala then. What are the 2 things that you want to see in 2026 in terms of the banking sector and the economy? You can take a few seconds to answer that. 2 things that you would like to see for the banking sector and the economy in 2026.
I think we all want the growth to come back because, that is actually going to be the oxygen for us to, survive and do better. Things are all in the right place, and the question is how do we build from where we are to the next level? I think that is going to be a continuing thing. I really don't think there is too much of headwinds that is there in the economy, so which again is actually going to be positive. Government is very proactive, so that again is quite interesting. The second thing is I'm a little worried about AI disruption because we yet don't know in terms of what's the real impact of AI. The valuations are just running a little ahead of what the normalcy is. And every time in the past when we have seen situations like this, unfortunately it has resulted in a big crash. We saw that happening in 2000, we saw that happening in 2008, again in 2014. And I genuinely hope that, we are not going through that same phase. Now, the good thing is if there is something like that happens in the global market, there is going to be potentially a downturn that, we're going to see. And as I earlier said that, India is not yet a full beneficiary of AI. So we are actually going to get a contra trade on that. But then invariably what happens is like, whenever there is a global slowdown, countries are so interconnected that, it drags you as well. So I think that's the other thing that, I actually worry about. And the last thing, which is unfortunately been playing out a little longer than what we all expected it should have been, is the tariff situation. And unless and until we have a resolution to that sooner than later, I think that is going to be a continuing theme that, will have the markets being a little jittery.
For the banking industry, better CASA growth, easier PSL compliance are the two things that I would certainly look out for. From a global, from an economy perspective, like we discussed, it may seem counterintuitive, but I would actually like to see better inflation numbers as we go forward. And from a global perspective, I am really hoping that we don't get any Mr. Trump disruptions like we did this year.
I think rather I'll take a bit of medium-term kind of a view here. One is a case wherein, look, banks like us or many of the banks, in a year or two, clearly looking scale as one of the important aspect in terms of how do you grow, and that's something I think is going to come. And the second aspect, the way the branch banking has been happening, I think there is a churn going to happen. Already significant things have happened on the branch banking. And although I think the usage of AI has to be there, but it has to be deployed in a very controlled manner. So two things as a structural change I'm looking at in the banking sector for next 2 years. One is something on the scale side in terms of size of banks. At the same time, I think the way the consumer side, the branch banking has to undergo some kind of a significant change, which would allow people to bank. The banking has to be, the ease of doing banking, that is something significantly going to change. And we as a bank lightly align with both the aspect in terms of the way you look into future, and I think that's something we're working to, work on both the accounts. Thank you.
Thank you. We can take one question if there's someone. There.
Hello, good evening to all of you. I would like to put up this question because all three of you all are from bank. So I would like to put up this question. What is the biggest challenge that banks face as far as risk, regulation, and technology is concerned? My second question goes, bank managers generally do not sleep at night time. Is it mainly because of NPAs, fraud, or competition? And my third question is, what is the biggest catalyst for Indian banking growth?
Ma'am, I don't think we can take all three, so let them decide.
I can take the second question.
Anybody?
Yeah, I'll take the second question. Firstly, I want to compliment you, all three excellent questions. As a banker, there are various things which are keeping me awake, which is a separate issue. Maybe we should discuss separately. But the bank itself does not keep me awake. From a bank perspective, we are in the business of risk. And so therefore, as long as you are managing the risk on your portfolio, whether it is credit risk and living within the guardrails, we completely recognize the fact that there is cyber risk and cyber security risk. All banks are reasonably well managed. It's a continuous battle between the fraudster and the banks, and ensuring that we are keeping the customers' trust on our systems and the kind of digital devices that we are able to provide is something that we are doing on a regular basis. NPAs is part of the game. We will never be in a situation where we will be in a zero NPA situation. And so therefore, the way that we look at it is Are you pricing for a certain level of risk for each of the assets that we are putting on? And as long as, and that is monitored on a daily, weekly, monthly basis by various teams. And as long as it is playing out within this framework, most bankers will sleep quite well.
What about my second question?
Yeah, I addressed that. Actually, if you club the first and second in terms of the risk and something make you awake, look, the banks are in a beautiful financial scenario as on today, so they are in the sweet spot. So nothing making them awake at night at this point of time, frankly. But at the same time, what Mr. Anand also talked about, the cyber risk, that's the real challenge as on today for the entire banking. And as a bank, my internal mechanism to deal with cyber security vis-a-vis my own system, we have everything now. I mean, globally, we're in terms of technology, we have everything. The area that concern to us at this point of time is the consumer side. The customers losing money because of the cyber security and all those things. And there is a huge, what you can say, within the system, huge coordination to prevent those things happening. But then still the risk is elevated, and all the banks, including the entire the ecosystem in terms of stakeholder, everybody working together. We would have seen a news item today in the morning. There is a company to be floated to prevent that, where Bank of Baroda is one of the anchor over there. So that's something I think is an elevated risk at this point of time. Financial, other part of the risk are well managed, as Mr. Anand said, but cyber is something we are really concerned at this point of time.
Thank you. We come to an end of the discussion. Thank you so much. Thank you.
Thank you so much. And on that note, I'd also like to request Shayan Ghosh, our session moderator, to also present a token of gratitude to thank all of our speakers for the incredible presence with us here this evening. So much for those wealth of insights. In fact, we've been gathering a lot of perspectives, of Pandora's box of perspectives since the morning. But that being said, we do come to the end of the conclave. And on that note, before we do so, once again, I'd like to thank our associate sponsors, Equirus Capital, Pine Labs, HDFC Life, J&K Bank, and Gift City. And let me also tell you, it's time to take those conversations outside over cocktails and dinner. So we'd like to cordially invite you all to please join in for cocktails and for the dinner, so that we can take forward our conversations, we can get to connect, and we can also get to ideate a lot more over drinks and dinner. So we'd like to cordially invite you to join in. Please don't leave us yet. There's still a lot more going on right here at the conclave. So thank you so much again for joining us, and thank you for being part of the conclave. We do hope you've filled in the feedback forms and the survey as well. The QR codes are still there on the respective tables. Thank you again.